Good morning, everyone. I'm Brian Sazi.
And I'm Alexis Christoforous of Yahoo Finance, and this is the first trade for Tuesday, December 17th.
Feeling the pressure, Boeing stock slides for a second day, and its suppliers are getting hit too as the company moves to indefinitely suspend 737 MAX production. The big impact this could have on jobs and the U.S. economy.
Fighting big tobacco and big vape. Congress is poised to pass a $1.4 trillion spending bill that would raise the age for buying cigarettes and vape products to 21 nationwide, what it could mean for the tobacco companies and for Juul.
And drink up. Coffee futures surge and could soon trickle down to your local barista and supermarket. What's pushing up the price of those beans we so desperately need to start our day?
All right, let's get a full check here of the futures ahead of the opening bell. So far, some modest gains across the board. Of course, we'll get a full check of the markets in just a bit.
But first, here's your big story.
Boeing's decision to suspend 737 MAX production starting in January is rippling across the industry and its suppliers. Take a look at Safran. That's the French company that works with GE to make engines for those jets. Shares there, as you can see, down more than 2% this morning. And Spirit AeroSystems, which makes 70% of the fuselage for those planes, has also been under pressure for days. And the company tells Yahoo Finance it is still trying to determine what this means for them. Boeing is insisting it won't be furloughing any workers, but economists are already warning that halting production on the MAX could eat into GDP. The MAX has been grounded worldwide since March after crashes in Indonesia and Ethiopia killed 346 people. Our editor-in-chief, Andy Serwer, is here now for more. And Andy, the fallout continues. It's been pretty swift. Should we be worried about this prediction that it could actually dent GDP?
Absolutely. And it's hard, Alexis, to imagine a single company with a single product that has this big an impact on our economy. Right now, we're talking about between 0.3 and 0.6 of a percentage point of GDP that could be shaved off because of this move by Boeing to stop production of this aircraft.
Andy, one company caught right in the middle here is GE, and a GE spokesperson told Yahoo Finance via email they're, quote, working to mitigate the impact of the temporary slowdown. For GE, this is the last thing they need.
It really is, and you know, it actually reflects sort of a bigger point, which is the headwinds that this creates for the economy and for specific companies like GE. Regarding GE specifically, Brian, this company was actually looking at about $400 million that it's set aside because of these problems already. And now that the production will be halted, we're talking about a lot more money. Specifically with regard to Boeing, you know, they had set aside up to about $10 billion already. And now analysts are saying that could easily double.
And what about the airlines? You've got American and Spirit both saying they won't put these jets back in the air until at least April. They've already said they've lost hundreds of millions of dollars this year. What's this going to mean for their bottom line in 2020?
It's not good. And Southwest is another company as well that definitely is feeling the effect already and will feel more effects. There are already shortages in terms of number of planes that these companies have to fly passengers around. So this is going to make the situation worse. And it's going to really hinder our system in terms of people flying around the country and, in fact, flying around the world.
Andy, it sure seems as though Airbus is getting ready to clean up in a big way.
Yeah, you know, the thing about Airbus is they're the only other game in town. I mean, it really is a duopoly in terms of these large commercial planes. The problem is that, sure, Airbus is going to benefit, but they're constrained by capacity. I mean, they literally cannot make more planes. And when you talk to carriers, they very much want two companies at least. There's talk of the Chinese actually making commercial aircraft as well, but they haven't been able to produce one yet. But, you know, the world needs Boeing, not just the United States, the world does. And so it doesn't look like, unfortunately, they're going to be able to solve these problems soon.
I want to mention that yesterday, Boeing came out and said they declared a $2.05 dividend, a quarterly dividend. Were you surprised by that? And I mean, if they were to start cutting that dividend, would that really point to big problems within Boeing?
I mean, you know, that was a big conversation point for the board, Alexis. And, you know, they didn't raise the dividend. They didn't cut it either, to your point. You know, that's the last thing you want to do, because if they cut that dividend, of course, the shares will plummet even further. But, you know, at some point, you're looking at a finite amount of cash. And the cash has got to go to the furloughed employees, to the various carriers they have relationships with, to the suppliers. And at some point, something's got to give there.
This is quite the situation. Andy Serwer, good to see you.
Good to see you.
Let's see what Scott Gamm is keeping an eye on down at the New York Stock Exchange. Scott?
Yeah, Brian, we've got futures kind of mixed after yesterday's record run. I think the key point for today is that any positive close, even if it's by a half a point, would log another record high for the major indices. But in terms of individual names, we're keeping an eye once again on shares of PG&E, trying to rebound, at least in the pre-market, from yesterday's big loss. There was a story today in Bloomberg suggesting that the company's plan with the victims of the wildfires has been altered so that the governor of California does not have to sign off on it. Remember, yesterday we told you that the governor was not fond of the plan. And then we're also keeping an eye on shares of Goldman Sachs. The analysts at Wells Fargo Securities raising their price target on the stock to $280 from $240. The stock as of yesterday closed at about $230 a share. The analysts are bullish on the company, especially 1 year into its new management team. And then also Unilever shares getting hit hard in the pre-market, down about 8% after the company warns that it will not meet its 2019 sales targets amid some economic headwinds in South Asia. Guys.
Yeah, that warning from Unilever, tough on the eyes. Scott Gamm, thank you. Coming up here on The First Trade, taxes and tobacco, the big spending bill up for debate in Washington that could mean major changes for just who can buy cigarettes and vaping products.
All right, let's take a look at those European markets on this Tuesday. And so far, we've got things lower across the board. The FTSE 100 is down 17, the CAC 40 off 8, and the DAX down nearly 74 points. Yahoo Finance's Edmund Heafy is joining us from London. And Edmund, I've been watching the pound erased almost all of its post-election gains. What's going on there?
Yes, Alexis, the pound is down almost 1.3% against the dollar, virtually erasing, as you said, all the gains it made following Boris Johnson's emphatic election victory last Friday. Media outlets here in the UK are quoting a number 10 Downing Street, that's the Prime Minister's office, an official there, saying that Johnson this week intends to publish legislation that would prevent the UK from extending the post-Brexit transition period beyond December 2020. And what this would do is effectively create a new cliff edge, no-deal Brexit-like scenario after that point. And that means that if the UK fails to negotiate a trade deal with the EU before then, it will effectively crash out of the bloc. And that's what sent the pound spinning.
And Edmund, we also got some employment data out of the UK.
Yes, Brian, this is more positive. The official employment rate in the UK hit 76.2% in the 3 months to the end of October. That is the highest since records began in 1971. Economists had actually widely expected a loss of around 10,000 jobs, but there was actually a gain of about 24,000. And then the unemployment rate dropped to near record low levels of 3.8%. That's a sign that the UK economy is more resilient than a lot of the other economic indicators are suggesting at the moment.
Edmund Heafy, thank you. Congress is racing to pass a $1.4 trillion spending deal before government funding runs out on Saturday, and it could have major implications for everything from taxes to tobacco. Jessica Smith is in D.C. with more. Jess, the kitchen sink was really dumped in this one.
Yeah, definitely. Republicans and Democratic lawmakers released this legislation last night. It's more than 1,000 pages long, and it has a lot in it. This bill will fund the government through September of next year. It's a $1.4 trillion deal. And here's a look at some of the provisions that are in it. First, it gives federal workers a 3.1% pay raise, and then it has $1.375 billion for President Trump's border wall. That is more than Democrats wanted to give, but less than President Trump wanted. It also repeals some of the taxes meant to support the Affordable Care Act. Those taxes have been pretty unpopular with both parties, though. And then it reauthorizes the Ex-Im Bank. And then looking at some of the other elements, a big win for Democrats. It has $25 million for gun violence research. It also has $420 million for election security. And then finally, two more bipartisan efforts. It raises the age for tobacco products, including e-cigarettes, vaping devices, raises the age for tobacco to 21 from 18. So that is a big one. And then it also includes the Secure Act, which is a bill to reform the way people save for retirement. And Brian, Politico had a really good line this morning describing this bill. They said if you're a business and you had a priority that did not make it into this bill, you should probably call your lobbyist or get a new one.
Yeah, they're doing something wrong if it's not in there. You mentioned that there are some bipartisan efforts in this bill. What is the likelihood that it passes in the state it's in?
Well, Republicans and Democrats were working together on this. They've been negotiating along with Treasury Secretary Steven Mnuchin. Lawmakers think that they have enough votes to pass this. It's not going to get votes of everyone. Neither side is completely happy. And we're waiting to hear directly from President Trump, though lawmakers expect him to be on board since they've been negotiating with Secretary Mnuchin.
All right, Jessica Smith live in D.C. Thanks so much. Coming up here on The First Trade, a new king of the gridiron, what Drew Brees did last night for a place in the record books. Let's take a look at today's news bites. At least 3 people are dead after a powerful storm front swept across the Deep South. Suspected tornadoes brought down trees and destroyed homes. Children are among the injured, which one official in Alabama said brought total chaos. The National Weather Service says the severe weather threat could last through the day in Louisiana, Mississippi, Alabama, and Texas. The House Rules Committee is meeting this morning to set the terms for tomorrow's impeachment vote. They're expected to decide just how much time members will get to debate the articles of impeachment on the floor. A growing list of moderate Democrats have said they will vote yes, all but assuring the president will be impeached. Meantime, the Senate is set to give final approval to a $738 billion defense policy bill. The bill boosts pay for the military by more than 3% and creates the Space Force, while also guaranteeing paid family leave for federal workers. President Trump is expected to sign that measure when it reaches his desk. And the family behind Purdue Pharma got more than $10 billion from the company since 2008, just as the opioid crisis was heating up. The report by a Purdue advisor shows extensive dividends paid out to the Sackler family, as well as legal expenses and other benefits. The Sacklers have offered to give up control of the company as part of a plan to end lawsuits over the spread of opioids. And the NFL has a new touchdown king. New Orleans Saints quarterback Drew Brees broke Peyton Manning's career touchdown record last night with a 5-yard pass to tight end Josh Hill in the third quarter against the Indianapolis Colts. Brees now has 540 career touchdowns. He also made NFL history by completing 29 of his 30 passes as the Saints crushed the Colts 34-7. Congratulations to Brees. Well deserved. Coming up here on The First Trade, going public, a lot of disappointment for investors in companies like Lyft this year. Could 2020 be any better? Stay with us. It has been quite a year for companies going public. Just last week, Saudi Aramco officially hit the public markets in the biggest IPO of the year, climbing to a $2 trillion market cap on the highly restricted Tadawul exchange. But it's not been so great for a lot of others that launched here in the U.S., namely Lyft, Uber, Slack, Pinterest, and Zoom. Most are way off their listing price. Here to talk about the state of tech IPOs and what to expect in 2020 is Ryan Hinkle, Managing Director at Insight Partners. Great to see you, Ryan.
Thanks for having me.
As you look back and reflect on 2019, how would you categorize the IPO market this year?
Well, there's a difference between the IPOs that you just listed and like the rest of the, I'll call them more normal IPOs, where the bulk of the IPO activity is in the $1 to $5 billion range when you hit your first market cap. And a lot of the examples you showed were substantially higher than that. They dominate press, but the volume of IPOs is dominated by those smaller ones. And we've had a very robust IPO environment in 2019, much like 2018.
How big do you think the Airbnb IPO will be?
Hard to say, and that's still a conditional. A decision to go public is just a financing event. And I think that the mysticism of IPOs is often overstated. The big difference between being public and private is your every move is now visible to the world. And you have to be willing to expose that blueprint to the world. So how big or small the valuation is just a moment in time. But it's ironic, the higher you push your valuation at IPO, the worse that slide you just showed looks. The lower it is, the more interesting that slide looks. You have this weird pressure from the investors that are inside the stock for the highest value, but also the press wants the highest pop.
From what you know of Airbnb, could they be a successful public company?
I don't see why they couldn't be. They have a very substantial market share for the sharing of rooms, for lack of a better word. And there's no reasonably close alternative that can disrupt it. But the execution game remains most critical. It is not trivial to continue to execute the way they have executed. And so the execution will always dominate the size they can be, more so than that moment in time price.
There are some highly anticipated names, Airbnb being one of them. But now we're seeing reports that Palantir, Casper, Madewell may actually not go public next year. In fact, where there are reports that Palantir may wait 2-3 years to go public as they look to the private market, namely SoftBank, which needs a few good investments. Can you respond to that at all? Might we really see some of these big names still hold off, and why?
Well, let's state the obvious. Next year is an unusual year for market activity. Public market investors like certainty and stability. We have an election next year. The election introduces natural uncertainty. Don't know who the Democratic nominee is going to be, don't know the outcome of the election. And so it's in effect a shortened year. And if you need capital, like you're burning a lot of money, you need to raise capital, the decision to go public is in some ways irrevocable. Like you're there forever. And so private markets are extremely robust. You mentioned one investor. There's lots and lots of private sources of capital. So the decision to go public or not is really back to what we were talking about. Do I want to expose my blueprints and have the point of no return get passed and be out there for the world to see? There's plenty of private money. So there's no stigma in being public or private. It's really, what are you prepared to do as an operating team? And we certainly encourage companies at Insight to stay private as long as they want to. But the ones that are special, we certainly also encourage them to go public.
Do you think we'll see Palantir go public next year?
Hard to say. I think if they're not public in Q1, Q2, they're not going to go. That would be my prediction.
Why do you still like the software plays?
The software plays?
Yeah.
Software has this beautiful unit economic business model. The ability to attract customers when you can articulate a value proposition means your customer acquisition cost is reproducible and tends to be reasonably low. The recurring revenue of software, meaning I sell you something today and I still pay you again tomorrow and the next day and the next day, is a fantastic thing. And the marginal cost of delivery, the COGS in software, is very small. So when you mix low acquisition cost, high gross profit, high recurring revenue, you get the dual combination of high growth and high profit.
Are there any companies we need to keep an eye on for next year?
There's so many companies to keep an eye on for next year. I mean, I think if you look at even the Insight portfolio, there's a number of names in there that, whether public or not, we have a median growth rate in our companies that's like measured in tens of percents. Like 50% is a median growth rate. And we're just a tiny segment of the software world. So the volume of innovation and the volume of software company growth out there is enormous.
One more quick question. Are we going to see more direct listings? We saw Spotify do it. We saw Slack do it.
I think you'll see more. I think they're reserved for special companies. Both of those names you listed had household name appeal to them. If you're not a household name, I would not expect a direct listing. I think it's harder when no one knows the name. But those names, I mean, like you knew those names. No one had to teach you what those companies do. And so I still think that is reserved for a special subset of companies that have mass understanding and appeal.
Calm's in your portfolio, right?
It is.
I use it.
Good, thank you.
We'll leave it there. It keeps me relaxed. It keeps me in the zone.
Stay chill.
All right, Ryan Hinkle, good to see you.
Thank you so much.
Appreciate it. We'll dive into these red hot markets next here on The First Trade. But first, here's a look at the action in overseas markets. And we'll be right back.
Welcome back to the first trade. We're about 5 minutes away from the opening bell. Stock futures not seeing a lot of action here this morning. Dow futures and the Nasdaq each up about 9. We've got the S&P up just 3 points. Let's go around the bell with Alicia Levine, chief strategist at BNY Mellon, and Paul Schatz, president and CIO of Heritage Capital, along with Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Good Tuesday morning to you all. Alicia, I'm going to start with you. We're in the final weeks of 2019. What are you keeping your eye on here this week?
Look, we think the next 2 weeks are going to be a melt up into the end of the year. You're not going to see a reversal here at all. You've got less risk in the international system, in the international economy, so you're getting this melt up. The other really interesting thing is that earnings for next year, for 2020, are still hanging out there in the 9 to 10% range, very similar to where they were in early October, suggesting that companies are actually not guiding down for next year. So you could see something of an earnings surprise next year. We're pretty positive going into 2020.
Paul, where do you stand right now on Boeing? Obviously, a lot of negative news on Boeing right now, but it's still Boeing. College kids in their dorms are unlikely to create the next Boeing. So what are you inclined to do?
So let's say this. If you haven't sold it already, if you didn't sell it into the rallies off of the bad news, I'd have a hard time pulling the ripcord when what seems like the worst news is already out there. I mean, if you think about it, how much worse can it get? What's left for the MAX to be? Just could they cancel it? Sure. But if you haven't sold it already, I have a very tough time advising someone to sell it down here. I think you're going to close your eyes, swallow for a little while. If you want to sell it, you'll get a rally in the first quarter at some point. Be my guest, sell it. But I don't like selling from weakness. I like selling into strength.
You're nodding your head, Alicia. What are you in agreement here with Paul?
So I would agree with Paul here. I mean, the only thing I'd say is that you're going to have some tax loss selling probably to the end of the year on Boeing. But look, this is about the worst news you're going to get. And so therefore, the stock will probably overreact a little bit, but you're probably close to a bottom here in the stock.
Maybe the worst news you get is that they cut their dividend, which they didn't do.
Right. Right.
Do you think this impacts U.S. growth in the first half of next year?
Look, the way we model U.S. growth, for sure it affects U.S. growth. And I've seen estimates from 0.4% to 0.6% in the first quarter alone, annualized. It's a big hit, but it's a little bit like what happened during the shutdown, which it looked like a big hit, but you eventually make it back when you bring production back online. So whatever the top line number is, it's not a permanent cut to GDP. It's a noisy little trough.
I want to jump off what you said, Alicia, about earnings, and Paul, ask you. It doesn't seem like companies are guiding down for at least Q1. What's your outlook for earnings next year?
I wish they were guiding down later in the fourth quarter. It would have made it easier for an upside surprise in Q1. I don't think Q1 is going to be as bad as what people have talked about, but I also don't think it's going to be a rip-roaring, rip-your-face-off earnings season. I think it'll be somewhat of a quiet earnings season. I do have some concerns on the shorter term that maybe we build some kind of January peak, and I wouldn't be shocked, but I don't think it's going to be an earnings problem that befalls the market in Q1.
Jared, over to you at the Wi-Fi Interactive Board.
Well, we got some green in Asia. We have the Hang Seng, the Shanghai Composite, and the Kospi in Korea, each up 1.25%. And some red in Europe. We have the DAX down about 0.5%, the CAC 40 down 0.21%. And in London, the FTSE's just down 13 basis points. Here in the U.S., pretty quiet. Dow is just barely up 1 basis point. S&P 500 is up about 8 basis points here. Here's the overnight price action. We can see we're bumping up against 3,200, and this is kind of the time of year when it's like watching paint dry some of these days. But seasonality definitely favors the bulls through the end of the year and also into January as well, where we have about 1/3 of the annual repositioning due. Interesting that, Paul, you mentioned the January peak. That's a potential here, but not expecting anything big until then.
All right, here we have a new trading day getting underway at the New York Stock Exchange and the NASDAQ. Caterpillar doing the honors over at the NYSE and NASDAQ has Procure ETFs. All right, the Dow Jones Industrial Average starting the day down about 6 points. In your notes, Alicia, you noted that Europe and EM is going to outperform the U.S. over the next few months.
Yes.
Why is that? Why
yes,
do you think that?
this feels like a shocking thing to say.
A little bit. When I read it, I went, really?
Yes, because look, the thing is, if you look at the forward PE from the last 10 years, where EM is compared to the U.S. and where Europe is compared to the U.S., they're trading at the lowest end of the range in the last 10 years. And it's in part because EM and Europe have been victims of the trade war and of the global growth slowdown. So what do we see for next year? We see a stabilization of growth. China's printing some interesting numbers, bringing estimates of GDP a couple of points higher for next year. And also, if there's any improvement in the trade situation with China, Europe is going to directly benefit. So you have underpriced markets, you have deeply valued markets that investors have been fleeing from. And when the second derivative goes positive, that's when you go into those markets. And that's why we think Europe's interesting and emerging markets as well.
Paul, do you agree with that?
Interesting point on EM. I believe that the VIX on the EM hit an all-time low yesterday. You've had the least amount of volatility in the emerging market space of all time. So even if I said I don't agree with Alicia, I think she's wrong, which I do somewhat agree with her, but you wouldn't just go from all-time low volatility to EM going down 20%. It's going to take some time. I think EM, especially the EEM ETF, I think it's going to break out. You could get easily a 10 or 15% run early in the new year. And look, Europe has underperformed our markets year after year after year. And even though I don't think the long-term trend has changed, I do agree with Alicia that at least there's a short-term, whatever you want to assign it, you want to call it a tactical trade, be my guest, but certainly on a risk-reward basis, something like VGK or EFA, those two ETFs versus the S&P have nice risk-reward ratios. Add on a little bit of EEM, and I think you could have a good pop in the new year.
But what about, neither one of you mentioned Brexit. What are the effects of Brexit on the UK market? Do you touch that? What's your outlook in 2020?
We've been very positive on the UK market. Our chief economist, Shamik Dar, spent years modeling Brexit in the Foreign Office. So we have a very good sense of what we think a hard Brexit looks like for the UK economy and a negotiated Brexit. Both situations are pretty good for the UK economy, in part because of the getting rid of the uncertainty, which will then encourage more investment. What really has killed the UK economy in the last year is the market decline in investment as Brexit was pushed out. So the deadline kept on moving, and you couldn't bring this thing to a close. Even a harder Brexit, which we have in the headlines today, would not be such a disaster for the UK economy. And flows have been only outward for the last 3 years.
Yeah. Paul, over to you. FedEx out with earnings later on today. It's been a dog of a year for FedEx. They're still having problems with Amazon. What's the trade there?
I don't think it's just FedEx. I think it's the whole transport complex. The transports have been on my list all quarter as at some point they're going to play catch up. They have not broken out yet. They're still in that trading range with which everything else was in for months and months and months. I do think before this market puts in a peak, a tradable peak, you're going to get an upside move in the transport complex. So if that's the case, you would think that FedEx doesn't have to have super stellar, terrific earnings. But if my thesis plays out, it would really prevent FedEx from falling flat on its face yet again. But I do think there is an opportunity for the laggard transports to kick it into high gear. And whether FedEx and UPS can contribute, we'll see shortly. But I don't think they're going to fall flat on their face if I'm going to be right.
And Jared, you have a closer look at the Dow transports, and I see a lot of green.
Yeah, this is quarter to date, just fitting in with the conversation. So we can see the railroad stock, KSU, is up about 19%. If we're looking at FedEx, it's up 15% here, followed by some of the airlines. JetBlue up 14%. And while the Dow transports, they haven't been able to break through that ceiling yet, a lot of these stocks have been able to take advantage of the sector and factor rotation as the 10-year T-note yield rises. Now, today it's off about a couple basis points, so we're not necessarily seeing that. We do see a lot of green here for today. FedEx has got something to prove after the bell, of course.
Alicia, big run in the markets this year, obviously. Do you think we see a pretty sizable consumer spending boom later next year?
We should. And we should because U.S. households are more exposed to equities than they have been since the late 90s and the late 60s. There is a direct wealth effect in U.S. households and consumption. We saw it in the fourth quarter of last year where consumption just dove with the S&P. So there should be some direct correlation to consumer spending. The consumer in the end is still holding up the U.S. economy and in some ways the global economy. So that should be good going forward. And I'll just say to the point earlier, transports are definitely the cyclicals that you're looking at to come back. Also energy, the most hated sector of the S&P went from being 8% of the S&P to 4% of the S&P because of underperformance. If you're looking to get some kind of exposure to cyclicals, energy is the place to go.
Yep. Is 2020 going to be the year energy shines, Paul Schatz?
Well, let me say this. I do think this late in the cycle, we are many of us are waiting for energy to have that final day in the sun. It certainly has that feel. I'm hoping that when everyone's picks come out for 2020, it's not littered with energy, as has been the case over the last couple of years. But certainly at this point, they're beaten down. Look at ExxonMobil, you've got a 5% dividend yield. So it's pretty hard not to at least take a somewhat positive view of stocks like that. And getting back to a point we just mentioned on cyclicals and the consumer discretionary looks absolutely beautiful here. So a lot of those companies, you got to take a look at those coming into the new year. The XLY looks all what you would say coiled up and like a spring that should pop into the new year. So you've got a lot of opportunities here as we come in. Very different than 12 months ago, I'll tell you that.
Jared, over to you.
Yeah, well, we're just talking about the consumer discretionary sector here. Here's the XLY ETF, and we can see it's just bumping up against 2019 highs, and it has definitely been consolidating here and coiled for a move. Looking at some of the sectors that are leading today, we have energy, consumer discretionary, financials, all outperforming along with materials. Let's do quarter to date and see what's been really working this quarter. Healthcare might be a surprise here that it's number one, up 14%, followed by tech, 13%, and financials, 13%. Financials just reached a record high yesterday, or maybe the day before, but they've been kind of one of those stealth factors that has really participated over the last few months.
We had a guest on earlier, Alicia, talking about IPOs. You think 2020 is going to be a good year for new listings coming to market?
I think so, because I think the risk of what's going on in the Democratic Party and some of the economic plans hangs out there over markets. And I think with M&A and IPOs also, there'll be some rush on the calendar to raise some capital here before the election.
Early in the year.
Yeah, look, there's definitely a volatility trade in here somewhere. My guess is somewhere between February and April, there's a volatility trade, depending on what happens to the primaries. I mean, different candidates have different levels of friendliness to capital and investing. We'll just leave it at that.
Yeah, you can say that.
Okay, so there's going to be a volatility trade in here somewhere. And if I were considering M&A or an IPO, this would be the year to do it, because you just don't know what the calendar brings going forward in November.
Mm-hmm.
Paul, final word to you. What's your top trade for 2020?
Wow. The year hasn't even ended yet. So
it's already over. It's been over for 6 months, Paul.
I haven't given it enough thought, but I do know that what we're loaded up with now, we've got semis and financials and obviously a lot of other sectors. Those are our two top ones. I will not feel the same way about the winners come in 2020. And key point here, to what Alicia said, I think companies will be rushing to have M&A and have IPOs. I hope she's wrong, not because I want her to be wrong, but because that will not be good for the bull market. That will worry me even more. 2019 is going to go down as the most IPOs on a dollar basis with companies that were losing money. That's not exactly the warm and fuzzy. It's not the dot-com bubble, but it certainly doesn't engender good feelings going forward when all these companies losing money are coming public and the public's buying them up. So I would say M&A probably increases, more IPOs. I am praying that they actually make some money instead of throwing dogs to the public.
All right, well, in the meantime, enjoy the market melt-up, folks. Alicia Levine, Paul Schatz, Jared Blickery, thank you.
Thanks, guys. Happy holidays.
Coming up here on The First Trade, get ready to pay more for that morning cup of joe. We'll look into why coffee futures are surging and what it means for your caffeine fix. Let's get back down to Scott Gamm over at the New York Stock Exchange. Scott?
Yeah, a couple tickers to highlight right now. Bed Bath & Beyond shares getting a little bit of a boost right now after the company says that 6 executives will be departing in the next few weeks as part of a new plan from the new CEO, Mark Tritton, who was named CEO back in October. Now, the stock is up a nice 34% so far this year, but it's still down over 60% over the past 3 years. And then as we've got stocks at record highs right now, I want to bring your attention to Apple shares. The stock right now is up slightly, but the important part is that the stock is above that $280 level. That's an important level to watch. Remember, yesterday it crossed above 280 but failed to close above 280. So if Apple can close above 280 today, that would be a significant development, not just for the stock, but for the broader market as well. And then finally, Roku shares, we're watching those as well after the company announced that the CFO will be stepping down, but of course he'll stay on until a successor is named. It's been quite a year for Roku, with the stock up over 350% in 2019, guys.
Not too shabby. All right, Scott Gamm down at the Stock Exchange, thank you. We've got easing tensions in the U.S.-China trade war, and that is keeping oil near $60 a barrel today. Yahoo Finance's Jared Blickery is at the Wi-Fi Interactive board with our commodities report. So what's the latest on oil?
Well, we don't have a lot of news driving it right now, just the general optimism that we have so many headwinds behind us. A lot happened last week, as we know. Price of crude is holding above 60, as you said, and we could take a look at the overnight price action. Got a little bit of a dip into 4 a.m., but has been rising steadily since then. And let's take a look at the 3-month chart in the candlestick basis, and we can see there's really a nice trend that we've been tracking here. We are kind of clinging to the upper end here. We would call this the wall of worry if we were talking about stocks. But to the downside, if we have any kind of retracement, I would expect 55, 56 to hold right in here. And so we'll have to see what moves crude oil this week. We're going to get the API number after the bell, and then the weekly DOE report tomorrow at 10:30. Anything else that comes up, we'll be ready.
Jared, I'm getting worried about the price for my coffee very soon.
Yeah, coffee futures just had their biggest one-day jump in quite a while. We can see it right here. And it has to do with the growing situation in Brazil, and also the fact that the real strengthened about 1% versus $1, and that's a pretty big amount. So suppliers are kind of holding on to their supply, and they also have an on-off growing season. So they'll basically plant 1 year and then take the next year off. So we had a pretty big surplus, and we're coming off of that from the prior year. But then in the current year, there simply wasn't as much planting. And so, yeah, you might have higher coffee prices here.
Yeah, might have to start making this stuff at home like I used to do as a kid. All right, Jared Blickery, thank you. Stocks are hitting record highs as the year comes to a close, leaving investors very optimistic about what's to come in 2020. But is the optimism warranted? Joining us now to discuss is Aon chief economist Tapan Datta. Tapan, good to see you here. Is this market too optimistic?
Well, I think it is. I think there is a sense of getting carried away with the fact that the risks are down from the summer, but the issue is that it is pretty flimsy basis for mounting a sustained rally as far as we see it.
Do you think that there is still a high level of uncertainty for investors? I mean, we seem to have a phase 1 trade deal hopefully about to be signed. Does that help with the cloud of uncertainty swirling around this market?
Well, look, I think that's clearly better that we've got that than not. And compared with a few months ago, things are better because the trade conflict looked like it was escalating right out of control. You know, 2 years ago, the average U.S. tariff on Chinese goods was like 3%. And if all else had continued in the way it looked through the summer, we would have been well over 21% by this time, in less than 2 years. And now we've got something that's a bit more moderated. But the problem is that the direction of travel on the trade stuff is still wrong, because the underlying reasons for the trade conflict and the broader economic conflict have not disappeared. And what we've got is a very partial deal. And China may not be able to deliver the commitments that it's made anyhow. So the trade stuff in itself doesn't look to me to be an adequate basis for really being bullish on this market looking ahead.
Do you think investors should trust the Federal Reserve in 2020? It's hard to believe that the Fed will completely stand pat for the entire year.
Well, I think the Fed is really playing it by ear. And it is very mindful of the fact that the underlying trade conflict is still very much with us. And it is concerned that the slowdown that's happened right the way through the global economy. Yes, the U.S. is growing, is the best of in a kind of bad neighborhood kind of thing. But the issue is that the global economy has slowed very, very markedly. And the Fed is worried that that will feed through and spill over onto the U.S. And frankly, if you look at the trade and manufacturing data that's coming out, even the U.S., it doesn't look that great. So the risks are really, as I say, they're less kind of in your face than they were a few months ago, but they certainly have not gone away. In a few months' time, all of this could just come back to bite us again. And that's the reason for saying, let's be a little bit careful around really chasing this rally.
Tapan, I'm sure you've been following the Boeing news. There is now word that perhaps what's happening at Boeing, the pullback in production or the halting of production of the MAX jet, can actually dent GDP growth. What is your outlook for growth next year? What do you, to your mind, see as the biggest challenge to U.S. growth?
Well, look, the biggest challenge is that the trade and manufacturing side stays weak, and we get some sort of rollover in what has been a pretty buoyant job market, isn't it? But at the margin, if you look at the employment stats, you will see that the pace of growth is slowing. Now, so far, the slowdown isn't anything to get really worked up about, but that's the thing to watch, whether the labor market starts to weaken in response to these drags that we see in the external part of the U.S. Economy. If that spills over onto the consumer, we're in trouble. I mean, I don't think the risks are immediate. It's more of a second half 2020 risk that we're talking about, that this kind of feel-good factor that we're enjoying for the moment as these risks diminish, that doesn't last. That is my big concern out there.
All right, we're going to leave it there. Tapan Datta, thanks so much for being with us today.
No worries. Thank you.
Next up on the first trade, a big shakeup at struggling Bed Bath & Beyond, while the new CEO is swinging his axe.
And here's another quick check of the markets for you. The Dow Jones Industrial Average is up about 25 points. The broader market right now is mixed. We've got the NASDAQ Composite lower by about 4 points. The S&P 500, though, hanging on with just a slight gain. We'll be right back. Time for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. Billionaire investor and Facebook board member Peter Thiel is reportedly at the root of an internal divide at the company. The Wall Street Journal says Thiel has been advising CEO Mark Zuckerberg to not change Facebook's political ad policy. That's reportedly leading to a divide within Facebook senior leadership. And a C-suite shakeup to tell you about it. Bed Bath & Beyond. The company announced a wide restructuring and the departure of 6 senior execs, including its chief marketing officer, chief legal officer, and chief brand officer. The new president and CEO, Mark Triton, has been focusing on transforming the brand and delivering a better customer experience. Unilever is facing backlash today after the company said it would miss its sales target for the year. The company has seen slow growth in North America, its biggest market, making times difficult for its CEO less than a year into the job. They blame difficulties in a wide variety of big markets for the disappointment. And the boards of Fiat Chrysler and Peugeot are reportedly holding separate meetings today to discuss their impending merger. Reuters says the two companies could announce a binding agreement as soon as tomorrow. The deal, first announced in October, would create the world's 4th largest automaker. And Netflix is sharing some new data. The streaming platform revealed it has 158.3 million members globally. In Europe, the Middle East, and Africa, it said it has 47.4 million subscribers. That's a 140% jump from March of 2017. Latin America's subscriber base nearly doubled, and the Asia-Pacific region has more than tripled since March of 2017. Netflix is urging Wall Street to focus on its overseas numbers as it faces a slowdown here in the U.S. Still to come, are they employees or contractors? Uber gets a mixed ruling from a judge in a legal battle that could change the employment status for millions of drivers.
A big legal victory with a catch for Uber. Federal judge declined to order Uber to reclassify its drivers as employees in California, but he also declined to throw out the suit. Tech editor Dan Halley is in our newsroom with the details. Dan?
Yeah, so this lawsuit essentially is basically going ahead and saying that Uber drivers need to be treated as full-time employees, not only because they're being cheated out of benefits that full-time employees would get, but also because Uber's practice is cheating the state out of getting things like Social Security payments and unemployment insurance that it would need from Uber if they were using full-time employees. Now, the reason why the judge kind of threw this out was basically saying if Uber complied right away with AB 5, the California law that basically put a clamp on the gig economy out there, he would kind of be hurting the drivers because there aren't many that would be able to fit the description of full-time employees because they had signed different pieces of paper saying they wouldn't underneath Uber's guidelines. It also, though, doesn't mean that Uber is in the clear. Basically, what he's saying is putting a delay on this so that they can move forward with the lawsuit eventually and kind of figure things out from there. But obviously, it's good and bad for Uber. I wouldn't call it a win, though the company's probably going to paint it as such.
All right, what about the bigger picture here, Dan? How is this going to impact the fight over pay and benefits for gig economy workers in general?
I think Uber is going to go full bore. They've obviously said that they're going to use as many lawyers as they can to fight having their employees classified as full-time employees. They're fighting it everywhere that there's some kind of legislation. In New York, where they were making them pay their drivers more, they tried to fight that. They lost, though, but they claimed that it was going to hurt sales and rides. It didn't do that. But they see this in California, and they obviously want to fight it anywhere where they're going to try to drivers are going to be tried to be classified as full-time employees. Uber will be there with an army of lawyers to try to stop it.
All right, Dan Howley up in the newsroom. Thanks for that one. And that will do it for the first trade for this Tuesday morning. I'm Alexis Christoforous.
And I'm Brian Sazi. Enjoy this market melt up, but remember, nothing lasts forever. Now let's get one more check of the markets with Scott Gamm down at the New York Stock Exchange. Scott?
Hey there, guys. Well, keeping an eye once again on shares of PG&E, the stock trying to rebound from yesterday's big loss, and it's up significantly right now. There was a story in Bloomberg saying that the company has revised its settlement plan with the victims of those wildfires so that the governor of California doesn't have to sign off on the plan. Remember, yesterday we told you that the governor was not fond of the plan. And then also keeping an eye on shares of Bed Bath & Beyond after the company says that 6 executives will be departing in the next few weeks. This is part of a new plan from the new CEO, Mark Tritton, who started a few months ago. Bed Bath & Beyond shares are up about 34% so far this year. And then another executive change to tell you about, this time at Roku. The CFO is stepping down but will remain at the company until a successor is named. Roku shares are up 350% so far this year. And that's going to do it for us on the first trade. Thanks for watching. Wi-Fi AM is coming up right after the break. Stay with us.
Good morning. Welcome to Wi-Fi AM here at Yahoo Finance. I'm Dan Roberts. We've got Kristen Myers and Anjali Khemlani here on the couches. All right, it's a mixed picture right now in markets after yesterday we saw record highs across the board. Right now the Dow is in the green, but the NASDAQ not so, and the S&P is basically flat. But we have to start the day talking about Boeing. Boeing is waving a white flag of sorts. Boeing now plans to suspend production of new 737 MAX planes in January. That's after the FAA announced its review of the aircraft will continue into the new year. So new developments with this endless 737 MAX crisis, and Yahoo Finance's Alexis Keenan has been all over it. Hi, Alexis.
Good morning.
So what's going to happen here? What will this mean for Boeing? I mean, there are obviously 737 MAX planes that already have been made and are sitting unused.
Yes.
Will those go up in the air at some point?
So here are the numbers. If we look at all of the grounded 737 MAX aircraft, it looks like this. There are about 770, almost 800 aircraft that are currently grounded. Of those, there are about, let's say, I've lost my numbers. 370 of those are delivered to airline customers. Another 400 are on the ground, off the manufacturing line, never been delivered. So a lot of inventory piling up. That's why this stop down of the line is taking place. It's going to begin in January. Right now, Boeing is saying that that is due to the certification knowledge that it will be extending now into 2020, that it won't happen this year as they planned. They say that the 12,000 employees that work at the Renton factory where the 737 MAX is produced will not be laid off. They're saying no layoffs as of now. They'll either continue to work on 737 MAX related work, or they'll be relocated to other facilities that Boeing is operating. So that's where Boeing stands right now, but they're attributing this to that certification extension, the uncertainty surrounding what the FAA will do and when they'll do it. And Boeing said that the reduced output enables prioritization of stored aircraft delivery. So they want to get those planes into the hands of the customers and put that matter first.
So this is obviously, this is the impact on Boeing, but what's the impact on the other airlines that actually fly those planes? Is there any cost associated with that? I know Southwest, a couple of airlines had come out and said, Boeing, we actually want you to pay us because we can't fly.
Many of the airlines want compensation, and rightfully so, right? They want their contracts that are now not being fulfilled because they're not receiving those planes. They want compensation, and Boeing is working with each and every customer. It's not only airlines, it's also leasing companies that lease the planes to the airlines. They all want some form of compensation. Boeing has repeatedly said they're working on a case-by-case basis on those. If we look at just the MAX-related production charges that Boeing has taken through the third quarter, it looks like this. There are $3.6 billion in increased production costs. Also, the company has set aside $6.1 billion in customer concessions there. So the numbers piling up here, though Boeing's board in making this decision has obviously done a risk assessment, thinking that halting the line altogether is a bigger cash flow savings than it would be if they were to just do another slowdown. As they did in April, they went from 52 to 42 aircraft. And Boeing at that time had said eventually in 2020, we're going to ramp up all the way to 57 aircraft of these 737 per month. That's, of course, not happening.
What are customer concessions in this case?
So we don't know. I've asked Boeing, many reporters have asked Boeing, but certainly when you don't...
pile for lawsuits, maybe?
Yeah, lawsuits, breach of contract claims, and everything between. You have, the Southwest Pilots Airlines Association. They brought a lawsuit, as did some of the crew, saying that we're not getting as much work as we thought we would. Our hours have been cut because this plane is not up in the air. Also, now you have the airlines moving their service dates. Most recently, we just heard from Southwest Airlines this morning, pushing their service of the 737 MAX all the way to April 13th. So they're being the most conservative there. Then American Airlines just adjusted to April 20th, or rather, so American is being more conservative, I suppose. And then United Airlines still sitting there at March 4th. They haven't made a recent move in their date when they anticipate these planes to be back in, in their repertoire.
So, well, no, I was just wondering, so Kevin McAllister was put on the chopping block, right? Head of the commercial aspect of Boeing. But are we not yet at a point where we say Dennis Muhlenberg needs to step down? I feel like every time Boeing comes out and gives us a deadline.
The CEO and chairman roles,
right, but that's like exactly, that's a slap on the wrist.
There have been compensation considerations. A lot of people questioning whether Muhlenberg should either have reduced compensation or no compensation during the time that this is all being sorted out. And certainly there have been plenty of calls from Congress members saying, should you be responsible for these two catastrophes by stepping down? That he's been called into question many times whether, his tenure should come to an end.
All right, we'll keep watching. That is a big development. Thanks, Alexis.
You're welcome.
Congress is racing to pass a $1.4 trillion spending deal before government funding runs out on Saturday to avoid a shutdown. It will have implications on everything from taxes to tobacco. Will it get done in time? Jess Smith is in D.C. and watching closely. She can tell us more. Hi, Jess.
Hey, White House advisor Kellyanne Conway just told reporters in the past half an hour or so that the president does plan on signing this legislation if it makes it through the House and Senate. Now, this is a massive spending package. Lawmakers have been negotiating this for quite some time, and they released the legislation last night. It's more than 2,000 pages long, and I want to show you some of the key provisions that are in this $1.4 trillion spending deal. First, it gives federal workers a 3.1% raise. It also gives $1.375 billion for the president's border wall. That is more than Democrats wanted to give, but it is less than what the president had originally wanted. It repeals some taxes that are designed to support the Affordable Care Act, but those taxes have been pretty unpopular with both parties. It also reauthorizes the Ex-Im Bank, and then in a big win for Democratic lawmakers, it allocates $25 million for gun violence research. It also has a $425 million for election security. And finally, two more big bipartisan issues here. It raises the tobacco age. That's cigarettes, e-cigs, vaping products. It raises that age from 18 to 21. And then it also includes the Secure Act, which is legislation that is designed to help Americans save more for retirement. So a lot of stuff in this spending deal. And the House is set to vote on these two bills today, and then the Senate will follow shortly after. And as we've just learned in the past hour or so, the president does plan on signing it. Dan.
Hey, Jess, what about the pushback on those taxes, right? The ACA related taxes. Have you seen anything in terms of possibly halting that?
No, I haven't. At this point, it seems like lawmakers are pretty set on what is included in this bill. The vote is later today. They are doing some debate on the House floor at this point, so we'll see what comes of that. But at this point, repealing those taxes is definitely in that legislation.
Hey, Jess, it's Kristen here. So normally I feel like the spending bills are really highly politicized, and this year it just seems like no one is really interested at all. I mean, what are you hearing down in D.C.? Is really the impeachment, the vote on the impeachment really overshadowing everything right now?
I mean, I think that you're seeing this effort to show that lawmakers can legislate and work on impeachment at the same time. We have a potential House vote on impeachment tomorrow. That's the plan at this point. And then you have USMCA on Thursday, the government funding today. So you kind of have those productive bookends around impeachment. So I think that's why you're seeing Democratic lawmakers really want to show that they can do more. They can do their regular job as they deal with impeachment as well. And no one wants to see the shutdown that we saw last year that lasted more than 30 days. So I think lawmakers on both sides of the aisle really want to avoid that because we are likely to have an impeachment trial in the Senate in January.
Right. All right. Jess Smith in D.C., thanks so much. We'll check in with you soon. And do note on your screen that markets have flipped into the green. The NASDAQ is now up. We will keep monitoring. And when we come back, it's knives out in Amazon versus FedEx. Welcome back to Wi-Fi AM at Yahoo Finance. Markets flipping around right now. NASDAQ barely in the green, the Dow in the green. Let's go down to the floor of the New York Stock Exchange and check in with Scott Gamm, who can tell us more. Hi, Scott.
Hey, Dan. Well, today's going to be one of those days where you're going to want to watch levels in two key stocks right now. Boeing, which is right now down, and it's trading at about $321 a share. The level to watch here is $320. Why? Because that was the low for Boeing stock back in mid-August, the low essentially since the most recent 737 MAX crash in March. But remember, in mid-August, we were worried not about Boeing, but about the inverted yield curve. So if Boeing right now dips below 320, that would be a significant development for the stock. By the way, with Boeing's declines right now, the stock is now slightly in the red for 2019. Another one to watch, Apple. The stock is up right now, just over $281 a share. The key level to watch here is $280. Why? Because yesterday Apple hit a record high. It fell below $280 a share right in the final moments of the trading session. So if it can close above that level today, that would be another big win for Apple, guys.
All right, Scott, thanks. We'll be watching Boeing and Apple. Appreciate the update. Well, Amazon has blocked third-party sellers from using FedEx for ground delivery shipping for Prime shipments. Amazon had already stopped using FedEx for its own deliveries in the U.S., but third-party sellers were still allowed to use FedEx. Now, Amazon sent a message to those kinds of sellers, who now, by the way, make up almost 50% of the items on Amazon. And Amazon said they could still use FedEx Express or FedEx Ground for standard orders, that is, not Prime orders. Now, this is the extension of a feud that started in August when FedEx announced that it would end its ground delivery contract with Amazon. And Amazon says the reason is poor performance recently by FedEx. Yowza. This is really maybe a huge problem for FedEx. I mean, these companies, FedEx, UPS, are already facing all kinds of problems. USPS, obviously, too. And there are people who think...
What's USPS?
Right, exactly. And there are those who think, although there is this sort of, there's that wholesome nostalgia. I just used the Postal Service recently. I thought they did a nice job.
I have
We need the Postal
Literally
Service.
no one.
But there are
feels
those
that
who
way.
think the inevitable next thing is Amazon just basically starts doing all this.
On their own.
They've already started on some levels.
On some levels, and they've been talking about it for some time. And I think it's really interesting how the story has changed from like Amazon saved mailing to now quite the opposite, where it's a problem.
I was surprised to see. I mean, I don't know. It just felt like Amazon's being the bully on the block. Like you guys aren't allowed to.
Surprise.
I know. I mean, yeah.
But the reason it can do that is because it's very good. It's efficient. I mean, usually there are not Amazon problems for customers.
And they have the customers. The customers keep coming back. That's why Target's chasing them. That's why Walmart's chasing them. Everyone is following this same strategy because it's working, and because despite all the problems we've talked about this, how there have been labor problems and the third-party contracts with the delivery drivers. No matter what problems they run into, Amazon is still leading the way and still has that market. It's still a market force, no matter what happens.
You wonder if FedEx can sustain its growth with just Walmart and just Target. I mean,
well, and Target now using Shipt increasingly.
Right, exactly.
With acquisition.
And if the problem is that FedEx is not getting, packages to the door on time, then all of these other retailers, as they try to chase Amazon for that next day shipping, are also going to stop using FedEx as well. I mean, what is their growth case in the United States if they're not delivering packages for all of those millions of retailers?
You know what would be really crazy is if one of them bought a stake or took over FedEx in some way. Like, what if Amazon is trying to bottom out FedEx and then just slip in, right?
I mean, that's not even a conspiracy theory. That's honestly something that could very possibly happen, especially because Amazon has frequently, they want to get more into shipping, but they don't have the logistics network as all of these traditional shippers.
It'd be a cheaper way to get into it.
Building it out fast. Yeah, if you can't build it, you buy it.
Buy it.
We'll see. Well, the family behind Purdue Pharma, the Sacklers, pulled more than $10 billion from the company since 2008, just as the opioid crisis was heating up. The report comes from an audit that is out today and shows extensive dividends paid out to the Sackler family, as well as legal expenses and other benefits. Now, the Sacklers have offered to give up control of the company as part of a plan to end the lawsuits over the spread of opioids. And just recently, some buildings on campuses that were named for the Sacklers, like at Tufts University in Massachusetts, have removed the Sackler name amid this ongoing scandal. Good thing we have Anjali here on the couches today. How bad is this for the Sacklers, or is this no surprise. We knew that this was how this family has used this company.
We did know. I think that the extent that they're putting out there, right, because the family is putting this out there, is to help, thwart the rumors of just how many billions, because there have been numbers, right, and ranging. And we know that the New York Attorney General is also really after them in terms of their finances. There have been a number of inquiries into all the financial institutions that work with them, so we're even waiting for the results of that. So in the meantime, I think this is sort of helping to quell that and figure out a straight path for that lawsuit.
And as you mentioned, this audit comes via an advisor for the family.
Yep.
So I guess they're trying to say, well, look, at least we're being transparent here.
Right.
It's sort of like a week ago here we were talking about Uber putting out its own safety report, and people said, oh my God, look how many sexual assaults, but it was Uber revealing its own data.
It's some sort of damage control, because right now they are the evil family that started Oxy, right? So
I feel like that just keeps getting more evil, though. I mean, if they're, yes, okay, great, they're transparent, they put this report out. But essentially what you're now seeing is that, I mean, you already knew that the family was making money, right, off the back of this crisis. But I mean, $10 billion, legal fees, taxes. I mean, and now that it seems as if they and Purdue might be able to get off scot-free with bankruptcy protection by not paying out as much to the families or to state governments as is wanted. I mean, because honestly, if all of these lawsuits had their way, they would have no money. No money at all after this.
That's true, and right now the agreement that they're looking at is $3 billion. So if everyone is talking about them pulling in $10 billion, they're going to try and increase based on that number for sure. Yeah.
Yeah, and look, the Purdue Pharma story is not over, as all of these companies, Purdue just one of them, still face more lawsuits, as I understand it, even after the big Ohio settlement.
I'm waiting for jail time. Like, we keep talking about civil lawsuits, and I keep waiting for, and we have heard like whispers of like the criminal lawsuits coming, but I am genuinely waiting for that headline that someone somewhere is going to jail, because it almost seems as if there's no way for this crisis to get as big as it did without someone knowing something along the way was amiss.
And they've already admitted previously some guilt, so yeah.
Yep. All right. The story's not going away. Coming up here on Wi-Fi AM, we will tell you what stocks are trending right now on yahoofinance.com.
And time for today's trending tickers. First one up, we have Roku. Roku shares falling over 1% today after its CFO, Steve Louden, announced plans to step down. However, he says that he will stay on and help find his replacement. Now, Louden has been at the streaming platform since 2015 and helped the company as it went public. Now, the stock is up over 300% this year. I know that's a huge amount, and now has a market cap of over 16 billion, 16.3
pretty good tenure for a CFO. I guess we won't see him on our Yahoo Finance Live shows anymore. But Roku has just been a fascination to me because Wall Street has loved it so much, and it doesn't make content. It's just the rails. It's just the device. Of course, now you can buy Roku-enabled TVs, so you don't even need the physical box anymore, the hardware. But Roku is just the host, which really has been very good for it. It doesn't have to worry about, if you're Amazon or if you're Netflix. Well, on Netflix, now Disney-owned channels are no longer running Netflix ads because Disney has Disney Plus, and that's a competitor. Roku is just the neutral party, the Switzerland in the middle that says, we'll host all of your content.
Right, and that was smart because all of these different content platforms, right, they didn't have the ability, they had the content, but they didn't have the ability to make the actual hardware. So when you consider Roku in the landscape, you have like Roku, you have the Fire Stick, and then you have like an Apple TV, and that's pretty much it.
I do wonder how this plays a role, though, if you're talking about in the future with, TVs building in a lot of these apps, right? They do come enabled on a lot of smart TVs. And Roku can catch up to whatever the latest one is. And as we have the streaming wars unfolding, we're going to see a little bit more of that. I just wonder how much of a role that plays, for Roku, whether or not they get kicked out of the equation in the future.
Well, exactly right. I mean, if TVs become enabled with the option to have all these apps on the TV,
and to upgrade,
maybe that hurts Roku and you don't need a Roku anymore. I also wonder if you'll see one of the big players either buy Roku. Roku for a while has been thought to be an acquisition target.
True.
Or it could make an exclusive deal with a TV manufacturer to have the TVs come only preloaded with their thing. What if Disney inks a deal with Samsung and
Exactly.
Samsung TVs come loaded with Disney Plus, but nothing else?
Right.
So I think it's probably more likely that Roku would get acquired instead of being pushed out because so far smart TVs have been around for a very long time and yet they've done a pretty terrible job of loading it with all of the apps that you want. And so you still exactly. So no one says, "Oh, I don't need exactly." No one says I don't need a Roku anymore because I've got it on my TV. Anyway, time for another trending ticker. Today we are looking at Bed Bath & Beyond. Shares are receiving a boost today, up over 4%. After news of leadership shakeups, the retailer announced a wide restructuring and a departure of 6 of its senior executives, including its chief marketing officer, chief legal officer, and chief brand officer. Now, the C-suite departures come ahead of the new president and CEO, Mark Tritton's plans for the company, which are set to be announced in 2020. Now, Tritton has been focusing on transforming the brand and delivering a better customer service experience, which is good for them because it is terrible so far.
Oh.
I mean, it's true, though. I mean, the stock is only up 29% of the year, so massively underperforming.
I mean, I've said it before, the actual product that Bed Bath & Beyond sells is actually really good, especially if you're, looking for not Walmart level stuff, right?
You mean their branded items or what you can get in their store?
Just what you can get in their store. The shopping experience in terms of the quality of products that you're getting is actually really good. It's just they have not been able to figure out, right, the whole shipping and reaching remote customers, which is why they have someone from Target now trying to, right,
you think the shopping experience?
No, I've heard this argument too, or at least I don't enjoy going. I don't think the experience is great, but there are you're right that there's a use case for Bed Bath & Beyond. There are things that you need there that I still can't think of a better, more obvious place. I guess you could say you could order it all online, but there's certain items that you still, at least I think of Bed Bath & Beyond, that you need to hold and touch and see in person before buying.
I don't disagree with that, but I think it is almost like a joke. It's been comical about how you step into a Bed Bath & Beyond store and it's like you're lost in a wormhole. Like you're like, oh, I just want towels, and you're like,
there's a lot going on.
Why am I passing curtains? I've got one towel here. There's towels in the Beyond section of the store. I mean, but it is a great point to bring.
Fear the Beyond.
Right, but it's a great thing to bring on someone from Target because Target famously, you go in for one item at Target, you never leave with one item from Target. You leave with like 100.
There's some nice organic discovery in Target. Bed Bath & Beyond, you want to get the items that are on your list and get the hell out.
Right. But they could benefit from organic discovery because, to your point, there are those things in the store you're like, oh, actually, I really need this.
Yeah, and really like it too. Yeah.
Soap dish. Hanging shower thing.
I'm big on the kitchen utensils. I have to see those.
Right. Yeah. Sponge on a stick. Scrubber thing. Those are the kind of.
Yeah, they always say thingamabob.
Sure.
It's toilet thingamabob.
That's why you go there.
You're like, yeah, I need this.
All right, coming up here on Wi-Fi AM, Bitcoin sinks to a 6-month low. What happened? We'll explain. Welcome back to Wi-Fi AM. Netflix is sharing some new data that shows how fast it is growing outside the U.S. The company revealed that it now has 158.3 million paying subscribers globally. Now, 47.7 million of them are in Europe, the Middle East, and Africa, the region often called EMEA. That's a 140% jump from March 2017. By the way, you can see that Netflix stock right now is up 3.5%. Now, Latin America's subscriber base nearly doubled, and Asia Pacific has more than tripled since March 2017. Netflix just putting these numbers out today, I imagine trying to quell the fears and concerns we're seeing from Wall Street about increasing competition and subscriber losses. And I've just written about this recently, you guys, about how Netflix kind of cherry picks. It releases no data, doesn't give any numbers, says no thanks, and then suddenly they release data when it suits them and when it makes them look good. They'll say, we're not going to share viewership numbers of the shows you're asking about, but we'll tell you that this original Adam Sandler dumb movie we put out was the second most watched movie on Netflix ever.
I hate that movie so
No,
much.
I actually suspect that if I watched it, I'd like it. I haven't seen it. I just think it's funny, and it proves my point perfectly, that Netflix can put anything on the Netflix home screen and recommend it to you, and a lot of people will say,
We'll watch it.
all right, I'll watch
100%.
that.
I actually searched for that movie, by the way, but I think you're right. The data from Netflix definitely should be approached with a healthy dose of skepticism. So one, the problem is, yes, they're shining a light on their overseas growth numbers.
Right, look
but
over here
Look over
instead.
here, exactly. What's behind the curtain over here? Well, it's the fact that in the United States, growth is slowing. They are facing stiff competition from Apple TV Plus, from Disney. They're facing stiff competition, and so now they're bundling the US numbers with Canada, which is going to give them a nice little boost and maybe quell some of those fears, because you're going to look at that headline number and go, oh, wait, actually, it's not that bad here at home. But it probably is, because they're hiding something.
This reminds me a little bit of Facebook, actually, because it's doing so much more overseas, and that's really a lot of where their branding is right now, and a lot of where, they've got a lot going on there. And back home, no one's using Facebook anymore, right?
Old people.
And yet the ad sales are up, up. But you're right. I mean, companies do this. Another example, Under Armour is doing much better overseas, growing big in China. So they say, look at our international numbers. But here on its home turf of the U.S., sales have been down 5 quarters in a row. It also reminds me of last season's NBA Finals.
Oh, yeah.
When the ratings in the U.S. were terrible, but the NBA was saying, but look at the ratings in Canada, because it was the Toronto Raptors. And it was record number of eyeballs in Canada. Of course, because the Raptors.
And just that one time, unless the Raptors are in it again, right? But to your point, Anjali, though, when it comes to at least like Facebook, right, their core business of like the social media platform, I mean, I think everyone's kind of like, well, we're going to leave that to the side.
yeah.
What we really want to use Facebook for, what we care about, is WhatsApp. It's Instagram, it's advertisements, it's everything else that they have going on. Netflix can't say that, though.
Right.
Netflix has one business and one business only, and they are struggling here at home to really compete with all of these other streaming providers. And that is a huge problem for them, especially as soon as those providers really start to go after them overseas. What is Netflix going to do? What are they going to shine a light on then?
Well, some of them might be able to compete in the same way. What they're doing really smartly is actually, aggregating all of that international content. I know among my friends who watch foreign films, they do see Netflix as, a really good source for that. So
I will just say about Facebook too, I know that in our world, it feels like no one in our peer group is really using it anymore, and I agree, but I also think we risk only seeing that bubble. I think quite a lot of people in the US and in the world
100%.
are still using Facebook as much as they ever did. I know it's hard for us to believe, but there's a reason the ad sales
That's
just keep
true.
going up,
I mean,
up, up.
younger people aren't using it anymore.
We'll put a pin in that one for now. A Pinterest in that. Bitcoin has dropped below $7,000 per coin. That is its lowest level since May, and the price of Bitcoin fell nearly 5% in just 7 minutes yesterday. All the biggest cryptocurrencies sold off as well, including Ether, XRP, Bitcoin Cash, Litecoin, and Binance Coin. All of those are down between 5 and 8% in the last 24 hours. So whenever this happens, people wonder, why? Well, this time, the continued damage from a pyramid scheme on the website Plus Token is being blamed, where fraudsters have been selling off stolen Bitcoins by the truckload. The website and tracking tool Chainalysis estimates that $185 million in stolen Bitcoins have already been dumped on Plus Token, and that more will still come and be sold off, so that might cause the price to fall even further. Now, 6 people tied to Plus Token were already arrested in Vanuatu and extradited headed to China, where Plus Token is based, for this alleged Ponzi scheme. So this is interesting, guys, because whenever Bitcoin falls big, regular people who might follow Bitcoin just passively say, well, why? What's happening today? And usually, I like to say, it's never just one thing. It's a lot of things. Maybe, there's been a China crackdown, there's been negative sentiment, whatever it is. But in this case, it looks like it's one thing, and it's the fallout from this scandal that there have been arrests as part of.
And it's usually been something regulatory or something that is an external factor.
Headwind.
Right. I think that it's interesting because this goes really against the whole argument for Bitcoin, right? People have been talking about how safe of a currency it is, and now you're seeing the critics sort of get their win in this news.
Well, it's very headline driven.
Sure.
But what people in this community always like to say when there's an issue like this, some kind of fraud, some kind of scandal, some kind of criminal activity, is they say, you know what? There's criminal activity involving the US dollar too. It's not the technology itself is agnostic.
No, of course there is, but criminal activity in the United States or anywhere for the US dollar doesn't mean my $1 is now worth 10 cents. I mean, that is the absolute difference between the two. If you've put all of your money into Bitcoin, or you're really looking at it as an
alternative, I hope no one has done that.
Well, but if you're looking at it as an alternative asset class, because there's a lot of young people that are like, forget the stock market, I'm investing in Bitcoin.
Or forget gold.
Right. Yeah. This is terrible news, especially if one big event, a Ponzi scheme, which Bitcoin is supposed to be, a little bit immune to in the first place, can really tank it. I mean, I don't want to say I'm not bullish on Bitcoin, but...
Why not? You can say that.
I mean, yeah, I guess I'm not bullish.
The big believers would say, just hodl.
I'm waiting for them to tweet at me angrily in like 5 minutes.
Right, exactly right. Okay, let's talk about Uber. Uber just got a big victory in federal court with a catch. A federal judge declined to order Uber to reclassify its drivers as employees in California, and Uber really didn't want to have to do that. But the judge also declined to throw out the suit entirely. Yahoo Finance's tech editor Dan Howley is here now and can tell us what's going to happen next. What is going to happen next?
A lot of stuff. I'll see you guys later. No, so basically, the judge did not throw the suit out. So it's not like a huge win for Uber. It's a win-ish for both sides, really. So he said essentially that immediately classifying these drivers as full-time employees would not make sense because they had signed arbitration basically saying that they can't. So it really wouldn't benefit that many drivers, and that's the fear that the judge really has. He also didn't throw out the suit because he basically says, look, AB5 kind of says that you guys are screwed at this point. They need to be classified as full-time employees, and so we're not going to throw it out. The attorneys are going to retry it or bring it back. And that's really going to be where this case goes. Now, this is something that Uber is going to continue to fight tooth and nail throughout the country. That's really what they're focused on. They're going to bring all of the lawyers that they can, all of the money they can to bear, because if they have to classify them as full-time employees, then it's really going to eat into their profits. And this is a company...
What profits?
Exactly. That has zero profits. They are losing money still, and there's predictions that maybe they'll be profitable in 2024. I heard 2024 on a GAAP basis.
I know Lyft is saying
huge
Q4 2021.
GAAP, non-GAAP?
Right. And speaking of Lyft, this has broader implications, right? There are other companies that are going to be hit with the very same rule and are watching this very closely, I imagine.
I think a lot of advocates for gig economy workers who've kind of said that these kinds of jobs are predatory. They don't allow people to gain as much income as they're originally advertised as. This is going to be a big issue going forward, and we're going to see other states have to deal with this as well. Obviously, New York has been dealing with it. California, because it's the home state for all of these companies, it's really a huge driving state, so Uber is really big there. I think that's going to continue to kind of explode across the board. And taxi groups, obviously, they're on board with this because they want to cut back on Uber and kind of fight back and say, look, we are full-time. We want you guys to have to deal with the same things we do. And on the flip side, the argument for Uber to have to classify employees, according to this suit, is they're also hurting the state because then Uber doesn't have to pay into the various taxes that they would have to pay into for having full-time employees. So it's a win-win for both, sorta.
Right. And Uber, of course, really eyeing profitability. Just yesterday, we were talking about the report that it might sell off its Uber Eats business in India.
Yeah.
So, man, I mean, after
Just
launching a
slice-
lot of new things right around the time of the IPO, it's already slimming down.
Yeah, I mean, they have to. They don't make money.
Right. All right, Hallie, thanks so much.
Thank you.
Coming up here on Wi-Fi AM, a telling new report about college graduates from the recruiting site Handshake.
All right, welcome back to Wi-Fi AM. I'm Scott Gamm on the floor of the New York Stock Exchange, joined now by Peter Tuchman. Okay, another day of record highs. Tell me something that we didn't know yesterday.
You know what? It's hard to know. Look, every day is a little bit different. I was sort of disappointed in the action yesterday, even though we did hit those record highs and we did have such sort of a bit of euphoria. The market sort of faded. So we got to question, is it running out of steam here? Are we just taking a pause in consolidation? Yes, we are hitting a new record high every day. But at this point, I almost feel a little bit jaded about it.
But I guess the good news is stocks are at least rising for a reason, whereas if you go back to January 2018, we just rose really for no reason during those first 3 weeks.
No, we were in deeply oversold mode at the end of last year.
Yeah, but 2018, January, remember those first 3 weeks?
Yes, but that we rose off of the, okay.
2
yeah.
years.
I'm a year different. You know, what's a year here and there. Anyway, yes, that's possible. But let's look. 3,200 right here. While we're on the tape here, the S&P's hitting 3,200. That has to be a record. The Dow in record territory. Every day seems to be a record. I think we're sort of up on a lack of bad news right now. People are trying to assimilate the China story. Phase one, what does it really mean? Is it the real deal? How many phases are there? You know, it is a big week. This is the Santa Claus rally, no question. Whether it's a little bit of a markup or what, we have a big week coming up here. So you've got an S&P and a Russell rebalance, right? So you've got funds that, you've got indexes that have to
rebalance and kind of rechange,
and that's a big deal. I've been looking at the numbers; they're quite large. The Russell is pretty big. When you have indexes that have moved so sizably in one direction or another, you're going to see volume come into the marketplace, right? We saw it yesterday. We closed out with over 1 billion shares yesterday.
Well, and also we normally see tax loss selling this time of year, where you would sell your losers, but a lot of people don't have losers in their portfolio.
Correct. Look, the market is up 20-something plus% on the S&P, on the Dow. I would hope everyone's 401k is looking more and more like a 501k than a 101k as it was last year, right? So it's a positive year. This green is good. You know, the consumer seems to be in good condition. These are formative days here, right? Coming to the end of the year to keep a good show in for 2019, coming into 2020 with all the potential anxiety around. The market, I always say this, and people always joke at me, but the market tells you what it thinks, right? There are people way smarter than us who are buying this valuation at this point.
Peter, got to go. Thank you, as
right.
always.
Good
really
luck.
appreciate it.
Beginning to look a lot like Christmas.
We'll have more on Wi-Fi AM coming up right after the break.
Welcome back to Wi-Fi AM. U.S. unemployment may be at historic lows, but new college graduates still feel a ton of financial pressure when they graduate and are looking for jobs. Many of them also graduate with a lot of debt. Handshake, a career site for college students, recently put out a study that shows that many students are inclined to just take the first job they're offered due to those financial pressures. Christine Cruz Vergara is Handshake's Vice President of Higher Education and joins us now from San Francisco. Hi, Christine.
Hi, good morning.
Good morning. So tell us about this report and a little bit of background here, how long you guys have been doing this and your methodology for the report. What's the biggest takeaway to you?
Sure, absolutely. So Handshake's been around for about 5 years. It's a new player in town and has been working with over 900 universities, 400,000 employers, and we're now at about 17 million students and alumni on the platform, really connecting them, helping them to access information, social capital, build those networks and connections, and then of course access opportunity. So in this study, we found that the majority of students still believe that their major selection, over 80%, believe that that is a huge determinant in what they're going to go on to do and in getting a job. However, only 50% of employers even bother to list major on their job postings. And so there's still a disconnect between what students think they need to have in order to be successful and what employers are actually looking for. More employers are leaning towards skills these days.
That's really interesting. It's Anjali here. I actually am one of those people who just jumped for the first job that came along, so I can definitely feel that pain there. But yeah. What is it that companies have to do to pivot in order to meet, close this gap?
Yeah, absolutely. I think employers need to continue to reiterate just how important certain skills are and to actually be vocal, quite frankly, in media. There's a social narrative that exists in our communities for families and for students, and it makes them feel this level of stress that's quite frankly unnecessary. Most employers are still looking for the skills such as strong communication, the ability to think critically, your ability to synthesize information, your ability to work on a team. And these are skills that we know many of our liberal arts and humanities students walk away with in spades. But that's not the social narrative that most of our communities and families actually know or believe. And so there's a lot of pressure on students to have to take that first job or to have to major in the right major when there really is no such thing.
So Christine, it's Kristen here. I'm wondering how the sentiment of recent grads has actually changed over time. I see what you're saying about recent grads now, but did graduates 10, 15, 20 years ago feel similarly?
Yeah, there's always been some level of stress. I think nowadays students are starting to see the effects of technology in literally every sector that they work in. And so with that, these soft skills, or what quite frankly I like to call success skills, they're really core to the separation between a great employee and a good employee and a great employee. And so I think there's honestly more emphasis now from employers around some of these skills. And so there's a differentiation for students in starting to focus on that. The major piece was a little bit larger, I would say even just 10 years ago. And employers are really starting to recognize how important skills can be and how major doesn't necessarily dictate that. So there has been a bit of a shift in the past 10 years, and I would predict that there's going to be more of a shift as we go into the next 5 to 10 years.
There's been a discussion for sure about, the value of higher degrees when you talk about master's or PhD. So is that playing a role right now in this report? Have you seen, the value of those drop as well?
We didn't, in this particular report, really look into the effects of graduate degrees. We were focusing on the undergraduate population, but I've worked in higher education for more than a decade now, and I can tell you that it ebbs and flows when it comes to those graduate degrees. When the recession hits, you see more students decide to go into graduate school. When the economy is strong, you see more choose to go into industry or immediately into a job upon graduation.
So Christine, how is the difference between on a gender scale, right? So you're saying that recent graduates want to jump for the newest job available. Is there a difference between men and women?
There is. So we learned in this particular study that women feel a little less secure than their male counterparts when they're thinking about the economy, they're a little bit more tentative and watching the potential recession that's going to impact their jobs. And so they're more likely to potentially take that first job that they get offered. Men, on the other hand, are a little bit more focused, and what our study showed us was that they feel a little bit more pressure to have a high-earning job and to have a position or a career that really shows growth. And so those are some of the differences that we were seeing between genders in this particular study.
All right, Christine Cruz Vergara of Handshake, thanks so much for joining us.
Thank you so much. Have a great day.
You too. Well, the World Economic Forum publishes its Global Gender Gap Index every year, tracking how long it will take to reach gender equality globally across numerous platforms and metrics. Joining us now to break down the report, Julia LaRoche, our good friend. Julia, what's up?
Well, guys, there's a few things to highlight here. This report is going back 14 years. They've been doing this since 2006. And this year they said that it will take 99.5 years to reach gender parity globally. That is across things like education, health, economic opportunity, politics. Kristen, you're just stunned at me saying that. Last year's report said it was 108 years. So the trajectory
so we've gained 9 years in a year.
Better, but it's a lifetime. And guess what? That is a timeline that Klaus Schwab, who is the founder of the World Economic Forum, says that we cannot afford to wait for. So the good news is getting slightly better. Still a lot of work to do. Now, look, we have more women who are entering office. That's always a plus globally. Still, the U.S. is actually lagging behind because we still haven't had that many women in ministerial positions. We still have not had a U.S. president that is a woman. One of the main drags on gender equality is economic opportunity. And that gap, that will take 257 years to close. Wow. And that is up from last year's 202 years to close.
We'll be long dead.
So this was obviously a global report, but how is the United States specifically doing in reference to this?
The U.S. is actually lagging behind. This year we were ranked 53rd. That is down 2 spots from where we were just a year ago, down from when we were ranked 49 2 years ago. And then when this report first came out, we were in the top single digits. And one of the issues, again, it is about the economic opportunity. We keep hearing this, close the gender pay gap. But guess what? We still look at the company boards in the U.S. for publicly traded companies. 21% of seats are held by women, yet we're half the population. We're also not getting promoted to senior level positions. The gender pay gap still has not been closed. And this is going to come down to leadership. Our CEOs, our companies willing to look under the hood. One of those companies was Salesforce. Mark Benioff, who's a trustee for the World Economic Forum, looked and in the last 3 years has spent $10 million closing the gap. And a lot of that has to do with acquisitions they brought in, closing the gender pay gap. So this comes down to leadership, and we really need some.
Well, that 99-year figure is so staggering. And yet, if we are currently improving at a rate of the figure coming down by 9 years every year, I mean, maybe if we can keep up the progress of the last year.
We can make that happen a lot faster if companies were willing to look under that hood.
Well, it's also legislation. The United States is one of the only countries in the Western world, actually, I think
the only OECD that doesn't
the only one that doesn't actually have pay parity as a part of it.
Paid parenting leave. We're the only one. It's crazy.
Certain states do, or are working on it. But
yeah, but as a country, yeah.
Yeah. Well, and I remember when the Sony hack was one of the early incidents that really exposed a major pay gap. Remember that? Two senior people at Sony Entertainment, one man, one woman, and the woman making much less. So that was the start, and we're going to still keep going and hope for more progress.
Push
Thanks,
for
Julia.
change.
Yep. Coming up here on Wi-Fi AM, we will talk to a cooking app owned by Samsung. Welcome back to Wi-Fi AM. The holidays are one of the busiest times of the year in kitchens, so the timing might be right for a new cooking app that is launching in the U.S. this week, Whisk. And joining us now from Birmingham in the UK is CEO Nick Holzer. Nick, thanks for joining us. Now, you guys have been up and running in the UK for a few years now, so why launch in the US at this time?
Thanks for having me. Good morning. So yeah, we're launching apps on Android and iOS, and essentially it allows users to save recipes from anywhere. What we're seeing is digital natives, so the new generations, are spending hours looking at recipe content. When you look at what they end up cooking, they end up around the world. They cook 7 to 9 recipes on repeat, which is boring, not necessarily as healthy as it could be. There's lots of things that can be improved in that process. So what we're doing to help users ultimately is we've created an app that where they can save recipes wherever they get inspired, whether that is on recipe websites, on TV, whether they share recipes in WhatsApp groups. They do it in all sorts of different places. They can save recipes into one recipe box, create a shopping list with one click, choose how many portions, seal the nutritional information, create shopping lists that they can collaborate on with members in their family, both in the creation of the list and the shopping of the list. And ultimately, what we're trying to do is help users be more successful in that journey, going from being inspired to eat something to actually being able to turn it into a meal in the kitchen.
Sounds pretty good, Nick. Now let me ask, what have you made of the rise and then in some cases the struggles recently of companies like Blue Apron, trying to ride the tide of young people cooking at home more, make it more convenient, and yet they really have faced a lot of struggles. The space got very crowded very quickly for these home delivery services and delivering ingredients for cooking at home.
Yeah, I think it still comes down to the same problem that users want variety. They're looking at all these different places for content, but they end up cooking the same stuff again and again. And I think one of the areas where maybe the meal kits in some cases didn't quite solve that was it was delivering a lot of the same meals again and again, or they didn't have that choice. They were kind of stacking up these recipe boxes in their fridges. I think that's one of the reasons also when you look at the restaurant delivery space, it's growing so fast because it gives users the ability to choose from so many different meals. And that's exactly the same problem in the recipe space. So you've got, people don't want to end up cooking these 7 to 9 recipes on repeat. They want to be able to act on all this amazing inspiration which is available on all these different websites, on Instagram, on YouTube, and shared within families in their personal recipe boxes.
Hey, Nick, Angela here. Two-part question really quickly. How has the user demographic changed since you launched in 2012? And then also, how are you solving the same problem? Because at the end of the day, you're aggregating the content. How do you hold, how do you hold these users accountable for even using them or using these recipes?
Yeah, totally. So I think what some people maybe don't realize is how big the grocery market actually is. It's an $11 trillion market. And it's one that's in transition. So what's happening is you've got a move to e-commerce. About 70% of people will be doing online grocery shopping by 2025. You've also got people collaborating much more on that grocery chore, where it used to be primarily something that one person in a household did. What we're now seeing, about 76% of households call themselves collaborative shoppers, where they're working together to create that list and to actually complete the purchase of it in store, and then to cook that meal when they're in the kitchen as a social experience, not just as kind of one person doing all the cooking for the whole family. So that actually requires kind of a fundamental new way of completing that whole recipe to meal on the table experience.
All right, Nick Holzer of Whisk, good luck with the launch. Thanks for joining us.
Thank you for having me.
We'll be back right here at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM. Well, it took 25 years, but Mariah Carey's holiday hit, All I Want for Christmas Is You.
I love that you had to sing
is
it.
now a #1 Billboard's Hot 100 hit for the first time. You guys pleased?
I think the 25 years, that's exactly the whole thing. What was it? Amazon brought it back, right?
Yes, Amazon is involved in this in a sense because Amazon has this new documentary out about her.
What a way to boost a brand equity. It's amazing.
I would give a lot of credit to Love Actually. I know that was old, but I think Love Actually really had a hand in making the song popular.
Okay.
Yeah. Yeah.
Your voice went up several octaves, which leads me to believe you don't actually believe that. The song was popular for such a long time. It's been the Christmas song.
Yep.
It's iconic.
But it was never #1, Kristen, until now. Thank you, Amazon mini doc series.
I mean, I think it was trending there. I mean, no one's thinking about Baby It's Cold Outside. No, it's Mariah Carey's
that got canceled.
All I Want for Christmas Is You.
That song got canceled. All right, thanks, guys. Good show. Thank you for watching Wi-Fi AM. We'll be right back here tomorrow, but don't miss On the Move. That show starts next in just 2 minutes, so stay right here.
It is 11 a.m. here in New York City, about 90 minutes into the trading day, and we've got stocks mixed right now. Not much change overall. Delivery pains. Amazon steps up its fight with FedEx ahead of the shipper's earnings after the bell today. The honeymoon is over. The pound slides as UK Prime Minister Boris Johnson faces a new Brexit headache. And C-suite exodus. The latest as top executives at 2 more companies head for the exits. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Boeing officially announced it will halt production of the 737 MAX. Scott Gamm is on the floor of the New York Stock Exchange with what kind of effect this is having on markets right now. Scott?
Hey there, Adam. Well, Boeing shares right now seem to be holding above $320 a share. The low this morning was at about $321. That $320 level is so important because the low for Boeing stock since the most recent 737 MAX crash back in March was $320 back in mid-August of this year. But in mid-August, we were worried not about Boeing, but about the inverted yield curve. And so the entire market, including Boeing, took a hit. So the point is right now, the stock has approached those low August levels because of a Boeing specific issue. So investors right now will be watching to see if Boeing can remain above that 320 level. By the way, earlier this morning, Boeing shares did turn into the red for 2019. They are back in the green for the year. A couple other stocks we're watching today. Goldman Sachs getting its price target raised by the analysts at Wells Fargo, Mike Mayo, to 280 from 240 a share. The stock right now is at about 230. Mike Mayo is bullish on the outlook for the company, especially 1 year into its new management team. And then finally, we're also keeping an eye on shares of Unilever, down about 7% after the company says that it won't meet its 2019 sales forecast amid some economic headwinds in South Asia. Guys.
Thanks, Scott. Appreciate it. Well, our top story today, delivery rivalry. Amazon has blocked third-party sellers from using FedEx for ground delivery shipping. In the latest battle between the two companies, the ban will start this week and last until FedEx's delivery performance improves, according to Amazon. I want to introduce this hour's panel to discuss Deutsche Bank Securities Chief Economist Torsten Slok and Yahoo Finance's Rick Newman. And Amazon, to the point of that quote, has said that it's concerned about FedEx's ability to get the packages there on time before the holidays. But this kind of speaks to the changing dynamics of this new delivery and shipping economy that is led by Amazon.
Well, and this has been a very important part and rising part of retail sales and a rising part of consumption. And given the consumer is doing relatively well at the moment, and given the shopping season is very important, it continues to be very critical that we continue to see strong numbers for the rest of the year. So this is a critical issue for what would the outlook be for the overall consumer for Q4.
But FedEx was separating itself from Amazon with the announcement several months ago. 58% of the third party of the stuff sold on Amazon now comes from third party dealers. So I mean, what kind of impact, if it's a minuscule amount, it's same day ground?
Yeah.
Is this really going to have, whether it be on the Christmas packages being sent or on FedEx?
Well, I think everything with Amazon is strategic, and Amazon. I think of Amazon as a logistics company. I mean, that is really what Amazon excels at more than being a retailer, and this is part of it. I mean, think about the turnaround here. I mean, FedEx was the premier shipping and delivery company in the world for several decades. I mean, I think it started in the 1970s. I mean, nobody did this better than FedEx. And now Amazon is coming in and saying, you're not doing it good enough. And the main thing here is the last mile delivery. It's getting it to the doorstep. Fed is really good at having the big hubs, global delivery by air. But Amazon is saying that, we, for our purposes, you need to excel at the very last thing. And that's because Amazon is now getting into this business. So Amazon is basically taking on FedEx.
Why isn't this a monopoly kind of situation? I mean, wouldn't FedEx challenge this, or even one day maybe UPS? Because Amazon's going to have 50 airplanes, and they're right there in Kentucky next to UPS.
Well, I can think of 4 big delivery services. So it's FedEx and UPS compete with each other. They have slightly different markets, but then the U.S. Postal Service is in there. And Amazon is now doing its own delivery. I mean, that's 4, so that's not monopoly. And then you have some smaller operators as well. That's pretty good competition for the foreseeable future.
FedEx, incidentally, is reporting its earnings after the close of trading today, so investors will be watching how it's been navigating the U.S.-China trade war, and also, I imagine they'll be asking about this Amazon situation on the call. On the trade war front, Torsten, what kind of ripple effects have we been seeing in the U.S. economy?
Well, a very important part of this, of course, is that a lot of the transportation from abroad, if you don't know what is the price of your good you get from abroad, if you don't know you can source from those countries, that's creating a lot of uncertainty, not only for consumers, but also for corporates that also use a lot of transportation services. And on the other hand, of course, for corporates who are then looking to sell abroad, if they don't know what the price is of the good, and if they don't know if they can sell those things abroad, the whole transportation sector has been relatively hard hit by the trade war. So the good news for them is that at least now it looks like some of the clouds have lifted a little bit from the trade war, so it looks somewhat better, but it is a very important part of the economy, what's going on in transportation.
But beware what you wish for when you talk about certainty, because they're getting some certainty in the UK. And Brexit chaos, British Prime Minister Boris Johnson is saying the UK will cut ties with the EU by the end of 2020, with or without a deal. We want to go to London, and Yahoo Finance's Edmund Heafy. This is having a negative impact on the English pound, isn't it?
Yes, it is, Adam. The pound is down by almost 1.3% the last time I checked, and had been down by as much as 1.4% earlier in the day. virtually erasing all of the gains it made in the wake of last week's emphatic election victory by Boris Johnson. And the reason it's down, as you said, is government sources have briefed practically every UK media outlet to say that Prime Minister Boris Johnson will this week publish legislation that would allow the UK to cut ties with the EU no matter what at the end of 2020. So the UK is due to leave the European Union on January 31st, but there will be an 11-month transition period after that runs up until December 31st. And the way things stand now, the UK could ask for an extension at that point if it is unable to negotiate a trade deal with the EU in time for that deadline. But what this legislation would do would prevent the UK, essentially make it illegal to seek that extension. And now this was a manifesto pledge of Boris Johnson, and he had signals that this would happen, but he's now looking to make it law. And what this does is it essentially creates a new cliff edge, no deal Brexit-like scenario in which if the UK hasn't reached another deal by the end of next year, then it will crash out of the bloc and fall back on World Trade Organization terms. And the reason the pound had gained in the wake of Boris Johnson's election win was because there was a new kind of added element of certainty to this whole process, and traders and investors and markets were confident that the UK would leave the European Union with some kind of deal. But analysts had warned that the idea that reaching a deal and leaving on January 31st was not the end of the story. And once that happens, you enter the transition period and you enter trade negotiations. And unless they reach a deal, we could be ending with a very tricky scenario around this time next year.
Again. All right, Edmund, thank you very much. Let's turn to the panel on this. Torsten, so interesting, the initial reaction to Boris Johnson's and the Conservatives' victory in the UK, and now this sort of snapping back to reality again. What do you think the outcome is of the Brexit situation?
Well, the first observation is that trade deals, if you go back in time and look at all major trade deals going back over the last several decades, normally take at least 4 years to negotiate. So if you think about all the details that go into negotiating a trade deal, including also for the US, it does end up as a much longer process than you think. So the issue here at the moment is that we're going through situations where the market is excited and then is less excited, and as the political process plays out, then we will exactly need to know what the details are, both on the US-China Phase 1 trade deal, which is not ready in the legal language yet, but also in the UK situation, where we also need to have some more clarity on exactly what is it that this is going to end up with.
Would it make sense for them just to revert back to when the UK was part of the common market? And is that even a possibility? Just like, let's go back to where we were prior to entrance, and then we'll negotiate from that. I don't know if that's legally possible, but it would...
I have no idea. I'm personally trying to boycott all Brexit news because it's been going on way too long. Do you have any idea? Can they go back to the
at least Boris Johnson has suggested that this was not what he was going for. So in that sense, the question is, well, what are we then going for? And that just makes it still at least somewhat unclear if this can get done in time.
Under the Common Market Treaty, or when they entered the Common Market, I think it was under Wilson, didn't they have... They had the autonomy and the independence that they've been clamoring, and we've now had twice the electorate in the UK say this is what we want, but they had the business ties and the trade ties.
So at this point, it still remains somewhat unclear exactly where it will be going and what the end deal will be looking like, which is why the language now needs to be agreed on and be negotiated. So in that sense, it could end up in some version of that. But as you know, the various scenarios will be Canadian, Norwegian, Swiss. What kind of solution exactly is it that we'll end up with? And it still remains at this point mainly an issue about, do we think that it can get done before the deadlines?
All right. For the historians out there, I'm not sure if it was Wilson or Heath, whoever it was, please let us know. I know you'll Twitter at us. Shakeups in the C-suite continue in 2019. Bed Bath & Beyond announced 6 executive members will depart in 2020, including the company's chief merchandising officer and chief marketing officer. Meanwhile, Roku announced the company's CFO, Steve Loudon, is going to step down. We want to turn to the panel, to start on this one. Bed Bath & Beyond, we knew something was going to be coming. They've been having trouble all year. But as far as Roku, they were actually being led to this eventual moment. This was expected.
Yeah, the new CEO came in November. I asked our retail expert, Brian Sazi, about it. He just did our Company of the Year profile on Target. The new CEO at Bed Bath & Beyond just came from Target in November. And I guess he's basically saying, you guys all suck. I mean, it's like, it's like kicking out the whole management team. But this is a company a retailer that is in desperate need of an overhaul. I mean, a very tired strategy. They probably need to downsize, get rid of some of their stores. The new CEO is an expert at merchandising. That's what he did for Target. So he made some of their in-store stuff cool again, including the Target branded stuff. So I guess that's the kind of transformation Bed Bath & Beyond needs at this point.
I mean, we keep being sort of surprised at all of these companies that have thrown out their executives this year. I'm looking at the Bed Bath & Beyond chart. It's sort of unchanged over the last year, but it's fallen 78% over the past 5 years. So its performance has been dismal, to say the least. Torsten, in this environment where overall the economy seems okay, the narrative has sort of shifted to not looking for a recession, stocks are doing very well. Is that part of the reason why we have seen so much executive turnover? Is that the underperformers look that much more negligent, perhaps?
It is somewhat surprising that consumption in some areas is still relatively weak, because at the end of the day, the main driver of GDP for the last several quarters has been consumer spending, and the labor market continues to be very strong. The unemployment rate is at the lowest level in 50 years. So in that sense, that makes sense that consumption is doing better. And therefore, you would also expect that consumption should continue to do better. Of course, you could then begin to think about whether the unemployment rate could go up for various reasons. But given that the trade war is no longer such a big risk, and given now that global growth looks a little bit better, we still expect the unemployment rate to look relatively flat over the next year. And therefore, consumption should also, generally speaking, across the board, both for high and low income, should
think about. So when you say down to the stock, Bed Bath & Beyond stock down 78% over the last 5 years, that's while the S&P 500 has been way up. I mean, that's a going out of business sale almost.
Yes, well,
that's absolutely.
What does Bed Bath & Beyond give you that you can't get at Target, that you can't get at Walmart?
People still buy sheets and towels. They just don't buy it from this store.
The reason the C-suite people are getting pulled out is these are the people who are supposed to have anticipated, as Target did successfully, as Walmart, some kind of plan going forward, whether it's order and pick up at the store. I mean, when you think of online, do you think Bed Bath & Beyond?
Well, you have even had minimum wages have also been lifted. You have wages going up for the low income and the middle income groups more than for the high income groups. So you also think about some of the benefits that have been coming to across the consumption spectrum to some of the low and middle income names.
The only thing I'm aware that Bed Bath & Beyond has going for it is you can go there to exchange your SodaStream canister, which gets you in the store. So they've at least found one kind of trendy product they've attached themselves to. And my son has a SodaStream, so my son goes to Bed Bath & Beyond, but I guarantee you he doesn't buy anything there.
Well, but this has sort of been the story of retail recently, in an environment where consumption has been robust, to say the least. And we have guest over guest come on here and say the consumer is underpinning the U.S. economy. It is remarkable how there are so many retailers. There are some that are very well poised. You mentioned Target. And that there are some that just have not participated in that consumption.
So think about what's going to happen when we have a consumer downturn, which we will. I mean, when consumers rein in spending, if there's a recession or they feel like it, or unemployment goes up, I mean, we've been talking about a retail apocalypse in a good economy. Imagine how bad it's going to be in a bad economy.
Yeah, especially for those guys that are on the razor's edge like this one. All right, coming up, pain at the pump, why Visa is warning customers about using credit to pay for gas. Plus, going public in 2019, we'll break down the year's best performing IPOs.
Welcome back to On the Move. I'm Jared Blickery. We got the S&P 500 hitting another record high, just barely. Dow Jones not quite there, up 44 points, 28,280. S&P 500 is up a whopping 7 basis points. NASDAQ is down 1 basis point. Russell 2000 up 2 basis points. You get the idea. Not a lot of action in stocks going on today, but not a lot of news either. And no news could be good news. Let's look at the 10-year T-note. It's down 1 basis point today, had been down 2 basis points. Financials had been under a little pressure, but really not too much of a big news to affect the factor and sector rotation that we've been looking at. U.S. dollar here. Now that is up a little bit. Let's take a longer term look here. Going back 10 days, when we can see we dipped right here. This is where we broke through a long-standing trend line, but have now come back up. We have to wait and see if that's going to be a false breakout. The U.S. dollar versus the Chinese yuan. There's another one, just below 7. It's been relatively under control lately, especially since the trade war seems to be on hold right now, but we'll have to keep monitoring that as well. And this is a NASDAQ 100 heat map, and we have Apple up 0.5% today. We have Google, Alphabet down 0.2%, Amazon up 0.2%. Looking at the performance of the winners and losers here, Netflix up the most. It's up 3%. Wynn Resorts with China exposure up 1.25%. And then we have some chip stocks. Chips have been doing really well lately, up about 55% as an industry group. To the downside, we have Alexion, that's down about 1.5%, along with Expedia and Regeneron. And we're going to be back in 1 minute, guys.
Investors are moving money out of bonds while global equities continue to jump, and that's according to Bank of America Merrill Lynch. The three major indices are up more than 20% year to date. Arian Vojdani joins us from our DC bureau. He's an investment strategist at MV Financial, and I was just curious, given the fact that stocks appear to some people to already be expensive, and we've been watching all this money sitting in fixed income and cash, as it comes back into the market, are they missing out, or, it seems expensive? Why would they come back in?
Well, to your point, it is expensive, but given that interest rates are so low and have been for so long, it's a little bit hard to judge based just off of that. Money really has no alternative other than to go into equities at this point. You're not really making anything sitting in bonds, and we've been signaled by the Fed, and really the Fed is what we should be looking at. They're not going to be cutting rates, but they're not going to be raising rates. So there's continued easy money to the market. Europe the same. So I think we're going to continue to see the stock market rise. There's still room for a run. Obviously, longer term, there are some gray clouds potentially gathering, but for now, investors should be happy and are happy with what's happening in the equity market.
One of the other notable findings of that Bank of America fund manager survey is that cash positioning is getting lower. So it looks like investors, after kind of sitting and watching this equity rally all year, are finally getting in. What does that say about the sort of sustainability of the equity rally as we head into 2020?
I think the rally is sustainable, and we've been telling our clients this for quite some time, actually, is that money has been sitting on the sidelines, and it is going to come into the markets. You see this happen at the end, towards the end of every bull market, kind of this last gasp, if you will, this last kind of just exhilaration that happens, and money that's feeling left out rushes into the market. That's not to say that we're seeing this thing turn off anytime soon, but I think you're going to continue to see that trend go on. So I think, to your point, again, this is pretty sustainable.
We'll give it at this point. I mean, a lot of the analysis in terms of value versus growth and the traditional way that we were all normally thinking about equities. Are we concluding today, as per what you just said, that this is really all about predicting what the Fed and the ECB will do? And it's really not so much about what are sales going to be, what product companies have, and what's management like. Is it all really, at the end of the day, a macro trade and a prediction about are interest rates going to go up or down, and that will be driving equities in your view?
No, fundamentals are obviously important, and right now we're seeing solid, not explosive, but solid growth. Companies are still showing strength, showing confidence. Consumer confidence is high. All those factors are important. Obviously, the Fed is a good indicating factor. We don't want to fight the Fed. I think as long as they continue to let the valve run and we continue to see fundamental strength, those two things in tandem with each other, will have continued equity strength in the U.S. at least, and even around the world, we're starting to see strength start to turn back around, even though there's been a negative news cycle around that for quite some time. I think right now investors are more comfortable in equities than they will be, or they'll expect better returns, and they should expect better returns than fixed income, which really provides nothing for investors at this point.
When you say that, what would you say to investors who are looking at, there was an article that talked about the spread between treasuries and some of the, the higher yield corporate debt is tightening. So it's a good sign for stocks, but it's also a good sign for people, isn't it, who might want to take on some of that higher yield corporate debt that might be lower rated, that they won't get burned or not? What would you say to those people?
It's a great question. We've had this question from clients. We like to bucket high yield debt in that you're seeing risk in that part of your portfolio, not like you would if you were just investing in treasuries or high grade corporate debt. So if you want to go to high yields, you might as well look to equities. In my opinion, and that's what we do for our investors in our portfolios, is we just kind of push that off to the side and say, why even go there if we can get this kind of return or better return in equities right now? You're assuming the same kind of risk.
All right. Arian Vojani is an investment strategist at MV Financial. Thank you for being here on The Move.
Thanks for having me.
All right, Visa is warning holiday travelers of potential credit card hackers at gas stations. The credit card company says attackers are installing software that exploits the lack of security within magnetic stripe cards. Visa also said the hack does not appear to affect more secure chip cards, so it's encouraging fuel merchants to transfer or support those chip-equipped cards. But that's going to cost them some money, right? This is an expensive transition for these gas stations to make, particularly I assume the smaller unaffiliated
So
ones.
I was thinking about this after I saw this story, and I think that when I have a car and I live in the suburbs, and I think that every time I fill up at a self-serve station, I swipe my card instead of sticking it into a chip reader, whereas most retailers now have the chip readers, right? And apparently it can cost $250,000 to upgrade all the machines at a typical filling station. And they supposedly don't make that much money on gasoline anyway. They make it on the stuff they sell in the store. Yeah. So there's not much of an incentive for them to upgrade those machines. But there will be, because I think starting in 2020, they are actually going to be on the hook. Visa, which processes the payments for many of them, is saying, we're not going to deal with the fraud liability anymore. It's on you. So I guess that will be an incentive to switch over.
But this is a software issue. I mean, when I first heard about this, I was thinking, is there some kind of device that they're using?
Well, sometimes they put
hacking.
So hackers can put those into ATMs where it's actually in the machine.
But this situation is they actually hacked into the software, and it's the communication between the minute you put your card in and it's supposed to be going to SafeLand and it winds up going to the hackers. Yeah. Who would be responsible for that? Is the gas station? Is Visa?
Well, Visa's trying to put it on the gas station, it sounds like, in this particular case. I'm just, this is one more example where I'm struck by, we have no security.
Cash. Nowhere is safe. Nowhere is safe.
Around our personal information, around our financial information.
And there's a lot of cost associated with fixing this, and who's going to pay the bill?
Right. But people do this stuff anyway. Right? I mean, people, in other words, are you going to choose a different gas station if you pull up to a gas station and they don't have the chip card reader?
Well, I'll tell you what.
Are you not? I mean, people certainly aren't leaving someplace like Facebook because they feel like
if you're not the one paying the bill, you don't care. But I think that would change quite a lot when anybody who's ever been personally defrauded, man, they are They're
Lifelock.
crazy about security, you know? I mean, but it has to happen to you, and you have to be caught, you have to be the one who bears the cost, and then you will really ramp up your own security. I mean, I've had a couple
Think about how
fraudulent...
often we all get new credit cards throughout
Yeah.
the year. I mean,
That they arrive in the mailbox.
meaning also your own because you had some issue, and
Yeah.
then you just say, get me a new one,
Right.
and you have to sit and punch it into all the things you subscribe to. But it's just getting very intense, and the costs have to be borne by someone. And a good guess is that it probably end up being borne by the consumer.
Well, we probably are bearing the cost through whatever fees are charged, right? Which probably raises the cost of everybody a little bit.
Has anybody here have you ever gotten the notification that, from your credit card company?
Yes.
Yeah. What was it like? I mean, how does this actually happen?
It's happened to me a couple times. Once before I was getting alerts on my phone, I got a call. They noticed something suspicious. And then I did get an alert from American Express once. Did you just buy $4,000 worth of high-end kitchen equipment in
Las Vegas,
Tenafly, New Jersey? And I didn't. And they actually resolved it right away. So fraud detection is obviously getting a lot better. They can spot it on the run, but it's still a huge problem.
My AMX phone call like that was somebody in Las Vegas, and I hadn't been to Las Vegas.
Yep.
I said, nope, not me, and they took care of it. All right, coming up, making progress, why the World Economic Forum says we are still a century away from achieving gender equality. Plus, before we go to break, take a look at some of the biggest winners in the Dow today. Look at that, Home Depot rising, as is Goldman Sachs and Boeing. We're coming up on, excuse me, on 11:30 in New York City as I cough up a lung. 2 hours into the trading day, and stocks a bit mixed. The Dow and S&P 500 still in positive territory. Nasdaq's fallen. Oil right now, let's take a look at what's happening there. It was trading higher this morning. It continues to go up, $60.88 a barrel. Open for business. Congress is expected to pass a massive new spending bill this afternoon, but the devil may be in the details for lawmakers. Better than the rest, we're looking at the big names that stole the show in the crowded 2019 IPO market. And gender disparity. There's a new study which shows the U.S. falling behind in the fight for pay equality. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Well, the 2019 IPO calendar was packed with highly anticipated unicorns. And while some did flop, this year did have some huge winners. Let's take a look at the best performing IPOs for 2019. Yahoo Finance's Dan Halley has been doing a dance. He's so excited about this. And he has the countdown for us.
All right, to say 2019 had some high-flying companies hit the stock market is an understatement. And while some bombed, I'm looking at you, Uber, Lyft, and Smile Direct Club, some absolutely killed their IPOs. But since so many companies IPO'd, we're looking at the best that raised at least $250 million. So let's get it started. First up was Tradeweb. It's up 68% since its IPO. It's a trading platform working in the fixed income and derivatives market with a subscription model that means it has a constant stream of revenue. That's part of the reason it's been on a hot streak since it went public in April. The firm's IPO price was initially set at $27, and as of December 10th, it was at a whopping $45.40. Up next, we have 10x Genomics, a biotech startup that produces gene sequencing platforms that scientists use to study diseases. The company is on an absolute tear. Initially offered at $39 a share, the company's stock was up 69% when it closed at $65.95 on December 10th. It's not profitable yet, but the company has a clear path to get there. Zoom is the rare unicorn that was profitable when it made its debut this year. Its stock jumped from its IPO price of $36 to a high of $107.34 before coming back down to earth and landing at $64.57 at the close on December 10th. That's still good, however, for an increase of 79% over its IPO price. China's answer to Starbucks, Luckin Coffee, has opened more than 3,500 locations across China in just 2 years. But it's also burning cash, losing $75 million in its last quarter. Still, the company, which set its IPO price at $75, has seen its growth off the charts, jumping to $32.12, or 83% since the company debuted in May. And finally, Bridge Biopharma, a pharmaceutical company working on drugs for various rare diseases, and because of that, it hopes to avoid the kind of competition it might see for treatments from more widespread conditions. The company hit the market in June for $17 a share and jumped 117.24% to $36.93 by December 10th. And those are the best performing IPOs over $250 million.
Dan Halley, thank you very much. Let's talk about pay equality. Turning to that issue, according to the World Economic Forum, we likely won't see during our lifetimes pay equality. They predict the milestone is still 100 years away. And what's more, the U.S. lagged this year when it came to addressing gender equality, dropping 2 spots on the list from last year and 30 spots since 2006. With us now is Sadia Zahidi, World Economic Forum's Managing Director, joining us from Geneva, Switzerland. Also with us is Yahoo Finance's Julia LaRoche. And let me start with you, Sadia. Under the law in the United States, I think it's Title VII, isn't there some kind of legal recourse to, if we're falling behind, perhaps bring us back toward equity?
No, of course. Many countries have within their laws clear need for parity for pay, equal pay for equal work. But the reality is that unless there is transparency and disclosure, and unless this issue is taken very seriously by companies, there's very little that can be done about it, because most of this remains implicit and most of this remains non-transparent. So there are a couple of things that we pick up on. One, we look at wage equality for similar work. So it's an anonymous CEO survey that's asking people generally within their companies for similar roles, do women and men earn the same wages? And the second aspect is, if you look at both wage income and non-wage income, so resources that come from other activities, whether it's entrepreneurship or inheritance, what are the income gaps there? And there again, there's a fairly large income gap. So whether it's the United States or other parts of the world, without transparency, disclosure, and a lot of efforts that ensure that there isn't bias in the workplace, we are not going to see much progress.
Sadia, here in the U.S. in particular, we didn't really see much progress, in contrast with the rest of the world where there was some. What do you think the U.S. is not doing right that perhaps other countries are doing right? What needs to change in the U.S. in particular?
So I think there are a couple of things that we're seeing play out. One is the continuous lack of a care infrastructure in the United States as compared to many other parts of the world, in particular Western Europe. So a lot of Western European economies, in particular the Nordics, are providing better infrastructure to change the division of labor between women and men, both in the home and in the workplace, whether that relates to childcare or elder care or paternity leave or maternity leave. There are a lot of systems at play that provide support to families. A second aspect is the technological changes that have been driving a lot of transformation in workplaces. Now, we tend to think of dislocation of male blue-collar workers, but in fact, there's also a lot of dislocation of women who've had middle-class livelihoods through, for example, customer service work or administrative assistance and other such roles that are low to medium skilled that are also being displaced. So there will need to be a focus on roles of the future, and that's not something that's happening right now, either for women or for men. But of course, for women, there's a greater disadvantage because there are fewer of them in the pipeline for the roles of the future, such as cloud computing, such as artificial intelligence, such as engineering.
It's Julia LaRoche. I saw that the economic opportunity, the gender gap there was 257 years, up from 202 years a year ago. What are some practical solutions to close the economic opportunity gap for women? Do CEOs need to look under the hood and actually make changes when it comes to pay? Do they need to consider paid parenting leave? What do you think would be some practical solutions?
So I think there are a few, three big things perhaps that need to be done. One, you're absolutely right that CEOs and the leadership of companies not just have to sort of make this a clear part of their goals, especially in this era of stakeholder capitalism, but they actually need to ensure that this is being implemented, and it's being implemented all the way through the ranks of the company. A second aspect is truly hardwiring gender equality into the future of work. So if we have all this great data on what are likely to be the growing roles of the future, why wait for course correction in another 5 or 10 years? Let's actually embed parity into those fast-growing roles of the future. And then, of course, a third element is policy. And policymaking has to change when it comes to parental leave, when it comes to care infrastructure, and when it comes to essentially providing role models as well from political leadership.
And in terms of some of these developments, which are very long-term, as you also have in the table we just saw on the screen, to what extent has some of these trends been magnified by the financial crisis? And what does that mean for how we think about the next financial crisis? Does it mean that politicians should have a whole new set of rules and regulations ready? And if so, how should we think about financial crisis going forward if there are these also serious consequences that are not what we normally discuss, unfortunately?
When it comes to the long-lasting effects of the financial crisis, one of the things that it's clearly done, combined with the fourth industrial revolution and the technological changes we're seeing, is a lack of social mobility or socioeconomic mobility. People don't feel that they have an opportunity to give their children a better future than they did themselves. And that is playing out even more when it comes to gender gaps, because women tend to have lower access to opportunity to begin with, whether it's through education, whether it's through the workplace, whether it's various forms of discrimination that are being faced. And so when it comes to preparing for the future or for any kind of economic crisis, I think one of the biggest areas to focus on is restoring socioeconomic mobility through better education infrastructure, better workforce laws, a better focus on housing, better focus on health, all of the things that, frankly, most economies should be focusing on anyway to be competitive.
All right, Sadia Zahidi, World Economic Forum's Managing Director, thank you for joining us from Geneva, Switzerland.
Thank you.
Coming up, new data suggests a positive swing for the U.S. housing market. Plus, paying it forward, why tax payments among U.S. businesses have reached a record low. Let's take a look at some big movers in midday trading in our stock spotlights. We've got Tallgrass Energy. Now, this is a pipeline operator. The company is being bought out, taken private by Blackstone Infrastructure Partners. It is buying out the remaining shares of Tallgrass that it doesn't own for $2.2 billion. It had made a prior offer, but then had to raise it by 15%, is buying it out at $22.45 a share. On the flip side, we've got Proteostasis Therapeutics. Now, this company has rallied hugely recently. It's up more than 400% since its low in November, but it is down today very sharply, about more than 50%. It released initial phase 2 results from its a study of its treatment for cystic fibrosis, and those were not as successful as the company had predicted. So that's responsible for the big drop in those shares. We'll be right back.
In the month of November, U.S. housing starts rose 3.2%. Activity in the multifamily sector also increased for the second straight month. So let's turn this now to commercial real estate with our next guest. Nareit senior economist Calvin Schnur joins us to discuss this. And when we're talking about commercial real estate, are we talking about commercial, private dwellings where people actually live, or are we talking about the whole gamut, rental apartments as well as malls and the storefronts?
It's the whole gamut. Commercial real estate encompasses any income-producing real estate, which is the shopping malls, office buildings, but also you include multifamily, all the rental-type properties. It's a very large sector in the U.S. economy.
So you describe the current REIT market as mature, not necessarily late cycle, but mature. So cut through all the terminology and let us know what exactly does that mean?
The reason why I use the term mature is the biggest question everyone is asking is, when is this cycle going to end? What are the late cycle risks? And the problem is the economy is not behaving in a cyclical fashion, a predictable way as it had in decades past. If it were, this cycle would have ended in 2016 and would be 3 years into the next round. So it really does not it doesn't help us if we think in terms of cyclical, but it is clearly mature. It's not in the early growth stages, but right now we're at cruising speed in something where there's no immediate end in sight.
Aren't we going to see, though, a decrease, for instance, in some REITs as residential values not necessarily drop, but the rents, for instance, in places like New York or in some of the larger cities, we see a lot of empty storefronts and leases that are 10, maybe 20 years old are coming up for renewal. We might actually see those fall because there is so much vacancy.
Well, actually, it's surprising that across a lot of property types, I think you're talking about the retail right now, but across a lot of property types, you have very high occupancy rates. For the REIT sector, which owns about 20% of total investment-grade commercial real estate, occupancy rates hit a record high last year, and they're very close to that record high right now. The reason is there's not a whole lot of commercial construction. There's still fairly good demand. It varies across the sectors, but no, we're not seeing it like it would be heading into a downturn. It's still fairly strong.
Calvin, is the mall bust over, or is that hole going to get deeper?
I wouldn't use the term mall bust, because if you would go out right now or on the weekend, you'd find the parking lots are full in a lot of these malls. Now, the retail experience is changing because consumer shopping experience is changing. So what are the malls doing? Well, first of all, there are some malls that are closing, but those are mostly older malls in towns that have not had a whole lot of job growth, not a lot of economic growth. There are a lot of other malls that are putting in new tenants. There have been some bankruptcies from some of the big anchor tenants, but they're putting in new tenants. They're changing the experience. A lot of people are still going. Sometimes it's to pick up the things that they bought online, and they're buying more goods while they're there. So, it's true what you were saying, that along the lines of what you're saying, that the malls are adjusting to the new consumer shopping patterns, but they're making progress and they're working forward with it.
And as an asset class, are we also thinking that things are mature at the moment, or is there still opportunities, and in which parts of the REIT space look a little bit cheaper or a little bit more potential growth relative to others?
Well, there are some sectors that are really quite robust in terms of growth, and this would be a secular growth with e-commerce. We're talking about e-commerce and how it's affected retail, but there are also the logistic companies that are helping ship the goods, and they've done very well over the past several years.
So warehouses would
Warehouses. They're warehouses, but they're not the traditional types of warehouses where you're storing things for weeks or months. They're storing things for less than a day as they're transshipping them to consumers. You also have the data centers that are storing and processing a lot of the data transmission, and you have cell towers that are handling the electronic communications. These are areas of the U.S. economy that are growing quite rapidly, and they require real estate, and that commercial real estate is in the hands of REITs.
Calvin, just quickly, how vulnerable are REITs right now to rising rates compared to in cycles past?
It's interesting. I've done a lot of analysis of the overall financial position, and their interest rate exposures are the lowest they've been in 20 or 25 years. After the financial crisis, they raised a lot of equity capital, their leverage is down, and they've lengthened the maturity of their debt to well into the next decade. And there's a lot of short-term response to the stock price when interest rates move. But if you look at their operating performance, their occupancy rates are still high, their earnings are still high, even as interest rates have moved. So if you're looking for a good trade, it's say if the market sells off because you're concerned about interest rates, look at the performance. They're holding up quite well.
All right, Calvin Schnorr, thank you for being here.
Thank you.
All right, this is what we're talking about when the cameras aren't on. Star Wars, The Rise of Skywalker premiered yesterday. Yahoo Finance's Melody Hom got an inside look at how Porsche's design team played a part in the film. Melody joins us from Playa Vista, California. Melody, definitely there's a lot of cross-promotion that is happening around this movie.
Yes, Julie, it's been an interesting event, and I just came back from the premiere last night. There were, as you can see, I was actually on that blue carpet way before the celebrities arrived, and this sort of cross-promotional collaboration is certainly seems to be a staple of the industry, not just with cars and entertainment. I think overall, I was really impressed by this brand new Tri-Wing, which is a spaceship that they designed together over the course of 6 weeks, but it was a collaborative effort over 3 years. Julie, the craziest thing, though, was it didn't actually make the film. And my impression is that J.J. Abrams actually saw it in the final cut and essentially said, hey, we're actually, this doesn't necessarily make sense for our company. I had a chance to speak with Klaus Zellmer, the president and CEO of Porsche North America, and here's what he had to say about Porsche and the future.
Well, it's this transition into battery electric vehicles that, with a sports car brand like Porsche is an exciting moment, because that's going to be a milestone in our history in decades to come, looking back and saying, hey, this is when we started the transition process into battery electric vehicles, because the future is electric.
So even with that electric component, how would you say the collaboration with Star Wars really amplifies that? Do you think it's a great marketing scheme, right, for folks who were perhaps considering this new vehicle?
At the end of the day, we are trying to amplify a brand, and we're trying to manage a brand the best way possible. And it's not all about the product. Many people buy our products because the products are great, but that's just a hygienic factor. The bigger factor is brand. And if you want to increase your footprint, reaching new audiences, then you also have to go new paths, new ways, new routes. And one of them is, of course, tapping into the audience of Star Wars that go over decades, generations of fans that take a liking into something that is very related to the future and to fantasy imagination. And that's where Porsche comes in and plays well, and we hope that we discover new fans for our brand that currently are in love with Star Wars.
So Julie, Adam, of course, Rick Newman, our car guy on set. Of course, this was an interesting conversation because of the global context that we're dealing with, right? Actually, offline, Klaus did speak to me saying that he was concerned about slowing car sales. As we know, Fitch Ratings actually expects global car sales to see their steepest year-over-year decline this year since the financial crisis. And I think overall, he's projecting that over the next couple of years, yes, he can hope that EVs will do well, but at least in the North American market, it feels very saturated. I also asked him to make a comment about Tesla. Of course, he chuckled. I said, a lot of the chatter around Cybertruck, of course, was that it looked like it was from a Star Wars galaxy, right? Yeah. And he said, yes, that is what I think.
Did you like the film?
So I actually really enjoyed the film. I was telling Ken and the production folks that I am a mild Star Wars aficionado. I'm not necessarily a diehard cult follower sort of fan, but I have to say the last set of the trilogies, it was very, very impressive. It also doesn't hurt, Adam, to be in the same auditorium as, Steven Spielberg, J.J. Abrams. It adds to the energy where you feel as though, okay, this is kind of the work of their fruition coming to play.
Well, I know a lot of people are happy that you didn't give us any spoilers, like
no
Darth
spoilers.
Vader is his father.
I have a strict
anything,
embargo
right?
with Disney.
Yeah.
I don't want to be on their blacklist.
I don't blame you for that. All right.
Be on our blacklist. Forget about Disney.
Half the crew is going Friday. Some are going next week. Melody, thank you. Coming up, that deadly winter storm moving across the United States spawns tornadoes in the south and claims more lives. Plus, the FBI buzzed 2 hackers and shuts down illegal video streaming sites that are bigger than Netflix and Hulu combined. Violent thunderstorms moving across the country spawned deadly tornadoes in the Deep South. 3 people were killed, 2 in Alabama, 1 in Louisiana, and several more injured as 27 tornadoes roared across the South. It's all part of that powerful winter storm front moving east. It has led to several accidents, and it's killed a total of 11 people. Purdue Pharma released an audit which shows members of the Sackler family withdrew more than $10 billion from the company. It makes OxyContin, and they face lawsuits for their role in the opioid crisis. The audit was part of Purdue Pharma's bankruptcy proceeding. The Sackler family, which owns the company, has offered to pay $3 billion to help settle several lawsuits. The FBI busted 2 computer hackers in Las Vegas who were running what the agency calls a massive illegal streaming service. They pled guilty to criminal charges over the weekend. The illegal streaming sites, one called iStreamItAll, boasted they had more content than and were so big that the sites, that at least one of the service called iStreamItAll, they boasted more content than Netflix, Hulu, and Amazon Prime combined. The U.S. House of Representatives will vote on a $1.4 trillion spending deal to keep the government funded through 2020. It includes a pay raise for federal employees and military personnel. It also maintains a $1.4 billion supplement for President Trump's border wall, but that's less than the almost $9 billion the administration wanted. We'll be right back.
It's time for Word on the Street, where we check in with our panelists and find out what stories they're watching. Rick, why are business tax payments at a record low?
Man, business tax payments, corporate tax payments have fallen to almost nothing, no percentage of total federal tax payments. So this is a big deal. The Democratic presidential candidates are talking about new ways to raise taxes. There was a new report out just this week showing that 91 big Fortune 500 companies that turned a profit actually paid no taxes in 2018 because of all the tax breaks you get. So I went and looked up the numbers. I wanted to know what percentage of total tax federal revenue comes from corporations anymore. You guys want to guess how much you think it is?
10%? Lower.
Lower, way lower, 3.5%.
Can you put it in context, though?
Yeah,
what it used to
sure.
be?
Only of all federal tax revenue, only 3.5% these days comes from corporations. That's down from, in 2010, it was 9%. In 2000, it was 9.4%. And back in 1960, 22% of federal revenue came from corporate taxes. So since 1960, corporate tax revenue as a percentage of federal revenue has fallen from 22% to just 3.5%. And that's because the rate has come down over time. All the loopholes that let companies shave their tax bill. And those loopholes exist largely because there's supposed to be incentives for companies to, spend money here, invest money here, hire people here. And it's just kind of not working out that way. So I think the Democratic presidential candidates are on to something when they say something's not right about this situation.
So does that imply that 96.5% of the tax burden in the United States, the revenue that the government gets, is from us?
No, individual income taxes are about 47%.
Okay.
Payroll taxes, which fund Medicare and Social Security and basically go directly into those programs, are another big chunk. And then there are estate taxes, which are tiny, a bunch of small things, excise taxes, and tariffs. tariffs actually are showing up as a growing line item. It's still a fairly small portion. But so all the, mostly payroll tax has gone up over time, and corporate contribution has just shrunk to almost nothing.
Speaking of tariffs, the trade war, Torsten, I know you're keeping an eye on it.
Yeah, no, we spent a lot of time thinking about, is the trade war over, and what does phase one really mean? We're now getting into the process of preparing the legal language, which will take at least a month, maybe even more. And the next question, of course, that we're discussing a lot with our clients at the moment is, what will phase two consist of? So the idea that there's certainly less trade war uncertainty than before, but it's not completely eliminated. And that then begins to open up discussions about, well, okay, if it's not completely eliminated, is it coming back? What will the form be? We saw with the USMCA just this week, also most talks about when the language actually was prepared, there was some debate about, well, was this exactly what they agreed on or not? So the nitty-gritty becomes really, really important in trade deals, because you often have different interests and different disagreements about what needs to be done. So we are very much watching going into 2020. Is trade war uncertainty really all behind us? For now, it looks like at least it's been quieting down, but what does that exactly mean in very precise terms, in terms of what the outlook look for next year, particularly on the phase two part?
Do you think that whatever the outcome from whatever phase one turns out to be, that we're just kind of, that is the status quo for the next year until the election is over?
So what I think is very important in that context exactly is that, well, if this was uncertainty that was shortening down business spending decisions, and now we're switching to election uncertainty, which also has some other issues around it, namely what will the business environment look like? Will it have higher taxes, lower taxes, higher minimum wages, more labor protection, less labor protection? All these things are more up in the air than they've been for a long time, which basically means that if the fear this year was that the uncertainty was holding business spending down, going into next year with election, then of course the risk is that that might transition from trade war uncertainty to, in the worst case, election uncertainty. That also might be a cloud over the business spending outlook.
All right, Torsten, good to see you. Thank you for being here. You're sticking around, and coming up, Amazon's war on FedEx, why the retailer is banning FedEx ground delivery this holiday season. Plus, before we go to break, take a look at some of the top trending tickers on Yahoo Finance today. And there you see FedEx trending down after the big news from Amazon saying, don't use FedEx if you're a third-party vendor. Noon here in New York City, 2.5 hours into the trading day. Stocks are trading higher. Take a look at what's happening with the 10-year Treasury yield. It, too, is going down, 1.88%. Delivery pains, Amazon steps up its fight with FedEx ahead of the shipper's earnings after the bell today. The honeymoon's over, the pound slides as UK Prime Minister Boris Johnson faces a new Brexit headache. And Let Them Be, one of Facebook's original investors, reportedly pushed the company not to vet those fake political ads. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for staying with us. Boeing officially announced it will halt production of the 737 MAX. Scott Gamm's on the floor of the New York Stock Exchange with the details and the stock action. Scott, the stock's up.
It's up, Julie, and they put Boeing's stock right on the board to my left, so that's how you know it's a big story. But yes, Boeing is up right now, but earlier this morning it was in the red, and the low today for Boeing was 321. That's important because the low for Boeing, really since March, when the most recent 737 crash happened, was 320. That occurred in mid-August when we were worried about the inverted yield curve, not necessarily about Boeing-specific issues. So really the stock had been resilient until now, although right now you are seeing Boeing shares above 330 a share. Whether or not that level can hold remains to be seen. Also this morning, Boeing shares briefly went into the red for 2019. Right now, they are back in the green. Now, Julie, a couple other stocks we're watching today. Goldman Sachs up right now after getting a price target raise from Wells Fargo Securities. The analysts over there, including Mike Mayo, are bullish on the stock, especially 1 year into the company's new management team. The price target is now at 280 from 240. Goldman Sachs shares right now are at about 231. And then finally, another stock that's on the board to my left, Unilever, down about 9% right now after the company said it will not meet its 2019 sales targets amid some economic headwinds in South Asia, guys.
Scott, thank you. Our top story has to do with FedEx. Delivery rivalry. Amazon blocked third-party sellers from using FedEx for ground delivery, shipping in the latest battle between the two companies. The ban will start this week, and it will last until FedEx's delivery performance improves. That's a quote from Amazon. Want to introduce this hour's panel to discuss all of it. Yahoo Finance's Akiko Fujita joins us now. Rick Newman is still with us. And we knew that they were going to separate, but this seems to be kind of, at this time of the year, it's just an amazing thing for Amazon to say, you know what, we realize it's third-party vendors, but forget Christmas, don't use FedEx.
Yeah, it almost makes sense because it's this time of year, right? When you think about the competition that exists between FedEx and Amazon, and as I understand it, it's a temporary block.
And it's also very specific. It's not a blanket FedEx.
It's one-day ground.
Right. Yeah, so at a time when Amazon's trying to get all their shipments out, you know, I mean, why not put themselves sort of in the front seat? I'm not advocating that it's the right thing. I'm just saying that I think that at a time when Amazon's being increasingly competitive, they've already severed that partnership on FedEx ground. Mm-hmm. This seems to be sort of that natural next step.
Yeah, perhaps so. And maybe also, the rationale they're giving is that they don't seem to have a high degree of confidence that FedEx is going to get the stuff. I mean, who knows if that's true, if they're just throwing shade.
Well, I mean, on the consumer side, this is good for consumers because Amazon is just relentless about getting you your stuff faster and faster and faster. I'm a Prime customer, and sometimes I'm like, 2 days is fine. I mean, I don't need somebody like racing to my house the second I ordered the thing. But that is where they're building. I mean, that is where they've built their reputation, building their business, and they have said if FedEx can get its performance back to where we want it to be, then they can start doing this again. But this is not really a core thing that FedEx does. FedEx does not specialize in last mile delivery. We could argue maybe they should. I mean, they specialize in moving, large, bulky stuff around the world, which is why they're exposed to China, for example, in the trade war. So FedEx may be deciding we don't need to do the last mile. Our core business is the big.
Don't you expect to hear that in the earnings call, which is this is a smaller portion of our business anyway.
For sure,
so yeah.
Yeah, I mean, I think that if you're on the FedEx side of things, the question is, well, where is that growth, right? I mean, they're, as you point out, they're not last mile, but clearly that's a speed that's becoming increasingly competitive. Those who have not looked at that before are going to now look to jump into it as, the consumer demands more and more of that kind of one-day delivery. So there's clearly an opportunity for FedEx on that side. I'd be curious to see how they spin it on the earnings.
Well, Amazon isn't necessarily in the last mile either. They contract with the third-party couriers and
Amazon is like all of the above. I mean, they will do small local couriers. They have some of their own. Of course, they rely heavily on the postal service. I think the question for FedEx, if they're going to basically say, we're not worried about Amazon, I mean, nobody really gets away with betting against Amazon, so they would have to make a really strong case to say, that's just not a profitable segment for us. And it's possible that the margins are, that's a labor intensive. I mean, to get, the last mile, it requires lots of infrastructure. So maybe they can make the case that that's just not a good investment for us. But boy, the rest of your business better be strong if you're betting against Amazon.
Are you last minute Christmas shoppers?
Yeah, I mean, I was going to point out, you said 2 days is fine. I mean, I was looking at it yesterday.
Except
thinking,
now.
Why, exactly, why am I going to get it on Thursday? I'm sitting at my laptop on a Sunday. I want it tomorrow.
Well, but you don't
get spoiled using
Prime. If
Prime.
it's the gifts, you don't need it until Christmas itself.
Unless you're flying out.
Most of the time, 2 days is fine. But, there are times when something comes, I order on Saturday and it arrives on Sunday, and I feel like, give that guy the day off. I mean, Monday would be fine, but not around now.
Let's move on to what's going on in the UK, because now we have Brexit chaos again. British Prime Minister Boris Johnson is saying the UK will cut ties with the European Union by the end of 2020, with or without a deal. Let's go to London. Yahoo Finance's Edmund Heafy has the details for us. So, I mean, it did seem like there was a higher degree of certainty after Johnson's win, but now is that all thrown into question once again?
Yes, it almost certainly is, Julie. And analysts had warned about this specific type of scenario. While the deal that Boris Johnson struck with the European Union gave some element of certainty, and his election win then gave certainty to that whole process, the pound now is down almost 1.5% against the dollar, meaning it has completely erased all of the gains that the currency made in the wake of the election win last Friday. And that's because government sources have briefed practically every media outlet in the UK that Johnson will this week publish legislation that would force the country to cut ties with the European Union at the end of 2020. As you said. So the UK is due to leave the European Union on January 31st, but as part of the current agreement, there will be an 11-month transition period where things essentially stay the same. And that's meant to give the UK time to negotiate a trade deal with the EU. But under current arrangements, the UK could request an extension to the transition period if they can't broker one. But Johnson's legislation would essentially make it illegal to request such an extension. And Johnson's election manifesto had hinted he would do this, but markets were definitely not expecting him to turn this into law so quickly. And this basically essentially creates a new cliff edge, no-deal Brexit-like scenario, whereby if the UK doesn't strike a trade deal with the EU, it will crash out without a trade deal on December 31st, 2020. And so, yes, all the pound's gains were as a result of the certainty that markets felt like had been injected into this process. But we could be facing more uncertainty this time next year.
Edmund, thank you. Let's bring in Head of Equity Derivatives Research at UBS, Stuart Kaiser, to talk more about all of this. And you say Brexit and U.S.-China trade are the biggest global concerns for markets, but as of right now, you're bullish. I mean, the recent, I don't want to say solutions, but the pause.
Yeah, honestly, we've been pretty bullish probably for the last month or so, just in the sense that markets were rallying pretty strong. U.S. employment data was pretty good, and then you had 3 or 4 major macro events before year end. You had, the UK vote, you had U.S.-China trade negotiations, you had FOMC, ECB, and some U.S. data. And by and large, all that's been neutral to positive, and it's just let the market kind of continue to rally. I think what we're seeing here today with the news is that, China and Brexit have been plaguing the markets for, call it 18 months, give or take, or Brexit even longer than that. And these things aren't going to die quick, and it could be that they kind of reinvent themselves into different risks over the course of the next few months. But I think into year end, things look pretty clean for the markets, and that's kind of been our view for the last month or so, I would say.
What about beyond year end? Because we still have to get the signing of this U.S.-China phase 1, right? Mm-hmm. And Brexit, that thing's going to linger around for, end of 2020. I don't know if I'm even optimistic it'll be done by the end of 2020 at this point, but what effect is that going to have on the markets?
Look, our core view going into 2020 is you're going to get a sort of significant slowdown in U.S. economic activity in the first half of the year, and that should be a pretty big headwind for the markets. I think the question now would be, because you've had a resolution to some degree of the U.S.-China stuff, will the market be willing to look past that slowdown in growth on the view that, well, it's kind of temporary because we've resolved that major challenge? So I think to the extent that you can keep the U.S.-China headline headlines positive, the market's going to be a little bit more resilient to any kind of level of growth disappointment, and that would be, I think, positive for the markets.
What's the resolution, though? I mean, if you look at exactly what the deal is, as far as we know, just ag purchases, right? I mean, there's other things that Robert Lighthizer has pointed to say these discussions are there, and yet we haven't seen it all in writing. And to Julie's point, it hasn't been signed.
Well, look, I mean, there's a couple issues here, Huawei and IP being two key ones for both sides that some investors argue are kind of irresolvable. So those are just going to sort of linger. But to the extent that you're rolling back some tariffs, you're adding some ag purchases, that would mean that the drag on growth should be a little bit less, and that's sort of a net positive for the market. The issue is not going away, certainly not, and the political calendar is obviously going to play a role in that. So I think the way the markets have been conditioned the last 6 or 12 months is, it was bad news stacked on top of bad news, and now we've had neutral and now maybe a little bit of positive news. And that's so from a sentiment perspective, I think it's a net positive. From a growth perspective, it's neutral to slightly a net positive. But yeah, you do have some things that are just going to be out there for the foreseeable future.
So Stuart, the baseline case now for the China dispute seems to be that if we get this deal, I mean, most of the tariffs Trump imposed are going to stay in place, but we probably will not get new tariffs. So we're going to get a kind of a more predictable situation, but with higher tariffs than everybody wants. Is that just a minor drag on growth here in the United States, or is there some way producers here, importers here can work around that, and so that it is not a drag on growth?
I mean, I think if we think of how things played out last year, you had tariffs announced in the spring. You had a pretty big drag on growth about 6 months later. So that was 4Q of last year and kind of into 1Q of 2019. If that sort of plays out again, then you've got a period of slower growth, and in our view, that's first half of 2020, and then you sort of go back to, I don't want to call it business as usual, but the economy then just starts to move past that drag. Companies have shown some ability to kind of work around this. It's not a full avoidance, right? I mean, you have smaller retailers in the U.S., for instance, are probably under a fair bit of pressure because they have a lot of trouble dealing with those tariffs. So I think you have kind of a 6-month period where the drag is pretty acute, and then you do have some ongoing issues for companies that are perhaps less healthy and less able to work their way around it. So it doesn't go away, but you hopefully, people have adjusted and the market can kind of, I don't want to say move past it, but adjust and reach a new equilibrium.
Stuart Geiser, thank you for being here.
Thank you. Appreciate it.
Well, Nike is set to report fiscal second quarter earnings after the bell on Thursday. Shares of the company have rallied pretty strongly this year. Actually, maybe they haven't rallied that strongly this year. And most analysts see more gains to come. Joining us now on the phone is John Kernan, analyst at Cowen. Sorry, that's my eyes trying to read that. Oh, they're up 30%. So excuse me. Thank you. So John, thanks for joining us. We, of course, have seen a management transition at Nike. That's been one of the more notable things that has happened. So what do you think John Donahoe is going to bring to the table on this earnings call and then going into 2020?
Yeah, thanks for having me. Great to be on. Look, John Donahoe is a transition from Mark Parker because Mark Parker was a product-driven mindset. His background was the shoe designer. Mr. Donahoe's background obviously is more in software and technology. He will lead the transformation of Nike's business to more of a digitally led, direct and digitally led platform.
You don't expect that, though, to cost them over the next couple of years and to take a hit on the stock for people who are putting money in it right now?
The stock sold off a little bit when the initial announcement regarding Mark's departure as CEO came out. It has since recovered. The stock's at an all-time high right now ahead of earnings this week. I think people see the long-term growth story here, particularly in China. China's nearly 40% of the company's EBIT growth the next 5 years. It's very powerful. Nike is the leading athletic brand in China by a wide margin. They have a near monopoly on basketball in China. Basketball is the most popular sport in China. It creates a very powerful growth story there. They're also gaining share in North America and Europe as well. So there's a big top-line growth story. There's a big gross margin story. And this is a mid-teen type EPS compounder over the next 5 years in our view.
John, you talked about John Donahoe's digital footprint or his strength in digital. We've heard that over and over, but what exactly does that mean beyond what Nike has right now in terms of their exposure on that front? What specifically do you expect him to bring to the table that would be different from what we see right now?
Yeah, sure. Nike wants to serve consumers digitally at scale through personalization and membership, their sneakers app, their Nike Plus app. They're building capabilities, they're building loyalty within those apps, and they're building active users within those apps very rapidly. So that's ultimately how they're going to serve consumers, I think, at scale. Is really with its sneakers app and the Nike Plus app. The growth potential of Nike in the digital space is quite enormous when you think about their platform and how much volume they're doing in the physical space through their own direct stores, but also through their wholesale partners. And I think Nike will capture more and more of the unit economics of each shoe that they sell when they do it through their own apps.
Do they potentially face, a slowdown if they don't come up with new designs? Because you pointed out in a recent note that Nike and Adidas have a void in the creative design heads.
Well, I think Nike has a tremendous product cycle right now. You're seeing it pretty much across men's and women's casual lifestyle, basketball, all are expanding very significantly. Their new platform, the Joyride, is scaling nicely. And, basketball's in a great product cycle right now. We've never really seen this company innovate at this rapid of a pace. And if you think about what Nike has to do to grow double digits on a constant currency basis globally, it takes a tremendous amount of innovation. I mean, it's almost creating an entire Under Armour brand, recreating an Under Armour brand, nearly $4 billion a year in sales. Each year globally. So it takes a lot to do that. It takes a lot of innovation.
Yeah. John Kernan, analyst at Cowen, thank you.
Coming up, buy now, maybe pay later. A new study shows shoppers are less confident about paying off this year's holiday shopping spree. Plus, take a look at some of today's trending tickers on Yahoo Finance. There you see a few of them. Unilever among those that are trending now.
Welcome back to On the Move. I'm Jared Blickery, and we got some signs of life just a little bit in the stocks. We got the Dow up about 78 points, or up 0.25%. S&P 500 up 13 basis points. Here's what's happened over the last hour. We can see we're consolidating in a pretty narrow range today, just below the 3,200 level, which, by the way, we hit in the futures, but not in the cash. Let's take a look at the Russell 2000. That has been on fire lately, but kind of muted today, although it is testing sessions highs right now. If we take a one-year look at the Russell, we can see that it is definitely broken out, but it is still about 5% off of its record high. And here's what bonds are doing. The 10-year T-note is down about 2 basis points, although the 2's 10 yield curve is actually expanding right now. It's a bull steepener. So if we take a look at the sector leaders, we will find financials outperforming, but energy and utilities are in the lead here. Kind of an interesting setup. And here's the energy ETF over the last year, and we can see that it's just barely breaking out, but it's still consolidating as we sit here. We're going to take a look at the Dow heat map here, switch it over, and we can see kind of a mixed picture. We have Apple up 1/3%, Microsoft down by about 1/4%. Again, financials outperforming. We see JP Morgan at or near record high, up 0.5%, and Goldman Sachs up 1.5%. We'll see you guys in 1 minute.
M&A activity in 2019 has been robust, with expectations around $2 trillion in deal activity globally. That's on pace with last year. A good portion of that volume was in mega deals in pharma, fintech, media, and banking. Joining us now is Karen Davies, private equity managing director and group head at Huntington Bank. And Karen, you look more at the sort of middle market, not necessarily the mega deals, right? So how has the year been on that front, if a lot of at least the deal value has been at the upper end of the range?
Well, it's been a very busy year. It's definitely been on pace with 2018, so it feels like a comparable period of time. The $2 trillion that you mentioned is about exactly where we were at this point last year. It's been very active, and it really has kind of picked back up very heavily in the third quarter and fourth quarter, because I think folks have a little bit more confidence in terms of where interest rates are. You know, the central bank Fed has spoken. We're going to hold our rates. We know what may be coming with tariffs. There might be sort of some quieting of the noise around tariffs. So M&A activity is sort of resurging, and the market is, S&P is speaking, the Dow is speaking. Consumer confidence is high. I see, 19 has been a rock solid M&A year, lots of money to put to work, lots of capital available, and that should continue into 2020.
And as it does continue, what does it look like? I don't know if you can tell us, players that might be, ripe for this, but sectors perhaps.
Right. So I think you're still going to continue to see anything technology, right? Anything tech that helps businesses get ahead of their competition, AI, fintech. You're going to see and continued tech in healthcare. Healthcare deals obviously very active. Food and beverage seems to be very active these days because you're sort of heading into a space that could potentially be non-cyclical.
Just a quick follow-up to that. We've seen with venture capital so much led to some pretty bad decisions. With easy money right now at low interest rates. Doesn't that risk exist for private equity as well?
It does. I think you have to be very selective. I think you have to stick to your knitting. I think you have to pick the industries that maybe you've already invested in, that you have operating partners who are on your team inside of the private equity firm, and you're working with credit providers who have strong industry expertise. So sort of strong industry expertise with strong investment knowledge in terms of sector specific usually is a little bit safer bet than maybe having a bit of a PE firm who might be a bit of a tourist in a certain industry, and then going with an unknown credit provider. That usually tends to be a little bit riskier. I think you just sort of have to pick the sectors that and at least where I sit inside of Huntington Bank in the middle market, ours tend to be just a little bit more B2B and industrial, right, in terms of the Midwest.
What's happening on the valuation front, right? Because we look at the broad market and we see things climbing. Is that starting to be an obstacle when you're watching deals?
Well, I think as I look at the multiples, and we've been saying this for 3 straight years. Like, this is an all-time high. It can't get any higher than this. And the reality is, I almost feel like that's a new norm. I feel that you've got so much private equity dry powder available, incredible access to capital from other providers, CLOs, sovereign wealth funds, direct lenders, us, a regulated bank like Huntington, credit providers. There is so much capital out there that has to be put to work, at least on the PE side, that we're not really seeing valuations come down that much.
And that's not changed by the WeWork blow up or some of the other missteps, for example, that SoftBank has taken? No. I mean, at one point we were talking about a broad scale sort of re-rating.
Right. But that has not changed. At least in the mid-market, that has not changed. The multiples are still elevated. I think the thought is that they will continue to stay elevated. It just basically goes with a bigger equity downstroke in terms of the capital structure that you put together to buy those businesses.
Interesting. All right, Karen, thanks for being here. Karen Davies from Huntington Bank. Appreciate it.
It is the season for spending, but a new report shows consumers are less confident about paying off all of their holiday bills. The latest Compare Cards data shows only 40% of cardholders feel, quote, very confident about paying their credit card monthly statement balance in full. That's down from 46% a year ago. Joining us now from Austin, Texas is Matt Schultz, Chief Industry Analyst at CompareCards.com. And Matt, I'm going to ask you a two-part question here. Why are people feeling less confident? And it's one thing to ask people how they feel. Do we know how they act, though? For instance, last year, 46% felt that they weren't confident. Did that transpire into delayed payments?
Well, it's interesting. Where this confidence survey sits is kind of in between late payments and paying those bills off in full, because anyone with a credit card knows that there's a big difference with that. And what we're seeing generally with economic numbers is that delinquencies are still pretty low, certainly by a historical standard. But what our confidence numbers show is that even though people aren't paying late, it doesn't mean that they're paying their bills off in full. And we've seen credit card debt rise to more than $1 trillion with no end in sight to that rise. So it's an interesting place right now.
So what are the implications then? I mean, if people are still not falling behind on their bills, but they're not paying it off in full, I mean, it means that they are obviously paying more interest, right? But are there any sort of broader implications for spending or for the economy?
Well, really, the main implication is that if you're building up credit card debt in good economic times, which by most accounts we certainly are in, you're probably not putting enough money away for when things eventually turn south. And we all know that things eventually turn south, at least for a little while. So what this means now is maybe not necessarily as important as what it means when we eventually see that downturn coming down the road.
I'm trying to understand the disconnect here, because on the one hand, you're saying that, consumers aren't as confident that they can pay off their bills, and yet we're at the heart of the holiday season, and we keep hearing that there is more and more spending, that this is the kind of holiday season we haven't seen in a while in terms of the confidence from the consumer. So help us understand what that disconnect is.
Well, the disconnect is that people may still be spending, but they may not feel that great about paying their bill off when January 1st comes around. And I think that a lot of that is simple pressure to spend, and a lot of it is simply not wanting to let your kids or your friends or your family down. So people keep spending. But our data shows that there's no question that people do feel less confident in their ability to pay that statement balance off in full at the end of this month than they did a year ago at this time.
Let them down, give them a lump of coal. I'm going to shift gears here, right? Because you also have that survey about holiday travel you looked at the best and worst airports for delays and cancellations, and I just want to shout out to what a lot of us consider the worst airport in North America, LaGuardia. Actually not so bad, but tell us about the others.
Yeah, that was a bit of an upset that LaGuardia actually ranked among the 5 best airports in terms of delays and cancellations. And part of that's simply because you don't have as many connecting flights or as many international flights necessarily, because there are some rules that govern LaGuardia that are different from, say, Newark and JFK and some of the other airports in that region. But the worst airports that we saw in our study were in Chicago, Midway and O'Hare. And anybody who's traveled through there is not going to be surprised by that. And also the fact that it's a city with weather issues during the winter time for sure. They're major hubs, they're big cities, there's a lot of air traffic around there. So not that surprising to see those two not do all that well.
All right, Matt Schultz is the Chief Industry Analyst at ComparedCards.com. Good to see you.
Thank you.
Coming up, smoking crackdown. Congress is on track to deliver a blow to the tobacco industry by raising the legal smoking age to 21. Plus, take a look at some of today's losers on Wall Street today. We've got Unilever down after a forecast cut. It's just after 12:30 p.m. here in New York City, about 3 hours into the trading day, and stocks remain little changed, although a little more positive than when we started the program. The Dow gaining 0.25% now. Let's look at gold prices as well here today. We are seeing gold push down, but very marginally, $14.80 the ounce. Open for business. Congress is expected to pass a massive new spending bill this afternoon, but the devil may be in the details for lawmakers. The other trade deal, we'll hear from the Lieutenant Governor of Ohio about what the USMCA means for jobs in his state. And costly law. Vox Media gets set to cut hundreds of freelancers amid changing labor laws in California. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Meghan Markle, the Duchess of Sussex, was a fan of these clothes during her pregnancy. Maternity wear brand Hatch is disrupting the industry with fashionable maternity wear that covers every trimester and beyond. Joining us now for our Women and Money segment, brought to you by USAA, is Ariana Goldman, founder and CEO of Hatch. You've got 2 brick and mortar stores,
yes,
and obviously online, I would imagine. With maternity wears, I've been listening to Julie talk, and I'm going to turn it over to you, actually. But I guess it's one and done, basically, and then you're giving the stuff away afterward. So, you know, how do you grow this business?
Not necessarily. I mean, yes, it's one and done until the next one, but really Hatch is about investing in things that go the distance. So it's really before, during, and after. So all of our clothes are made to go with the bump and beyond and expand with you through your journey into motherhood as well. So the duality of it is really an investment that women are finding value in, and I think that's really what sets us apart from really just maternity one and done options out there.
So how does that work exactly? Because when you talk about value, I mean, these are priced at probably a premium to the market, I would say, generally, when I was browsing some of the offerings on your website. So, you know, you think of the sort of old-fashioned maternity stuff as sack-like. This stuff is fashionable. But how does it look as good on you after you have the baby as it does when you've got the bump?
Again, the draping, the fabrics we choose, the designs of the pieces. When I entered the market, I was pregnant with my first daughter, and there was no one speaking to me. I wanted to invest in myself and feel good about the things that I was putting on my body. And everything was disposable, and it was a really low-cost, kind of cheap piece of clothing that made me feel pretty terrible. And so I really saw a white space in the market for clothing that draped beautifully with a growing belly and allowed me to invest in myself and invest in pieces that I didn't want to dispose of after the baby came.
We're coming at the end of a year where we've seen a lot of retail companies struggle. And I know with you have the sort of the direct-to-consumer model, and obviously you've got the retail footprint as well, bricks and mortar store. And I'm wondering what you're finding in terms of the shifts that's happening in the market in terms of how people consume. I know maternity is a very specific thing, but when you look at the broader retail space, what have you noticed?
So in the maternity market specifically, a lot of the bigger retailers have actually gone under recently. And I really think it's because they lost touch with their customer. And having started Hatch online and then listening to my consumer in person, hearing what she wanted, and then connecting the dots in person, bringing her the clothes through trunk shows and now in brick and mortar, and connecting the community has really allowed us to follow her along her journey and listen to her along the way. That personalization is what's really vital. And I think that's why Hatch is actually kind of rising as the category leader, because we're working directly with our customers and not assuming that we know what they want without talking to them.
What do you hear from them that they want?
They want to be heard. They want friendship. They want support. This is kind of an unknown time for them. So not only do they want a product that can be sustainable and go the distance, but they also want to know that there's other women going through the same thing that they're going through. And so we connect the dots with, in our brick and mortar stores, we have community events that really unite these women, not only from a shopping standpoint, but from an educational standpoint that makes kind of the whole experience 360.
How important is sort of the social media element as well? When you say you're reaching out to customers and trying to understand where they want to go, obviously the in-person communication is important too, but I wonder, with so many different channels you can tap into, what do you find has been the most effective?
I mean, Instagram has been fantastic for us across the board. I think we have a long way to go on Facebook and really where people are chatting with each other in community spaces. Because it's a small brand that's growing quickly, I'm stacking my team right now with the right talent to help us kind of reach all these different women. But really in person has been the most impactful. And so having this kind of strategy to get grassroots, so to pay on top in an acquisition strategy, but also to get out there and talk to women in real life has been critical to growing a brand.
So going into 2020, what's the growth forecast look like for you? And in this tight labor market, is it challenging to find those people that you're talking about hiring?
There's a lot of wonderful talent out there, and especially with other brands that aren't so fortunate as Hatch is, we're able to kind of reap the benefits of some talent looking for opportunities. In terms of Hatch for the next year, we are planning on growing another 40% year over year, which is really exciting. And we're going to be launching fourth trimester, which is the conversation after baby. It's a time when women really go through some significant moments and nobody really discusses it. So providing products in nursing and transitioning back to work, it's going to be a key focus for us to continue that conversation and LTV with the customer as she goes on.
Ariane Goldman, founder and CEO of Hatch, good to have you here.
Thanks for having me.
Coming up, China is stealing the headlines, but it's the U.S.'s trade deal with Mexico and Canada that could mean big business for American workers. Plus, let's take a look at some of today's most actively traded stocks by volume. Tallgrass Energy higher as it gets taken out by Blackstone. Let's take a look at some trending tickers from YahooFinance.com. We've got Unilever. The shares that trade here in the U.S. are down by almost 9%, and that's after it's cut its sales forecast. It says it's going to be at the lower half of the previously expected range for 2020 as it's been trying to change its product portfolio. But some name brand consumer products just aren't doing as well as they used to. We're also taking a look at Jabil Circuit, if we can find that here on the trending ticker list. Here it is. It is up by 5% today. The contract electronics maker out with its earnings that beat estimates. Revenue up 15.4% and earnings coming in better than had been anticipated. Truck maker Navistar, though, not faring as well. Those shares are down 8%. Its net income falling, revenue missing estimates. Truck revenue down 20%, parts revenue down by 14% here for Navistar. So those shares paying the price today. And if you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
House of Representatives will vote today on a nearly $1.4 trillion spending deal that would fund the government through September 2020 and avert the looming threat of a shutdown. Yahoo Finance's Jessica Smith is in D.C. with the latest for us. Jess, they want to get this out of the way, but setting it up for the election.
Right. They're trying to get this done to avoid a government shutdown when funding runs out on December 20th. They are debating on the House floor right now. They should vote later today. And they released this legislation last night. It totals more than 2,000 pages. There is a lot in it. And I want to go over some of the big provisions in this deal. Federal workers will get a 3.1% pay raise. President Trump and Republicans get nearly $1.4 billion for a border wall. Not as much as the president originally wanted, but more than Democrats wanted to give. And then in a big win for Democrats, the deal includes $25 million for gun violence research. It also raises the age for tobacco products, so cigarettes, e-cigs, vaping products, to 21 years old from 18 years old. It also includes some retirement reforms. And Republicans and Democrats each are claiming victory on certain items, but there are quite a few bipartisan measures in the bill. Still, nobody is completely satisfied, though they do expect the bills to pass. Here's what lawmakers had to say on the House floor today.
This is not the bill I would have written on my own, but I am proud that we have been able to do so much good in this political environment.
While I wish that we had been able to pass all the bills by the beginning of the fiscal year, I'm glad we're going to be able to finish the appropriations process without having to pass another continuing resolution.
If the House does pass these two packages, then the Senate will follow. And White House advisor Kellyanne Conway says that President Trump does plan to sign the legislation. Adam and Julie.
Thanks, Jess. I think when nobody's satisfied in politics, that's usually a sign of success. All right, trade is also in focus today as the House Ways and Means Committee is holding a hearing on the new version of the USMCA trade agreement. A vote's expected in the full House on Thursday. The deal would be a major boon to the economy of states like Ohio, as international trade, including exports and imports, supports about 1.5 million Ohio jobs. Joining us now to discuss is Ohio Lieutenant Governor Jon Husted. Also with us, Yahoo Finance's Adriana Belmonte. Lieutenant Governor, thank you so much for joining us. When you look at NAFTA versus USMCA, what are you most excited about for Ohio in the new legislation that is different from the old law?
Well, I'll tell you what the companies tell me, that they know it needs updated. The intellectual property protections that are in there are important to them. Opening up new markets for dairy and agriculture to Canada that were previously shut off. Those are a couple of the things that I've heard from businesses who have told me why they think it's important. But most of all, they're just mostly want to see it get done so that they can have stability and they know what the rules are so they can move forward.
Can you help us understand, though, exactly what the change is going to mean for men and women who work in heavy manufacturing, say in Ohio? Because the largest percentage, I believe, of the exports has to do with aircraft industry and the automobile industry. So what's really going to change for those folks who live in the Buckeye State?
Well, we think a bigger part of those automobiles need to be sourced within the trading partners, and more of that can happen in the United States, particularly as we're moving to electrically powered vehicles and to the automated driving systems. More of those kinds of things, I think, are the kinds of things that can be produced in Ohio. Everything that relates to the aircraft. Look, you've mentioned auto, aircraft. These are big industry sectors in Ohio, and the businesses who create those jobs in our state want this stability. They have worked with the Trump administration to get their issues addressed, and they are addressed. So as soon as this gets done, the better. More predictability. That's what they want.
Lieutenant Governor, back in July, you had tweeted, "We have a technology-infused economy. We need a trade deal that represents that," when you were talking about getting the USMCA ratified. Do you believe that this current USMCA that will be passed does represent the need for technology?
Yeah, look, the original trade agreement was done before essentially the internet existed and before the smartphone existed, certainly. And there just was nothing in there that was set for the modern economy. These provisions, as I've talked to businesses in our state who are in that space, they believe that this is a modernized trade agreement that addresses those issues.
Lieutenant Governor, one of the, I would argue, more significant changes in the USMCA are the labor protections that are put in place. There are obviously incentives there to make sure, at least on the Mexican side of things, that there are fair costs or equal wages there. And there's labor panels as well. And when you look at the original NAFTA, one of the biggest criticisms was that it drove down the cost of labor and it pushed jobs outside of the U.S. I'm wondering, as a result of some of these provisions in the USMCA, how many jobs do you expect to come back to Ohio?
Well, that's an impossible number for me to predict. I do believe, though, that when you're forcing Mexico to abide by higher labor standards, that creates a more competitive environment for American labor as it relates to Mexico. When you're forcing more portions of, say, automobiles, for example, to be produced, a higher percentage of that in Mexico, in Canada, in the United States, that is a pro-labor agreement. The fact that labor groups got on board with this, the fact that we have a bipartisan vote that we're expecting on this, I think exemplifies the fact that many of those things that people felt in a globalized economy left the working men and women of places like Ohio behind, that much of that has been addressed to their satisfaction. And as with any new agreement, we'll see what the long-term implications are. But when you compare it, because look, this is what we're comparing it to. What was it like versus the old NAFTA? Is it better than the old one? Everybody agrees on labor standards that we're better off.
All right, Ohio Lieutenant Governor Jon Husted, thank you for joining us.
Thank you.
Coming up, don't change. Early Facebook investor Peter Thiel reportedly told the social network not to vet those fake political ads. Plus, take a look at some of today's winners on Wall Street. Let's take a look at the top trending stories on Yahoo Finance right now. Nationwide strikes and protests disrupted schools and travel in France as mass demonstrations crippled cities across the country. The strikes come as unions continue to battle with the government over pension reform. The French official who's leading a controversial pension overhaul actually stepped down as the result of the backlash and the fact that he was working some side jobs. PG&E shares are in the spotlight after announcing that it amended a restructuring plan to advance its $13.5 billion settlement with wildfire victims. This comes despite California Governor Gavin Newsom's view that the plan was non-compliant with state law. PG&E removed a clause from the proposal that required Newsom's approval, but did say it will address his concerns. Here's one for all of you Mariah Carey fans out there. The award-winning singer made history with her 25-year-old holiday hit, All I Want for Christmas, which rocketed to the top of Billboard's Hot 100 chart this week. This marks Carey's 19th #1 hit, and she's just the 4th musician to chart a #1 hit across 3 different decades. We'll be right back.
It's time for our buzzer beater round. 3 stories, 1 minute each. Let's get started with this. Yesterday, the Supreme Court refused to hear a major case on homelessness. The case, which originated in Boise, Idaho, would have protected homeless people's right to sleep in public spaces. So this refusal to hear the case is actually a victory for homeless advocates, because it means that cities, I guess, won't have the power to remove people in all cases.
Yeah, and this means that the Ninth Circuit's Court of Appeals ruling stands, right? I mean, this is something that a lot of Western states have obviously been struggling with. A city like LA, they saw, 16% jump or something like that. It's a tough issue. I think a lot of cities feel like having the homeless out on the streets with more and more of them, they would make an argument that it's a safety issue, but a health issue. But at the same time, where are the shelters? They're not building the shelters quick enough because that homeless population is
Well, and this
growing
doesn't differentiate. The problem here is you've got people who are mentally ill as opposed to people who are economically homeless. Two different sets of people, right? Yeah. And so.
Well, it's not a win for anybody. I mean, it's a sad state of affairs. In San Francisco, of course, they have whole blocks that are basically homeless encampments. The problem continues. Cities are doing a bad job of addressing this problem.
Vox Media is reportedly preparing to lay off hundreds of freelancers in the coming months. This after California legislators passed the Assembly Bill 5. That law forbids non-employees from writing more than 35 articles a year, freelancers essentially. It's set to go into effect in 2020. Anybody want to weigh in on this?
Well, California has, decided what properly defines a freelancer. It seems pretty silly to me that you have to have the government saying this is what this number of articles constitutes a freelancer. We work in the business. It's something you can't really put a number on. But what this means is some people who got some income from this are now not going to get income.
They're going to be limited.
Some will probably, a few will probably get hired as regular employees, but most of them are going to have to give up what basically was independent contractor or gig work. So it'll help a few, hurt more. Doesn't make sense.
And I think it speaks to how wide-reaching this bill is. We talked about it in the context of the gig workers that we usually think of, which is Uber, Lyft, but obviously this is much broader than that. It'd be interesting to see how many employees that a company like Vox actually hires back, though.
Yes, definitely.
It's going to be a small number of everybody
One would
affected.
think so. All right, Peter Thiel reportedly pushed Facebook to not fact-check political ads on Facebook. This, according to the Wall Street Journal. And Thiel, of course, is well-known in conservative circles and therefore has been somewhat controversial in Silicon Valley even before this. My question is, would Facebook have done this anyway, even without Peter Thiel's influence? It doesn't seem like they're making really great decisions on the privacy and fairness front.
Well, I think this speaks to the fact that Facebook is in a bind, right? If you read the Wall Street Journal story, there's clearly a big division on the board. Peter Thiel is sort of the conservative cover that Facebook can point to say we're not biased in one way at a time when they're getting heat from the right to say that their algorithms are skewed towards anti-conservative. At least that's the argument on.
Will he be invited back to the Republican convention? He was there.
Sure he will. So he's a Trump supporter, and Trump is, of all politicians, he's got the most ads on Facebook and probably the most falsehoods, too, because Trump traffics in falsehoods. I would love to see Congress change the law and so that online platforms no longer are exempt from having to vouch for the truthfulness of everything on their sites. We have to abide by that. Traditional media has to abide by that. And I realize there's a volume problem. These sites are not dealing with it, and I would be fine changing the law and force them to deal with it.
Well, once you have as much money as Peter Thiel, you can lobby to that effect, Rick.
I will do just that.
Otherwise, we have no voice.
Speaking of making money, let's take a last look at the markets right now, and you can see that we are back in the green. All 3 indexes are trading higher.
All right, thanks for joining us. Thank you to Rick and to Kiko. Stick around for Wi-Fi PM. That's coming your way next.
It is 1 p.m. in New York City, and all three major indices are in the green, looking to extend a 4-day winning streak as the S&P 500 hits a new record high. On tap for today, Boeing shutting down production of its troubled 737 MAX planes, why the impact of the move extends far beyond the plane manufacturer and why it could dent U.S. GDP by 0.5% next quarter. Plus, as impeachment talk heats up, President Trump is raking in the re-election dollars. We'll have why it could backfire on Dems the longer it drags out. And Americans still procrastinating when it comes to holiday shopping. We'll chat with one startup looking to flip the script to let others pick out their presents first before you even think about what to get them. All that and more. This is Wi-Fi PM. Good afternoon, everybody. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Kristen Myers, along with the Brewer Group CEO and former NFL star Jack Brewer in studio again with us. Always good to see you, man.
Man, I love being here.
It's good times every time you're here. Good to see Kristen as always.
I never get
as
the
well.
kind of warm welcome that Jack gets when he's
well,
in
you know,
his chair.
These things happen. We're going to check the market action we're seeing right now. And right now, as I said, green across the board. The Dow up by about 80 points. The S&P and the NASDAQ in the green as well, though the NASDAQ has paired some of those gains now, inching closer to break even. We'll see what happens throughout the hour. But first, more backlash for Boeing. The airplane maker is now looking to suspend production of new 737 MAX planes come January. And it follows the FAA announcing its review of the aircraft would continue into the new year as well. And Yahoo Finance's Alexis Keenan joins us now with the details. And Alexis, what does this mean for Boeing if they're pushing that out to January now?
It means a lot of things for Boeing, and it means a lot of things for employees. It means a lot of things for suppliers, and it means a lot of things for airlines. So depends which one you want to take first, but let's just go over the basics. This stoppage of the production of the 737 MAX, that will start in January. Boeing is right now saying that it's 12,000 employees that work in the Renton factory where the Boeing 737 is put together. They will not be laid off at this time. They're saying that they will either be relocated or continue to work on the MAX. Also, though, suppliers come into play here, right? There's a very carefully coordinated supply chain that goes along 600 to 700 suppliers that Boeing has in order to assemble this aircraft. And, as Boeing has acted so far, they've continued to produce 42 aircraft per month. That was down from 52 in April. However, they did not let that impact their suppliers so far. So making a lot of calls to suppliers today saying, are you making any changes? Haven't learned of any significant changes yet. Most of the suppliers just saying that they're continuing to monitor the situation. But it'll be really interesting to see whether Boeing will keep those suppliers on pace at that 42 or if some big changes are going to happen.
And you mentioned all the other companies impacted by this as well, the suppliers, airlines. There is really, truly a ripple effect through it. And JP Morgan out with a new note today highlighting a piece of that, saying Boeing will still burn over $1 billion a month even after halting the 737 MAX production. And the spillover effect, when we look at Q1 GDP, could be dented by about 0.5% as well. But I mean, that's a lot of money that Boeing still loses even after this decision.
Yeah, and I've seen some differing opinions from analysts on how much of a GDP impact this would take, though Goldman Sachs estimates that over 5 years before this stoppage happened, that the 737 MAX represented about 33% of production revenues for Boeing. So a huge chunk here, and they certainly have to get back on pace. Most of the analysts that I've read so far have said that once these planes do get delivered into the hands of their customers, that we should see a swing back and that recovery for GDP. But right now, yeah, that 0.5 percentage point is what JP Morgan is saying.
Go ahead, Jack.
I was going to ask, what's it do to the brand? I mean, I hear everyone saying it's like you're just going to turn this switch off and on again. I mean, if you stop production, you got 400 planes sitting in a warehouse still that you haven't delivered. And what does that do to the Chinese companies that are starting to produce planes? And there's other competition that are coming to the market. I know myself personally, I've flown on that Ethiopia flight. And when I saw that plane go down, I'm looking for that plane. I'm not going to fly on that plane again. And I think a lot of consumers are going to feel that same way. So I hope this doesn't just tarnish their brand.
I think that's an excellent point, and there have been some consumer sentiment studies that have, been trying to figure out whether people will get on this plane. I think that that's one of the huge questions that's hanging out there is, will people be willing to fly it, whether it has rebranding or not, right? And if we look at the numbers of how many of those planes, you mentioned 400 of them approximately on the ground, there's some more of those planes on the ground, and those are the ones that have already been delivered to airlines. So right now we have about 370 planes already delivered, grounded, cannot fly, and then the 400 additional, those are the ones that Boeing has produced since the crashes took place. So coming up there, 700 plus aircraft that can't go anywhere, and we don't know when the FAA is going to act either.
Yeah, they got to pay rent for the warehouse. Imagine how big of a warehouse.
Yeah, some of them are outside.
400 planes. Some of them are outside in the lot somewhere.
Still, though, I mean, that's a lot there, and we saw the timeline for all the airlines saying, when is this going to get back in the air? Some more optimistic than others, but right now, it seems to be that date being pushed back and back and back. But Alexis Keenan, thank you so much for bringing us that. Appreciate it. Well, I don't know if you've noticed this over the last couple of days, but we have seen a market rally continuing today. And today, the theme continues of President Trump once again attacking Fed Chair Jerome Powell, tweeting, quote, would be so, 3 O's, great if the Fed would further lower interest rates and quantitative ease. The dollar is very strong against other currencies, and there is almost no inflation. This is the time to do it. Exports would zoom, and it comes after White House economic advisor Larry Kudlow said yesterday that U.S. exports to China will more than double over the next 2 years under the Phase 1 trade deal. Bloomberg reports further details on just how that would happen, saying China plans to restart purchases of ethanol by lifting those trade war tariffs and potentially reroute trade that currently passes through Hong Kong to mainland ports, which could add around $10 billion there, guys. But Jack, I mean, when we've seen this trade deal play out, it's clearly boosted the market. We're on pace right now for a 5-day winning streak. When you look at the overall market action we've been tracking. But I mean, it seems like everyone's buying into this idea. We haven't had a signed trade deal yet, but President Trump said that they have agreed to it. Sounds like the market's buying it.
I would buy it too. Just the fact that from the agricultural side of things, I think that's where you're going to see, the biggest impact. We've given subsidies to the farmers. Some folks on the left complained about it, even though if it was someone on the right doing it, they would have been okay with it. But now that we're seeing that the trade deal actually looks like it's about to happen, potentially $50 billion in agricultural purchase. Obviously, that won't be on paper, but still, I think it gives a big jolt to our ag sector, which is going to stimulate our economy. If they start buying ethanol again in China, that's going to be huge for our farmers here in the U.S.
If.
If.
It's a big if. Yeah, listen, it was great that we were able to achieve the Phase 1 part of the trade deal, but until I see them actually sitting down at a desk and signing it, I'm actually a little bit skeptical because I feel like we've heard good news before and then the rug has been pulled out from underneath us, either on the U.S. side or even the Chinese side. One of the sides does not agree to the text of the document. Even after Trump came out and tweeted and said, oh, well, actually, we have an agreement, the Chinese didn't want to come out and actually confirm some of Trump's tweets. If we remember, then the markets did not react positively to that at all. So even Trump's recent tweets now about, exports zooming if the Fed would lower interest rates again. I'm like, no, the exports would zoom if you would get a trade deal done. So great.
When we talk about it, Jack, I mean, when we talk about let's just go ahead and say we'll assume what we're hearing is true for now and assume that the trade deal is going to be signed in January, as people have hinted towards. But when you look forward to 2020 and the market itself, granted, I'm not entirely sure if Fed Chair Jerome Powell is going to go ahead and cut interest rates. It sounds like they're willing to hold steady here. But Oppenheimer's out with its price call for the S&P 500 in 2020, 3,500, what they are slating right now. That would be a pretty good improvement there for next year. But I mean, when you're seeing this all play out, let's assume that the trade deal gets done. What are your market implications looking forward? Does that sound about right, 3,500 year end?
It does. I think you're gonna see a huge boost, not just here domestically, but this is going to help markets internationally. because I mean, if you just look overall at how we've had this consistent gain throughout the Trump presidency, you're talking about this man is negotiating 4 trade deals, major trade deals. There's never been a president in history to negotiate 4 trade deals through their entire presidency. Nonetheless, first 3 years of their presidency. I mean, this is some historic stuff. I mean, I think our economy is roaring, and if we do get this trade deal done, I hope we do for Americans and for our workers. I mean, this is gonna be unprecedented. I mean, you're gonna see a huge boom. I think as long as the dollar can stay strong, at some point we gotta start getting a little bit weaker. I don't know when that'll be, but I think when you see this UMCA deal come through,
the USMCA deal going through.
When that gets done, I mean, from a manufacturing perspective, that's going to be a huge jolt for us.
It was just kind of shocking to see that get through, despite all the impeachment talk and everything else seeming so divided, to have everyone agree on the USMCA deal to come through. Again, it's hard, I think, to predict what could happen in next year when we talk about stocks, because it's an election year and no one ever really knows what's going to happen in the election year, what happens at the ballot box. But we will see. And right now, Oppenheimer is saying 3,500 for next year. But coming up, why Netflix's The Irishman may have been a bigger bust than initially thought. We'll dig into the new data showing how it could spell trouble for the streaming giant when Wi-Fi PM returns. Welcome back. Netflix is continuing its trend in looking abroad for new subscribers. The streaming giant released new data on its overseas subscribers for the first time yesterday in a new filing, disclosing 90 million subscribers outside of North America. And when you dig into the numbers, you see that Netflix's global revenue growth is also up across all regions year over year, with the biggest jumps in the overseas markets. As you see there, Asia Pacific, a very strong market for Netflix, guys. Of course, the U.S., large in terms of dollars. Growth, though, not so much when you look across the globe.
Right, and that's why they're bundling the United States numbers with Canada. And when it comes to Netflix, and we were talking about this a little bit earlier on AM, it's always like Netflix only likes to release data when they're ready to. And so you should always approach their data releases with like a healthy dose of skepticism. They're like, oh, look at what's great going on over here, so you can ignore the bad news that we have over here to the side. So yeah, it's great. Overseas growth is going well, but here in the United States, they are going to be facing, they are facing actually already, Disney and Apple TV Plus, and their subscriber base is slowing down here at home. And it doesn't seem that they're able to keep pace with a lot of their competitors. So great that they're doing well overseas, but when you start seeing all of these other streaming providers pushing into those regions where Netflix is doing well overseas, I wonder how they're going to be able to maintain that growth over time.
Yeah, and Jack, I mean, the other aspect of this, too, is you can point to these overseas locations doing so great in subscriber growth, but at the end of the day, the amount of dollars they bring in per international subscriber, way below what you get in the U.S.
Way below. And you look at markets, particularly, you see Africa and the Middle East, and I have a little bit of experience over there, but I think that's where they'll see the majority of their growth over time, because they're going to be the first to market in a lot of these places.
Yep.
Places like India is tough for them because there's so much competition already there in that particular continent. But when you talk about Africa, you know, the middle class is growing so fast, and you got other emerging markets that Netflix can really take advantage of. Now, to your point, what will the spreads look like there? You know, will they be able to get the type of margins that they get here in the U.S.? I doubt it, but I think if they strategically place themselves in those markets and start making some acquisitions there, they'll be okay. So I'm not quite as bearish as y'all, but.
Well, I will say this, though, to that point, Netflix, unlike the other providers, is doing very well, at least for the original content from those regions. Right. I mean, if you go on Netflix now, just the amount of documentaries or films or shows that are African, right, centered.
That's right.
That's going to get subscribers in that area. Asian content is also much bigger on Netflix than you do see on the other platforms and the other providers.
Sure.
So if they can position themselves well to really hold off the competition overseas, maybe.
And they have enough cash to do it.
Well, that's a question mark, too, because I want to get into that, because we have seen them spend a lot here in the U.S. Of course, the size of the prize is rather large.
You just want to bash the Irishman and go on.
Well, hold on. I'm just saying here. Let's just say. Let's dissect this, though, because, yes, given the U.S. is the biggest pie for Netflix, it's not surprising that they continue to spend heavily on content here at home. But as evidenced by the Scorsese mob film The Irishman, new numbers suggest it might not be as big of a deal for Netflix as we initially thought. Netflix announced the film garnered streams from 26.4 million households globally in its first week and estimates 40 million streams for its first month. That would fall nearly 50% below the numbers posted by Bird Box at 45.3 million households in week one and 80 million in a month, which is problematic from a dollar perspective, given The Irishman cost Netflix roughly 8 times as much to produce at a nearly $160 million budget. And you can say that's fine. They're just paying for the hype and the end goal of acquiring subscribers. But new figures from Seven Park Data shows that The Irishman, despite all the hype, actually led to fewer subscribers than Bird Box. Using a ratio of new U.S. signups to viewership as an assessment for the movie's performance, The Irishman again got bested by Bird Box by a slight margin, 8.2% to 8.6% advantage. Bird Box. And guys, I know you could say, look, Bird Box was a hit, and it caused a whole storm, everyone covering up their eyes.
It went viral.
Every kid running around.
The Bird Box challenge.
And I understand.
It did not exist with The Irishman. The challenge with The Irishman was just getting through it.
Yes, that's a big problem.
All 3.5 hours. That was The Irishman challenge.
Yeah, that was. Can you sit in the chair for 4 hours?
Can you watch it?
But I mean, the thing is, if you're going to spend that much money, I always thought Netflix's real kind of competitive advantage here was that it was a tech company. It was smart. It knew what to spend on. It seemed like a studio move for me, looking at it, just saying we'll spend a lot of money on Scorsese. And I understand the hype, Golden Globes, whatever might come after that. But still, at the end of the day, $12 billion in long-term debt, that number continues to rise. If they're just going to go out and spend like a studio does and just throw money at stars, I just don't see that as sustainable when they're going up against the likes of Disney and some of these other studios.
I don't think that'll be their model going forward. I think you'll see one of these every year or two. But I think their model is going to be to start acquiring more content, because now the actual cost to produce content is going down around the world. And I think as long as that happens and Netflix is smart about their acquisitions, they'll be okay.
If they're smart about doing another Bird Box.
Right, but what acquisition, because you see a lot of the big content providers that Netflix used to purchase from, they're yanking their shows, they're yanking their films, they're yanking the rights. Marvel was yanked, obviously. Disney yanked that straight away from Netflix. Netflix had to go and cancel a bunch of shows and a bunch of their original content because they lost some of those rights. I mean, is this now a great era for those small production studios to get involved? I mean,
100%.
The big players are just taking their content away. I think we talked about this when Netflix started to get into original content, because to your point, Zach, it's a tech company. It did not start out it didn't start out as a studio.
Yeah.
It did not start out as a content creator, and you're seeing them kind of coming from behind on that aspect. I mean, they do have some wins. House of Cards was a huge win for them. Stranger Things, another huge win for them, but they can't keep throwing money at the wall like some of these big studio players can.
All I'm saying is we've had Ross Gerber on the show before, seemingly a Netflix permabull, but he has shifted increasingly every time to Disney, and I've seen a lot of investors make a similar move as we see Netflix, the amount of debt they have on their balance sheet, what
Disney,
they're going up against.
To that point, Disney, unlike Netflix, has distribution and the knowledge and the know-how in that Netflix doesn't. I mean, Disney already has all those relationships with with theaters and the, coming up with like toys and products, to match the shows that they're putting out. I mean, Baby Yoda is like on back order.
Baby Yoda, constantly on back order. The biggest
And it's
star
not
of
even
2019.
being sold yet.
Yeah, I'm just saying.
If I'm Netflix, I start putting my movies in the theater first and then bring it to my.
Yeah, they've been trying.
Tried.
They've been trying.
They
We'll
can keep
see.
trying. They'll figure it out.
We'll see if they can do it in 2020 again. For now, though, The Irishman, kind of big whiff. Just after the break, the House voting on a $1.4 trillion budget deal to avoid another shutdown as the Trump impeachment battle heats up. Why it's already backfiring on Dems when it comes to GOP fundraising. Wi-Fi PM is back in 2. Welcome back to Wi-Fi PM. We are checking the market action right now. Still green across the board, though the NASDAQ is the closest to dipping in the red. You can see the Dow leading the way higher, up 60 points on the day so far. We'll see what happens throughout our hour. Well, Congress is racing to pass a 2020 spending agreement, and the House is set to vote today on a $1.4 trillion deal to avoid another government shutdown. The new bill is expected to have implications on everything from taxes to tobacco. And Yahoo Finance's Jessica Smith joins us now in D.C. with the details. And Jessica, government funding runs out on Saturday, so this is a spending bill that is needed, but is it expected to pass?
Lawmakers do expect these two bills to pass. And legislators have been working on this for quite a while. They released the legislation last night. It's more than 2,000 pages long, and it's divided up into two packages. And I want to go over what's in some of those. You can see a 3.1% raise for federal workers, also nearly $1.4 billion for President Trump's border wall. That's more than Democrats wanted to give, but not quite as much as the president had originally wanted. There's also some taxes that are meant to support the Affordable Care Act that are going to be repealed, and then it reauthorizes the Ex-Im Bank. There is a big win for Democratic lawmakers. $25 million is going to go toward gun violence research, $425 million for election security, and then it raises the tobacco age from 18 to 21, and it also has the Secure Act, so some retirement savings reform in the two bills. Now, not every lawmaker is completely satisfied. While there are some bipartisan measures here, and Republicans and Democrats can each claim victory, nobody's completely satisfied. So here's what lawmakers had to say on the House floor earlier today.
This is not the bill I would have written on my own, but I am proud that we have been able to do so so much good in this political environment.
While I wish that we had been able to pass all the bills by the beginning of the fiscal year, I'm glad we're going to be able to finish the appropriations process without having to pass another continuing resolution.
Now, lawmakers are still debating on the House floor now, but it looks like they're wrapping up and they should vote pretty soon. And then the Senate will follow in the next couple days. White House advisor Kellyanne Conway did tell reporters this morning that the president is expected to sign this legislation. Zach?
All right, Jessica Smith bringing us the latest from Washington, D.C. Jack, I know you were applauding there when she was describing some of the things included in that bill as it stands right now, the tobacco age going up from 18 to 21.
Amen. Amen. Kids don't need to be smoking when they're 18 years old, in my opinion. I mean, we have healthcare costs that are screaming up, but yet we allow people to smoke what they want to smoke, eat what they want to eat, but then we want to rely on the government to pay for our health care when we're not taking care of ourselves. I don't agree with that. So I'm very glad to see them raising that age limit up, and I wish it would go up even higher.
I'm stunned.
Why?
Because I thought Jack here wouldn't be a fan of big government telling us that we have to wait until we're 21 in order to smoke. I just think
if we didn't depend on government for health care, I wouldn't.
That's true. It is shifting that way. It is shifting that way.
I wouldn't mind. But if we want to depend on government for health care, that means you should eat right and take care of yourself.
if you can be tried as an adult at 18, if you can go fight for our country at the age of 18, you should be able to smoke a cigarette and have a beer at 18.
It seems like the Twilight Zone. I'm confused here because normally you guys are on different positions here.
I know, right?
But this is one too that we've seen, especially with the vaping epidemic in 2019, kind of the push, even Juul kind of pushing for the vaping age to be raised from 18 to 21. Purchase of tobacco age should be raised from 18 to 21. That is something that's gotten a lot of attention. Some of those other pieces in there as well. Kind of status quo when we look at the budget, especially when it comes to President Trump's border wall, maintaining pretty much the level of funding that was slated to go towards that.
Less money than he was looking for. Look, this bill is actually pretty interesting, I think, this year, because normally every year we talk a lot about the spending bill. It's something that is usually very heavily politicized. This year, however, you have the impeachment inquiry, I think, not even the inquiry, the impeachment vote actually overshadowing this vote a little bit. And as everyone heard, they said, this isn't the bill I would have written, but I'm glad we got some bipartisanship done. Great, I'm glad. That's what compromise is. It means both sides are equally unhappy with the outcome.
Yeah, I almost wonder.
But that's what Congress is supposed to do. They're supposed to come to the table. They're supposed to cobble something together. It's not supposed to be a pure Democratic victory or a pure Republican victory. It's supposed to be both sides working together to get a bill done.
And I almost wonder if the impeachment inquiry hanging overhead, as you said, actually made it easier to get the spending bill through because everyone else is kind of distracted a bit. But let's focus on the impeachment inquiry right now because the GOP is looking to monetize on President Trump's possible impeachment. And Axios is reporting that the Republican National Committee has seen over 600,000 new donors since the start of that impeachment inquiry, with the Trump campaign and the RNC taking home more than $10 million in small dollar donations last week alone, following House Dems' adoption of 2 articles of impeachment. Kristen, I know that you always keep a close eye on funding numbers. I mean, President Trump has texted his base. I mean, we've seen it from his election campaign.
I've got it right here on my
phone. The Impeachment Defense Fund.
Right here on my phone. I mean, obstruction of Congress and abuse of power, political madness. This is too critical to sit out. Donate in the next 24 hours in the midst of impeachment lies. I'm counting on my donors. Stand with me and get your name engraved on our 2019 donor wall. I still don't entirely know what that means, where this donor wall exists. I know he's previously done this in Trump Tower, but no, we've talked about this a lot. Donald Trump kills it at the fundraising game. I mean, whatever your politics are, you have to give this man credit. He is very, very good at motivating his base and motivating small dollar donors to give to him. And when it comes to the impeachment inquiry, he is coming out and he is saying, guys, I need money. Join my impeachment defense fund, get your name engraved on a wall, and people obviously are giving money. Now, Democrats, on the flip side, while they are getting a boost in the fundraising numbers, they are not hanging fundraising on the hook of impeachment.
Yeah, well, that's also the idea, is that it could backfire extremely poorly for the Democrats when you think about, even if it was, right? Even if you have this go well and you're able to raise money, you're still splitting that amongst all the candidates that are still running right now on the Democratic side and everyone else on the other side of the aisle, going straight into one-man President Donald Trump.
Yep, that's what's so scary about it is you look at those Democrats, I think there's 17 in key states that have voted for impeachment, and people are at their throats right now because impeachment is a serious thing. It should be bipartisan. There should not be a partisan impeachment. I mean, those two words just are oxymorons. And so, it is scary to see that, and I think, our country is not as divided as we want to think it is. There's a lot of people who have common sense. The folks that want to impeach Donald Trump hate him. They're impeaching him because they hate him. Because there's been presidents all throughout history of time that have done things way worse than what Donald Trump has done. So it is what it is.
Okay, well, speaking about that, latest polls show that half the country actually supports impeachment. So there's bipartisanship for you.
I mean half the country wanted to impeach him the second that he went to office. That hadn't changed.
I agree with you that no one should be using an impeachment process to get rid of a president that they do not like. However, when the president decides to actually break the law, and commit impeachable offenses, which, by the way, because I've asked lawyers this, impeachable offenses is just what Congress says is impeachable. There's no list of things that the president does and they say, that's automatically an impeachment.
You're setting the precedent.
Congress has impeached a Democratic president, Bill Clinton, most recently, and now they're going to impeach. Well, chances are they will likely impeach now.
What's also interesting, too, is if you're saying that, people are impeaching President Donald Trump because they hate him, you do wonder about the flip side, which is presented people rushing to defend President Donald Trump because they love him. And that being one of those things where a lot of people are watching this play out and saying, look, if you're a congressman, you've got to do your duty and hold up to knowing the facts and looking into everything and be 100% unbiased here before you come to conclusions.
All I say, Zach, is if you treat everybody the same on the same playing field, I can listen to you.
Yeah.
But when you don't get upset that our FBI is targeting people and lying and changing documents and doing things out of bounds like it's the J. Edgar Hoover FBI, and you don't get upset about it, whenever you have the former vice president and his son enriching themselves and you don't get mad about that, then you can't get mad about this man wanting to hold up some funds to Ukraine if he actually did that for that reason. All I'm saying is just treat everybody the same.
Your argument
analyze everyone the same.
Your argument can't be he might have committed an impeachable offense, but we shouldn't impeach him because other people are doing things
I said if
that are
he
shady.
did.
That's not an argument.
But you can't prove that he did. It's not. I
think we're about to hear.
The president has the right to give aid when he feels he should. We have
withholding aid though is a different.
I was going to say, I know we got to go to break, but we have to put this out there. The president is allowed to make some of these decisions. The president, however, is not allowed to use a foreign government for his own personal benefit and his own personal.
Here's what I will say though. This is kind of proving the whole point.
Out corruption.
This is kind of proving the whole point though, right here, is that it clearly there's a lot of rage to go around, frustration to go around, where you're seeing things happen in D.C. And this is exactly, I think, the reason why we're seeing so much money flow into this right now. Kind of proves the whole point, which is exactly what we're talking about. President Donald Trump able to capitalize on all this. Democrats splitting it up amongst all their many candidates. Got to take a quick break. We're back with the market's biggest movers on Wi-Fi PM right after this. All right, let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
All right, Zach, I want to bring your attention to shares of Boeing. We've been talking about it all day. The stock holding up rather nicely given all the negative headlines surrounding the stock. Right now it's up about 0.3%, trading just below $330 a share. You know, earlier this morning it approached $321 a share, which is $1 above the low for Boeing stock since the recent March 737 MAX crash. That low came on August 14th at about $320 a share. And earlier this morning, Boeing stock did fall into the red for the year. It's now back in the green for 2019. But of course, Boeing has a huge weight within the Dow Jones Industrial Average. So the stability in Boeing stock right now is keeping the Dow not just in the green, but also at another record high. But there are a couple other stocks we're watching today, including Goldman Sachs, which saw its price target raised by the analysts at Wells Fargo, including Mike Mayo, who is bullish on the outlook for the company amid its new management team, which of course has been there for a year. And then finally, Unilever shares getting hit today. The stock is down about 9% right now after it announced that it will not meet its 2019 sales targets amid some economic headwinds in South Asia. Zach.
All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But next on Wi-Fi PM, Bitcoin plummeting back below $7,000 a coin. We'll have what's causing that move. Plus, a weed analyst out with a new note saying one cannabis giant, Aurora Cannabis, could go to zero next year. The alarming call when we're back in 60 seconds. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Kristen Myers, along with the Brewer Group CEO and former NFL player Jack Brewer, along with us in studio. I want to take a look at the market action we're seeing right now, ladies and gents, and we can see green across the board. Though the gains across that board have kind of paired since we started the show, the NASDAQ now up just 4 points, the Dow up 44. We'll see what happens in Act 2 of Wi-Fi PM. We're also watching Bitcoin today as the cryptocurrency hits a 3-week low, dipping below the $7,000 mark, and it comes as digital tokens across the board, including Ethereum, Ripple, and Litecoin, are also trading lower, wiping billions of dollars from the combined cryptocurrency market cap. Guys, researchers are pointing to a $2 billion scam in China that may be causing some short-term price drops here, as well as some people implicated or a piece of that scam try to offload some of their cryptocurrency here. We've seen that before, but China being the main driver here.
A Ponzi scheme, actually. They were selling stolen cryptocurrency, and they had to drag them from Vanuatu back to China.
Surprise, surprise.
Here's the thing. So Bitcoin usually, when they experience drops, there's like a couple of factors that go into it, but this is just like that one thing really that seems to be driving the price lower, which for me, people are usually go to cryptocurrencies as an alternative asset class because it is supposed to be safe, and because things like this Ponzi scheme essentially, they're not supposed to happen. I don't know why people enjoy investing so heavily in cryptocurrency, knowing the volatility and now knowing that one singular event like this could cause the price of your asset to just decline.
I think what you're talking
massively.
about, are you talking about, because a lot of people do tie scams in crypto together because of what we've seen over and over and over again of some of these coins and people peddling some coins that maybe you never heard of, guaranteeing returns. We have seen that theme play out in the crypto space. But you're right, in terms of volatility, it has come down quite a bit from what we saw before. And despite the fact that Bitcoin's now below $7,000, still when you look over the last year, up about 100%, Jack. So, I mean, it is still one of those assets out there that, you just got to have a little bit longer time horizon, still intact.
You know what? It scares me, though, because anytime you see the market roaring like we're seeing and the economy going like it is, to see any type of investment vehicle that's on the decline right now is scary. And it is. It's up, up 100%, but it crashed all the way down to 3,000 from like 15,000. I mean, so, that's not good. I would stay away from it. I have invested in it before, but I completely agree with you, because when I originally started investing in Bitcoin, I thought, transparency, you're going to be able to see everything. No one can ever break in and do anything to it. Baloney.
Blockchain tech was supposed to be the savior. It was
supposed to be bulletproof.
Right.
Yeah, I mean,
it's not.
Well, it doesn't stop people from, making poor decisions. It's still, at the end of the day, a currency, and you can get scammed using dollars, Bitcoin, whatever you want to use.
Spooky. Me and Jack are on one side of the table,
and I'm on the other. I'll take the other. Listen, I'll take the other on this one.
Never happened before.
I'll take the other. I'm just saying. You
got a conservative and a liberal together. America, this is what we need to see.
Maybe that's just what cryptocurrency will do. It brings people together. All right. Well, one space that is almost just as hotly contested, to be quite honest with you, is the cannabis space. And today we're watching Aurora Cannabis, and the stock is plummeting today, now down about 8% after a GLJ research analyst initiated his coverage of the company with a $0 price target and a sell rating. The analyst says he believes Aurora's equity holds no value, and it's facing a liquidity crunch, potentially running out of cash come July. That's problematic for a number of reasons there, Jack. I mean, we've covered the cannabis space here. No doubt 2019's been a tough year, but saying that a company is going to run out of money by July is not a good thing. And it's definitely not as well capitalized as its competitor, Canopy Growth, sitting on $2 billion American, whereas Aurora does only have about $150 million in the bank.
It is scary. When the cannabis boom first started, I thought these companies were going to be piling and just having stockpiles of cash. But they're having trouble, man, because it's so expensive. You have to invest, in your growth. You got to invest in all these facilities. And competition is coming up. And if you look across the board, I have a couple of friends that are a part of both of the largest companies. And you see what they're trying to do. They're scrambling. They're scrambling to open enough facilities. They're scrambling to be able to take enough oil and contract it out of these plants. So there's a lot of issues that still have to go on. This industry needs time to develop.
And a lot of people
have to understand
and
that.
I mean, this analyst kind of pointing out that some companies might not have that time because, as we talk about it, I mean, the Safe Banking Act was passed in the House, still waiting in the Senate. But that's one of those acts, one of those bills that's kind of addressing the heart of the problem, where these companies, it's hard to raise money if you're a cannabis company, and it's also hard to manage all the cash that you're getting from people buying your products because you can't actually use what a traditional bank. Yeah, you can't use it like a traditional company would. So I mean, that clearly, I guess, being a headwind. Unless it gets solved moving forward into 2020.
I mean, just one of the many headwinds. I mean, Jack's right. Cannabis stocks are literally almost the definition of the long game. I mean, we talk a lot, obviously, there's a lot of stocks that people need to hold for quite a bit of time, but cannabis stocks, absolutely. When you want to talk about headwinds, there's the regulatory hurdles that you have facing here in the United States. And that's just not even the banking industry, that's also the legality around recreational marijuana use, CBD, if you can even use that in foods, like that's not fully regulated yet by the FDA. Then you also have the black market still continuing to completely undercut in those areas where recreational marijuana is able to be legally bought. Then you also have the products, there are not enough stores. So that they have a backlog in some areas of some of their products that they are able to sell. I mean, the headwinds just keep piling on and they just keep spending more cash to position themselves for when all of those floodgates do eventually.
But eventually, if you do hit a liquidity crunch, then there is a problem there. But there is also kind of that aspect. If you are saying hold on for the long run here, that is one of those things where it's like we try and warn people who watch the show, investors across the board, don't put all your eggs into one basket and don't do it all at once, because if you do have this, you're caught in that weird position, uncomfortable position of, all right, maybe I just eat my losses here because who knows where it could go from here. And that's why we always try and warn. It's fitting that it follows crypto. don't gamble with more than you're actually comfortable losing.
Analysts always say, listen, if you're going to be putting your money in this area, you have to be prepared to hold on to it for quite a bit of time.
Yeah, for sure. All right, well, there you go. Cannabis and crypto, both very interesting sectors, both ones that are potentially coming into some problems here as we wrap up 2019. But after the break, Americans procrastinating again on shopping for the holidays. We'll have how you stack up against the norm when we talk about people delaying longer and longer, and why one startup is looking to make the whole process easier by letting others pick out the gifts themselves when Wi-Fi PM returns. Welcome back. Holiday shopping season is headed into the home stretch, but not everyone has their gifts wrapped and ready to go. According to new data from Prosper Insights, and analysts find that majority of shoppers are falling behind. As of last week, 61.4% of consumers surveyed said they had completed 3/4 of their shopping for the year, while a shocking, I don't know if this is that shocking, 1 in 7 admitted they haven't even started to shop for holiday gifts yet. I am in that camp. But if you're crunched for time and just out of ideas, online gift-giving platform Loop&Tie lets the recipient choose their own holiday present. And join us now is Loop&Tie founder Sarah Rodell. Sarah, it's good to see you.
I'm happy to be here.
Thank you for being here. When we look at this, it's an interesting idea because it's almost like a wedding registry for every gift you'll ever buy in your life.
Exactly.
So you're letting people choose here.
Yes, the idea is the gift-giving process can be very challenging. So we wanted to reduce gifting to just that intention of I want to do a nice thing for someone and let the recipient pick out the gift that they want. And the whole process is kind of like taking the recipient shopping.
It kind of seems like a gift card approach, right? You don't know what to get them. You don't want to think about that idea too hard, or maybe you're just completely lost. Why is this better than just throwing a gift card out?
I think we're kind of like the gift card's classy cousin. You know, gift cards are very transactional. It's I love you $50 worth, you know? And the whole idea with Loop&Tie is you're treating someone to this experience that it feels like you're taking them shopping. So the recipient never knows how much you spent on them. They're welcomed into this world where they get to choose what they want, and all of the items are sourced from small businesses and independent makers. And a big mission that we have is essentially making a market between the buying power of either companies or individuals and these small niche businesses that may be hard to discover. And our premise is that when you send choice, you totally change the set of goods that can be transacted.
Got it.
So, okay, so I get it. So it's not, I'm not giving you a gift card and I say to you, oh, you only have $75 to spend. I go onto your website, I say I want to give a gift that's 25 or less, 50 or less, 75 or less, and then the recipient can only choose one or multiples until they hit the target. I mean,
so it's only choosing one. So that was an important part of the process where when if we want it to be price blind, we have to make sure that the recipient is only getting to pick one item, and the whole process is around the stories, right? So they can click in, see the story behind the maker, and figure out whatever is something that they actually want in their lives. So reduces returns as well.
Yeah, well, I mean, that's key, because you never want to get a bad gift, and I'm not saying I got one, but, you know.
This is genius. First off, how do I invest in this?
I like where your head's
You have our
at.
first deal here.
This is genius. Think about how many gift cards go to waste, and people don't even end up spending them. So now, I mean, I can guarantee you, if you give someone a gift like this, they are going to go online and buy them something cool. I think it's genius. You just changed my whole perspective. So I'll just let you know, I shop one day before Christmas. Christmas
Wait,
Eve.
you do Christmas
I
Eve?
go-
What's even
Christmas
open
Eve.
on You're that
Let
guy.
me finish. I go to the mall at 9 a.m. and I'm done by noon. And there's hardly anyone in there at 9 a.m.
Listen, man, that's
Eve,
kind
and
of,
I'm
I
done
like
by
to
Shorten
noon.
that time, Jack?
I like to
Now,
cut.
you have to just
Now
go
I'm
online.
shortening it even more. I love you.
Listen, I don't know, man. I like cutting it close, but 9 a.m. on Christmas Eve,
Trust
there's
me, no
nothing
one's
left in the
there.
store. There's
No
nothing
one's there.
left in the
It's peaceful. And the people in the store, they know me now.
Oh, yeah,
Go
well,
to
now.
3 different
They're
stores.
like, hurry up.
Yeah, Jack, you're here. Welcome. We're waiting on you.
You don't buy online?
No.
Yeah.
I go into the store in Boca Mall, and I'll see y'all, 24th. You know I'm coming.
And no, now you'll see him.
I hope you have my name on your.
Yeah, well, if
You know
not,
what? Now I will, because you know what?
Exactly, loop and tie.
Loop and tie, I'm buying both of you a gift.
Yeah, I'm going to hold you to that because, I don't like liars on this show, but Sarah Riddell, thank you so much. I appreciate you coming in.
Thank you for having me.
Appreciate it. Very exciting stuff. Clearly, Jack is on board. There you go.
I'm all in.
Yeah, but coming up, the chicken sandwich wars are getting downright nasty. We'll have the latest taunt from Popeyes directed at its main competition right after this. Welcome back to Wi-Fi PM. We are checking the market action right now, and it's pretty much the same as when we opened the show here, though we have paired a bit of the gains. The Dow up just 42 points and the NASDAQ up by about 6. We'll see what happens as we approach 2 p.m. Eastern time. Well, the chicken sandwich wars are still raging on after Popeyes poked fun. That's a tough alliteration right there. Popeyes poked fun at fast food competitor Chick-fil-A. The restaurant chain is running classified ads in the New York Times, New York Post, Boston Globe, the Miami Herald, seeking applicants who can work Sundays, wink, wink, and who have experience prepping chicken sandwiches. Guys, of course, Chick-fil-A is famously closed on Sundays. To me, this is taking it a step beyond just the banter that we saw on Twitter before, saying our sandwich is better, your sandwich is better. It's kind of taking a shot at why Chick-fil-A is closed on Sundays, which is because, of course, the owner's religious reasons of wanting to let everyone kind of have that day off.
You go first.
I think that's, a stretch. I think it's just like, hey, do you want to eat a chicken sandwich? And is it Sunday? Come to Popeyes.
I'm just saying, you play with fire. You run the potential of starting to get burned here because we have seen this kind of playful banter back and forth. But at some point, there has to be a breaking point, in my opinion.
Now, I agree with you. Listen, and I'm a believer, and I believe in Christ, and I'm a follower of Jesus. So I respect Chick-fil-A for sacrificing for their belief, sacrificing money. So I think it's off limits. Joke and poke fun, make a sandwich, compete, do all of that. But when it comes to religion, let people do what they want to do.
Yeah, like the Sunday thing, clearly it's a shot at Chick-fil-A. We've seen other sandwiches come out and get in on this. Though I will say, the Popeyes chicken sandwich, we've had it on the show, phenomenal. So we'll just address things.
The seasoning is off the chain.
I'm just going to address things.
I still find Wendy's to be the underrated winner of the
It was actually underrated in our Heidi Chung, who's now...
Spicy chicken sandwich,
the
though, right?
spicy chicken sandwich at Wendy's.
Yes.
No one gives it enough credit, I think it is actually better than the Popeyes chicken
Which is actually quite surprising, considering Wendy's is normally the most vocal when it comes to social media. Surprising to not see them more in it when we're talking about all these things. But for now, Popeyes and Chick-fil-A going tit for tat. I want to thank Jack Brewer for coming back. Always good to see you, man. Happy holidays. Merry Christmas if I don't see you beforehand. Chris Myers, thank you for being here as well. I'll be sure to thank you again off the top of the show next time. But stay tuned to Yahoo Finance. We're headed to the New York Stock Exchange in 60 seconds time. Let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
All right, Zach, thank you. I am joined now by Matt Cheslock of Virtue Financial. Okay, so record highs again. Stocks are rising because of trade. Is that the narrative right now?
I guess it's a Santa Claus rally. I mean, all things right now are fairly positive. We've got all the stuff that's going on with the House. That's not affecting the market at all right now. So I think you've got to pinpoint it and say, you know what? It's not the Fed. It's not earnings. We're all past all that. It's got to be trade talk.
So really a mirror image of what we saw a year ago at this time.
Yeah, you know, I mean, last year it felt painful in the beginning of December. It felt really painful. We had that sharp rally on Christmas Eve that took us to where we are now. So, you know, it's pretty close. The fear was at the beginning of December that we were going to have the same meltdown. We just haven't had it. We are at all-time highs. What happens if we get to Christmas Eve and maybe go the other way this year, you know, trading off all-time highs? So, you know, a lot to be thankful for this year, but right now, not much going on.
Well, yeah, the Christmas Eve last year was a big decline, and then a few days after that, we had a nice rebound.
Yeah, the big rally, and that, you know, you need that massive sell-off at that point. You need to get that fear out. It was done, and then we had the huge move higher. You know, hopefully that doesn't happen in the reverse this year, where we're trading at all-time highs. You know, like keep going, and then maybe we sell off on some kind of news. But right now, it doesn't seem like it's going to be out there. Politics is going to be out of the way this week. We'll be able to focus on continuing the Santa Claus rally.
Well, and I've been asking this to quite a few different people. You know, normally this time of year you see tax loss selling, right, where people sell their losers. But really, at this time, given the market's gain, a lot of people don't have many losers in their portfolio. So maybe there's no tax loss selling right now.
Well, you know what? I mean, not as much as normally would be the case. You know, I think people are afraid to sell their winners too because they're forecasting a good 2020 going forward, at least the first half of the year. So you want to take part of that. You don't want to be chasing returns like some people did this year. You know, there was so much angst and worry at the beginning of the year about so many rate hikes. People were chasing returns at the end of the year. You want to ride those winners in early 2020 and see what the election's going to bring in the second half of the year.
Yeah. All right, Matt Cheslock, always great to see you. Thank you so much. Zach, we'll send it back to you.
Coming up, FedEx reports earnings after the bell, how new competition from Amazon could apply some pressure. The ticker all over it starts in 2.
afternoon and welcome to the ticker on Yahoo Finance. I'm Shauna Smith. We are breaking down the biggest stocks to watch today. As there is green across the screen, the Dow is up 48 points. The biggest winners in the Dow so far today. Home Depot, that stock up just around 1.5%. We also have Johnson & Johnson. We'll talk a little bit about that stock here in just a few minutes. It's up just around 1.4%. The S&P and NASDAQ also holding on to gains. Let's start with our big three tickers. We have Boeing climbing into the green despite announcing that it will suspend 737 MAX jet production in January. We also have Apple's iPhone sales plunging in China last month. This is according to a new report. And 2020 may prove to be a big year for Johnson & Johnson stock. That's according to one major bank. Well, first, let's get to the latest on Boeing today. It announced that it will suspend production of its 737 MAX jets next month. Now, this comes after the FAA said that its review of the planes would extend into next year. Emily McCormick is with me to break down what all of this means. And Emily, just what's interesting to me, the one thing that's sticking out is the fact that we're not seeing the stock decline today. What's going on with that?
Well, Shauna, we really saw the big decline in the stock yesterday. Boeing stock off about 4% after the Wall Street Journal first reported, citing people familiar with the matter, that Boeing was poised to really cut production and bring that to a halt for the 737 MAX. Of course, that plane grounded since March following two deadly crashes. Today, seeing a much more muted stock reaction, but we did see the stock briefly go negative on the year. That's something we haven't seen really at all, even as these events have unfolded since mid-March. Really, Boeing had been holding on to those year-to-date gains because of the duopoly that it holds in that single-aisle aircraft space along with Airbus. Investors had really always been skeptical of Boeing's timeline to get that approval by the end of the year, even as Boeing had been pushing that for about the past 6 months. It's been largely implied that the delays in the MAX's return would likely include production cuts. Now we have confirmation of that. We did have a note today from Credit Suisse saying that this was one of 3 outcomes that had really been priced into the stock and anticipated by markets heading into Boeing's December board meeting. The other 2 would have been just a mild decrease in production or a cut to the dividend. Neither of those 2 actually played out, but we did get one of the 3 that had been anticipated manifest.
Emily, there was another note that caught my attention. It was from JP Morgan today. They cut their price target on the stock, and they also said that they expect Boeing to still have a cash burn rate of just around $1 billion per month. So when you take a look at that, that's a little concerning out there for investors.
Definitely. If we look at Boeing's third quarter, they saw operating cash flow at negative $2.42 billion. That was even worse than its results in the doldrums of the 2008 global financial crisis. So really the financial impact from the 737 MAX groundings has been substantial. This is exactly what JP Morgan had to say. They said, quote, "We estimate that Boeing is burning nearly $2 billion per month on the MAX, but this will not drop to zero during the halt. We expect Boeing to support suppliers, which comprise about 65% of the 737 cost base, in order to preserve labor and production capabilities. For now, we assume about 50% of supply chain costs hang around, resulting in monthly cash burn that is still solidly greater than $1 billion. So still seeing that impact to the financials on Boeing's end.
Yeah, Emily, you mentioned the suppliers there. We also need to talk about the airlines because we just had Southwest canceling their 737 MAX flights through the end of April. They're joining American, who already did this. So there is some concern there just in terms of what that could mean for some of these airlines.
Right, but the good thing that we've seen on Southwest's end, at least, is that because they've been so conservative in really predicting when the 737 MAX would be back in commission, they haven't seen quite the impact to their stock that Boeing has. So Southwest stock is still up 17.5% for the year to date, underperforming the S&P 500, but definitely outperforming Boeing, which is up just about 1% for the year. Again, as you mentioned, joining American as another domestic carrier that has been grounding the flights longer than originally anticipated. Again, Boeing is really at the mercy of the FAA here and whatever their regulatory timeline is for getting these planes back in the air.
All right, Emily, thank you. Well, big warning for Apple today. In a note this morning, Rosenblatt Securities warning that iPhone sales are falling in China. Now, the firm saying that sales dropped 30% from a year ago as consumers buy cheaper phones from some of their competitors. Jared Blickery is with me. And Jared, we talk about the fact that China is so key just in terms of Apple's future growth. How big of a headwind do you think this is for the company?
I could see this going two different ways. So there has been a rise in competitors and adoption of, say, Huawei and Xiaomi in China. And Apple really doesn't have the pricing power that it used to, not only in China, but the US. And so the expectation that they could drop by, let's say, iPhone 11 sales as much as 60% year over year in the quarter ended March, or even just for overall iPhone sales to drop 40%, those are huge numbers. But also we have 5G coming into the mix. Apple hasn't deployed anything yet because the technology isn't really there. Most analysts agree that it was right to delay, but you're going to see this huge product upcycle here when people finally adopt 5G. And look, the share price isn't really being affected today by this analyst note. It's up 0.3%, and we can look at the year to date. It's up 78%. If we recall what happened just about 1 year ago, it was only the second trading day of the year. Apple pre-guided and the stock dropped about 10%. Everybody was scared that it was going to fall off a cliff, and look what happened afterwards.
And Jared, we talk about the fact that the stock is up, 77% so far this year. It's interesting because some people on the street are saying that, hey, maybe this run will be coming to some sort of end soon. But then on the same day that we got that other note, we have a Cowen out today saying that Apple is one of its favorite ideas for 2020, and they actually upped their price target to $325. So they still think that the stock has some room to run.
Yeah, 325. That's quite a bit higher. That would be right about here. And for the other side of the coin here is that the other price target was 150. So that's a street low. Look at the disparity between these. If you look at what's going to happen in the U.S., let's exclude China for a second. We still have the situation where Apple doesn't really have the pricing power that it used to, but it has services and it has wearables, and we're seeing greater adoption of this. And I think the holiday season is going to be key here, and we're going to get reports on that in about March of next year.
All right, Jared, thank you. Let's get to a bullish call on Johnson & Johnson. It's one of the top performers in the Dow today. Now, Morgan Stanley upgrading the stock to overweight, saying that it is, quote, looking defensive again. The bank also raised its 12-month price target to $170, so pretty substantially higher from where it's trading today. We have Anjali Khemlani here to break all of this down. And Anjali, I mean, the one thing that sticks out to me is that Johnson & Johnson has had a tough year, to say the least, facing numerous lawsuits. Is it fair to say that maybe the street thinks that the worst is behind them at this point?
I don't know about behind them, but definitely that they're, again, with the whole defensive quote, like they're able to price it in, they're able to look at what they're dealing with, and they've been pretty transparent about what they're willing to offer. We know that in the lawsuits, altogether, for the opioids alone, which is, one of the biggest publicity, issues that they've had, $4 billion to settle all of them. And they've already agreed to, about $500 million and $20 million. So that's, inching its way there. Now, what Morgan Stanley said was that they're estimating that it'll be in total, including the talc powder case, which we know, and a couple others, there will be $14 billion over 10 years that they'll have to pay out in their legal fees, whereas in the market is looking well above 50. And that was, a concern for the longest time. That's been that number is 50 billion. And so with that, Morgan Stanley is saying that, the market's overestimating, and Johnson & Johnson, which has consistently outperformed, will continue to do so.
Yeah, those couple of numbers caught my eye, because when you think about what Morgan Stanley is predicting, compare that to the 65 to 75 billion, that's a huge discrepancy there. Another thing that stuck out to me in this note was that they were saying that the pharmaceutical segment here is set to accelerate in 2020. When you take a look at the landscape as a whole, what do you think is driving the growth into next year?
Well, it's actually part of the strategy. So in May, they revealed that is going to be their strategy for the next 5 years, is to really boost what's coming out of Janssen, their pharmaceutical arm. Largely we've known Johnson & Johnson as a very big consumer product. And so I think that, CEO Alex Gorsky specifically said that they're pushing for regulatory approval for 40 more uses of its existing therapies and treatments, and they're looking for new launches by as early as 2023. So that's a lot for them to be able to handle in their portfolio.
You mentioned earlier just Johnson & Johnson's role with the opioid crisis. One thing that I want to bring to the attention is the state of Michigan today suing opioid distributors, saying that they deliberately use their licenses to issue drugs without controls. What do you think the implications of this are?
Well, really, the biggest thing for Michigan in this is that they get to legally call Johnson & Johnson the distributors drug dealers, and that's exactly what a lot of lawsuits have said up until now. It still is a civil suit, and all the rest are as well. And so what everyone is waiting for is, does this then open the door for criminal suits, which has been rumored for some time. But definitely ability to be able to sort of hold it to them with this law that Michigan has.
All right, Anjali, we'll leave it there. Thank you. Well, coming up, a fresh wave of new data is painting an unexpectedly bright picture for the U.S. economy. But is the picture as rosy as it appears? We've got the details. Stay with us. Welcome back to the ticker. Let's check in on the markets. We're still seeing the Dow move in the positive direction, up around 51 points now. S&P and NASDAQ also holding on to gains. In terms of sector-wise today, we're seeing some strength in financials, energy, and consumer discretionary. Yahoo Finance's Scott Gamm is standing by on the floor of the New York Stock Exchange for more on the market moves. Scott?
Hey, Shauna. Well, you know, yesterday we had a record day across the market. So the good news about today is as long as we have a slight positive close in any of the three major indexes, that would log another record high. Now, right now I'm looking at Boeing. We got it up on the screen just to my left. It's down slightly, but the stock is still trading a little bit more than $326 a share. As long as it stays above 323, it'll stay in the green for 2019. Remember earlier this morning, Boeing stock went as low as $321 a share, so that would be moving into negative territory for the year. Now, it's not just Boeing. We're also keeping an eye on shares of Goldman Sachs, the company getting a price target raise from the analysts at Wells Fargo, including Mike Mayo. They are bullish on the outlook for the company, especially 1 year out from its new management team. That price target now at $280 from $240. Goldman shares are now at about $231 a share. And then finally, I've also got Unilever on the board just to my left, down 9% after the company warns that it will not meet its 2019 sales targets amid an economic slowdown in South Asia. Shauna.
It's a huge drop today, up almost 7%. Scott Gamm, thank you. Well, coming up, Netflix is disclosing new information about its growth abroad, but will it prove to be enough to offset a slowdown here in the U.S.? We have a top analyst weighing in next. U.S. home building surging to a 12.5-year high as lower mortgage rates continue to boost the housing market. We also got a reading on U.S. housing starts. They jumped during the month, rising more than 13% from a year ago. Here with more on this, we have Jeffrey Cleveland, chief economist at Payden and Regal. And Jeffrey, when you take a look at the numbers that we got in housing today, I want to just step back and talk about the economic picture as a whole right now. How strong is it from where you stand?
Well, the housing data is great news, I think, because for many months now, people have said, what's holding up the U.S. economy? It's the consumer. You know, what else is there? Is that the only game in town? And for the fourth quarter and the third quarter as well, we're seeing contribution from new home construction. And so that's a great sign. Today's data in particular tells us that for Q4, housing will probably add maybe 0.3 of a percentage point. And I think you're looking at over 2% growth for the fourth quarter, which is great news and very different than just a couple of weeks ago. A couple of weeks ago, people were worried that growth was going to be much slower in the fourth quarter, and we're not seeing that. We're seeing much better data.
Yeah, certainly is a totally different picture than what we were just talking about a couple of weeks ago. When you take a look at these numbers, do you think it's fair to say, or could we be on the verge of some sort of housing breakout?
If you look at it on a chart, it does look like the permits data has broken out, as you said, 12-year highs. I think we have more room to go higher. I wouldn't be surprised to see over the next couple of years 1.8, maybe even as high as 2 million on your housing starts and permits data. I think in that range, because the reality is for the last decade, we have been under building houses in this country. And I think we need to move the other way now. So I think there's more upside here on home construction, which is a great sign. Typically, when housing is slowing, so when single family home construction is slowing, that precedes a downturn. 9 of the last 11 recessions were preceded by a slowdown in housing. We're seeing the opposite right now. This is good news.
Jeffrey, I want to switch gears just a little bit here. Another big story that we're watching today is the Boeing news out. And Boeing saying that they were suspending, at least for now, their production of the 737 MAX jet. Now, JP Morgan was out with a note saying that the fact that they're doing this, it could shave up to a 0.5 percentage point off of first quarter GDP. What do you think of that argument?
I think it's an issue. It's a headwind. It will shave directly off of growth. But the bigger question is that temporary? Is that some permanent delay? Is that at some point are they going to bring that back online? I mean, to me is less of a business cycle issue and more of a temporary business issue. And I think the business cycle aspect is going to be much more driven by the fact that now the Fed is in full-on easy mode. Global industrial activity we see as rebounding. We expect it to rebound further in the first half of 2020, and that should help the U.S. manufacturing industrial outlook.
Yeah, the industrial production number is actually what I want to talk about here because it jumped just around 1.1% in November, just shy of what the street was expecting. The fact, though, that it did move to the upside, are we at least at some part of an industrial production on the mend?
Well, some of that is just unwinding the weakness that we saw in October, which probably was strike-related. So I want to make too much of that. But I do think industrial output will improve over the next year. The big culprit that slowed U.S. and global manufacturing activity was the Fed. The Fed hiking 7 times over 2017 and 2018. That tightened global financial conditions, and that really had an impact on global manufacturing, and we're seeing that reverse now. I think global manufacturing industrial activity bottomed out in July and August, and we'll continue to see some improvement in early 2020.
What about the change in status just in terms of the U.S. and China, the trade war? We got the phase 1 deal. How much uncertainty do you think that takes off the table when it comes to economic outlook?
I think that's a big deal. I mean, in terms of the uncertainty, when you look at CEO confidence, when you look at sentiment indicators, it was one of the big factors weighing on sentiment. So to the extent that is, abating, that will be good. It'll also be good in terms of the dollar. The dollar was restraining global activity, and the dollar had appreciated along with global uncertainty. If global uncertainty is lessening, the dollar should edge lower, and that'll be good overall for global economic activity. I think our really key view, though, is that, yes, the tariff story, that was a headwind on global trade and on U.S. growth. But that slowdown in global trade began before the tariff story really started to ratchet up. It began as a consequence, as I mentioned earlier, of the Fed. The Fed had tightened global financial conditions. And so that was the real big culprit. That tide has shifted and gone the other way. So I think that's the biggest factor here.
All right, Jeffrey Cleveland, we'll leave it there. Thank you. Well, coming up, why Netflix is unexpectedly revealing overseas subscriber data to investors. We have a top expert weighing in. We have some breaking news from Capitol Hill on that $1.4 trillion spending bill under review in the House. Yahoo Finance's Jess Smith has more. Jess?
Yeah, Shauna, the House just passed that $1.4 trillion spending deal. It was in two different packages, and we saw a vote that was a mix of Republicans and Democratic lawmakers. Unlike a lot of the votes we see here in Washington, this one was not along party lines. This will do several things, including funding the government until the end of September. It also raises the tobacco age from 18 to 21, and it gives President Trump some money for his border wall, and that was the reason we saw several Democratic lawmakers oppose this bill. But now it does move to the Senate. The Senate is expected to pass it sometime in the next couple days before funding runs out on December 20th. And then the president is expected to sign this legislation as well. Shauna.
It's coming down to the wire here. Jess Smith, thank you. Let's turn to the streaming wars. Netflix rising more than 3% today after disclosing its global subscriber numbers and revenue breakdown by regions. Now, its Asia Pacific membership signups skyrocketing by 148% between the third quarter of 2017 and the third quarter of this year. Now, Europe, Middle East, and Africa is up 132%. Joining us now is Ray Wang, CEO and principal analyst at Constellation Research. And Ray, when we take a look at those numbers, I think the big question is Netflix prior to this has not disclosed these numbers. So why do you think they're doing it now?
It's like, look, squirrel over here, APAC, EMEA, we're doing really good.
I guess it's working. The stock's up 3.5% today.
It's completely working. But here's the thing, right? International subscriber growth is not something easy to do, right? It's not like other people are going to jump out and get into these markets. And Netflix is truly a global company. So being able to show that growth is important, given the amount of investment they've made on content outside of the U.S. and Canada, right? But they also did this other trick, which is like, hey, U.S., Canada, we're going to keep your numbers together. And that's the other thing that kind of came together. So you're looking at very uneven numbers. But the main thing is growth has slowed down in the U.S. market and the Canadian market, and the streaming wars are coming.
How big of a headwind do you think that slowing growth here in the U.S. and in Canada is going to be for the company? Because even though we are seeing the stock react up over 3.5% today, some of the more bearish calls or some of the skeptics out there in the street, they're using that as the reason that they're saying, hey, maybe Netflix won't have the same competitive advantage as they do now in just a couple of years.
I think for the next 6 to 12 months, we're going to see an and strategy, but some consumers are going to leave Netflix to try something else. So Disney Plus, we'll try something else. We'll try Roku, we'll try Apple, we'll try whatever's coming out there, but they're all going to come back to Netflix. And so I think if you're holding for the long run over the next 12 months, it's going to be fine. It's going to be Netflix plus something else, Netflix plus something else, or Disney Plus Netflix. That's going to be what the landscape looks like in the North American market.
In terms of Netflix's biggest competitor here down the road, we've already gotten some numbers from Disney Plus. They look very strong here out of the gate. Do you think that they are the biggest competitor, at least as it stands right now? now when it comes to Netflix?
It is. It's because of the content library, right? This battle is about content, network, technology, and consumer. And when you bring four of those things together, you have a strong platform. Disney has that to begin with. But there are other folks that you have to worry about, right? There's going to be folks around on the Comcast Universal side that you have to worry that are going to come into this market. And of course, Apple itself is coming in at a very, very slow pace. But think about that. You've got almost 1 billion iPhone users that could suddenly be an Apple TV subscriber.
I want to switch gears here just a little bit. We're going to stick with the streaming wars, though, and we're going to talk about Roku. Now, their CFO is stepping down. When you take a look at the stock reaction today, there's clearly some concern out there from investors. You can see the stock off almost 2%. Why do you think the CFO leaving is that big of a concern? Because, as I understand it, he's played a pretty instrumental role in the company.
Yeah, Roku, I mean, the CFO's done a great job managing them through the transitions, getting them to this point, right? But the question is, what's going to happen in the streaming war? Will Roku be a winner? Will Roku be able to pull out of this? And the short answer is yes, Roku has another role as well, because I'll have my Roku device and I'll have something else. And what is going on at this in the market is we don't know who the ands are going to be. Everyone thinks it's a winner-takes-all market, not so in streaming.
And I just want to get your thoughts, because I know you closely watch Apple. We talked about it in the beginning of the show. Two very different calls when it comes to the company. They had Rosenblatt Securities out basically warning, saying that they're seeing weakness over in China. And then we had Cowen issue a very bullish call on Apple in terms of its potential growth into 2020. Where do you stand on the tech giant?
Oh, I think they're in great shape. They're going from that product to services transition. That transition has happened. iPhone 11 sales are doing really well, especially in China. So I'm not sure where that report is coming from.
Well, they were more focused on the fact that that they're favoring the iPhone 11, the slightly cheaper phone, rather than the iPhone 11 Pro or the other more expensive
That is
ones.
correct. But the thing is, you got the Chinese market to get away from the nationalism of being on a Huawei phone or being on something else besides an American phone, and we saw that transition happen. The other piece is it's services revenue, right? You might get your iPhone for $20 a month, you might tack on Apple TV, might tack on another service, might pay on the Apple card. Pretty soon, by like 20, let's say 25, you may be spending $50 to $60 per month on Apple. Right, and that's really where the growth is coming, and they're coming out of that. So they came out of that product and services shift, and I think there's more to see in terms of what they're able to do. And here's the thing, consumers trust Apple because they're not selling your data for advertisement. They're willing to give you more data to improve performance, and because of the privacy is there.
Well, when we talk about all the time just the strength that Apple has, or the advantage that they have, I should say, in terms of their ecosystem. They already have so many people who love Apple products who at this point don't really want to go elsewhere for some of their technology products.
It is, right? I mean, think about 1.4 billion iPhones sold around the world, 900 million as a base, right, just to begin with. There's a lot of services to go. If you can just raise ARPU on every phone, you're doing really well, and you're going to stick to that phone for a while. I mean, this is the decade of the iPhone.
Yeah, 1.4 billion devices. That's a staggering number. All right, Ray, thank you. Well, coming up here on the ticker, a slate of major banks and research firms are giving big price target hikes for the S&P 500 next year. Should investors get behind the bullish calls? We've got more on that. Don't go away. Welcome back to the ticker. I'm Shauna Smith. Let's give you a quick recap of the tickers that we've covered in the show today. Our first was Boeing. Now it's officially suspending production of its 737 MAX jet. That's beginning in January as it struggles to get approval. Now, despite the move, JP Morgan estimates that Boeing will still burn about $1 billion per month due to the halt. Our second ticker was Apple. iPhone sales in China tumbled by 30% last month. That's according to a new report from Rosenblatt. Now, the research firm saying that part of the decline was because Chinese consumers are opting to buy cheaper models of the iPhone rather than the new iPhone 11 Pro. Our third ticker, Johnson & Johnson, it's getting upgraded to overweight from neutral by Morgan Stanley. Now the bank calling J&J the most under-owned stock in healthcare. That's a pretty bold statement. With pharma growth likely to accelerate in 2020, you can see the stock up just around 1.5%. Well, checking in on the closing price of oil today, crude is currently trading to the upside, up just around 1% at $60.89 a barrel. Now, this coming on hopes that the U.S.-China trade deal will bolster demand in 2020. Now let's get back to the markets. Oppenheimer is out with a very bullish call in terms of where they think the S&P can go next year. The firm is initiating a year-end 2020 price target for the S&P of 3,500. This as it sees a phase one U.S.-China trade deal as a platform to boost stocks. So joining us now is Eddie Gabor, Key Advisors Group. And Eddie, when you take a look at that call there, 3,500 for the S&P next year, extremely bullish. Where do you stand on that?
You know, I agree with their call. Actually, I was pleasantly surprised to see that. A lot of people have been playing it safe, using the excuse that we've had such a big year in 2019. And a lot of analysts have come out with single-digit returns. I think next year is setting up nicely for another double-digit return in the equity markets. Not as strong as this year, but I think double-digit returns is a realistic expectation heading into next year, which is my opinion right now.
So, Eddie, you're not at all concerned about the fact that maybe it is time for a breather. We've had this huge momentum in the markets this year. We're hitting another all-time high today. You still think there's reason to buy at these levels?
I do. Now, look, we have, from a firm standpoint, we got a little bit cautious in the summer, and we have rebalanced portfolios. You know, it's always prudent, to your point, after a big year like this, to make sure you're not overweight and take some profits. But when you look at why we were a little bit defensive in the summer was because of China. That's a big deal. If trade and the Federal Reserve is off the table for 2020, and you take a look at the backdrop of low interest rates, accommodative Fed, and a strong real estate market, I mean, the path to least resistance is upward. So I think this momentum carries into 2020. And here's another very important factor that I hold a lot of weight to. This has not been a very popular bull market. People have been looking for reasons to sell. Retail investors have been on the sideline, and there's been records amount of outflows from equity funds. So with all those everything around us with those fundamentals, it again points to a very, very good year for the equity space.
So, Eddie, you mentioned the fact that maybe at this point we do need to take a look at our portfolios, rebalance a little bit. What are you buying at this point?
So right now, I think there's good opportunity, and I'm a contrarian, so I like to buy spaces that haven't done well. I'm a big believer in dividends. I think in the energy space, you can find some good dividend yields with companies that have good cash flow. I think you can look in the home building arena as well, too. Again, real estate has not been very, very strong, and I think it's starting to show some signs of life. But at the same time, I do say rebalancing a portfolio when you have these types of runs is extremely important. We're doing that for clients, even though we're very bullish right now. We don't want to be too greedy and be overweight any particular sector.
When you take a look at maybe there's some attractive valuations overseas, are you at all looking at emerging markets at this point, just in terms of the fact that they may be priced a little bit more attractively than, say, U.S. equities?
I actually agree with you there. I think over the next few years, you may have some better upside when you look at evaluations overseas, because they have definitely struggled. And the difference between U.S. returns and international returns has been a big gap. And I'm a big believer that things usually will revert to the mean. So I think a good diversified portfolio should absolutely have some international exposure. And if we do get a phase 2 trade deal next year as well, too, that's only going to bolster the global economy and be another win for the international markets.
Eddie, what do you think the odds are that we will get some sort of phase 2 trade deal? Because I've been talking to some analysts, some experts, and they were saying that it's very, very questionable at this point.
You know, I would agree with that. Frankly, I didn't think we were going to get this deal done that was announced last week. So I think from a market perspective, it's really about the rhetoric and the fact that it looks like they're trying to move in the right direction. But if you think about it, the Chinese at this point in time really don't have an incentive to sign or do anything until after our election to see who the president will be heading into 2021. So I think the phase 1 deal is a big win for the market from the standpoint that it takes that fear of those additional tariffs that were supposed to go on December 15th off the table. And that's why you're seeing this momentum in the equity markets, because it did remove a big question mark.
It certainly did. All right, Eddie Gabor, thank you.
Thank you.
Coming up, why investors are cheering yet another executive shakeup at Bed Bath & Beyond. We've got the details. Don't go away. Welcome back to The Ticker. Let's get to our next three tickers for the show. We have Bed Bath & Beyond leaping after announcing yet another executive shakeup, and Guess getting a ringing endorsement for its new focus on efficiency. And investors are eagerly awaiting FedEx's latest results after the bell as its relationship with Amazon dissolves. Well, first, let's get to the latest on Bed Bath & Beyond. Now, the retailer's new CEO is ousting 6 senior executives amid a turnaround attempt. Now, the departures include Bed Bath & Beyond's marketing officer, general counsel, and Chief Merchandising Officer Anjali Kamlani here is back with me, and we're seeing that the market is reacting pretty positively to the news. This is part of maybe they foresaw this coming, the fact that the new CEO is in. What could we expect just in terms of his other plans for the company going forward?
Sure. Well, I mean, they may have expected a shakeup. I don't know this size. I don't know that it was, some people are saying it's pretty unprecedented to let go of this many C-level executives. But for sure, with his history, at Target and how he was able to turn that around, that has been playing a role in the sort of enthusiasm that you've seen. You obviously saw the stock jump as soon as he was announced as being on board after tanking. I think we saw the lowest at $7.40 per share in August, which is really low. So definitely looking at the way that he was able to turn around the brand of Target. I think we could see definitely some of that with the in-house label, some private labeling, all of those things that he was able to do at Target. I think we're going to see, and for sure, Amazon is going to be on the radar because as his predecessor, his previous employer has, acquired Shipt to kind of work on the logistics side. I think it's safe to say that, Bed Bath & Beyond might not be far behind.
Yeah, Target was our Yahoo Finance Company of the Year, and a lot of their success was because of their initiatives that they took in terms of online sales and driving their online business to compete with Amazon. That's clearly an area that Bed Bath & Beyond has to improve on. What's interesting, though, to me is that Bed Bath & Beyond is a retailer, and they did this in the middle of the holiday season. Why do you think that is? Or do you think that that might be a little bit concerning at all to investors?
Of course it's concerning. I think that's been one of the most popular comments. How does this affect, the sales for the holidays? Or is it seen as, well, they were going to be dismal anyway, who knows? Definitely looking at the whole shopping experience, I think a lot of people, Bed Bath & Beyond isn't a bad brand in the sense that the products it has aren't terrible. It's just that the whole shopping experience is so off. So if they were going down anyway, how much does this really hurt? Who knows?
Yeah, well, 5-year chart, we can look at that. Bed Bath & Beyond off just around 77%. So there clearly needs to be some changes at the company. Right, Anjali, thank you. Well, let's move on to Guess, and it got an upgrade today. Now shares are popping after Cowen raised its price target on the stock, or raised its rating on the stock to outperform, saying that the stock is, quote, misunderstood and not appreciated. We can see shares jumping just around 7.5% so far today. Jared Blickery is back with me. And Jared, they're saying that they're underappreciated. Why are they so bullish on Guess right now?
Well, they have their old CEO back at the helm since February. This is Carlos Alberini. He was CEO of Guess from 2000 to 2010 when they went from a $200 million company to a $4 billion company in market cap. A pretty big deal there. And so he went to Restoration Hardware, and now he's back. He's focusing on cutting costs, margin expansion. Over the last few years, they've really expanded to 1,700 stores. They've been focusing on growth, but that comes at a cost. So he's going to batten down the hatches and hopefully lead them to profitability here, or greater profitability, I should say. Well, its stock is up about 7% today. Year to date, it's been kind of a rocky road here. You can see that they dipped into August, but now have had somewhat of a comeback here. And if we look at a max chart, we can really see the story of Gap. So here's where Carlos came in at about 2000. Here's about where he left. This is a financial crisis, huge swings there, but it's been a downward slope ever since, and the stock's just trying to make a comeback.
Jerry, the one thing that stuck out to me was their revenue from last year. 71% of it was generated from outside the U.S. Do you think the thought is that Guess needs to have a little bit more or a bigger presence here within the United States?
I don't know that they're going to expand their presence anymore, because that growth story is really coming to a close. They do have huge exposure to Europe, which is actually turning around right now. If the global economy does return to growth mode next year, that's going to be a boon for all of these stocks. But just looking at Gap idiosyncratically, I think this is the right move for them. They've done their expansion, and it's time to batten down the hatches, get their expenses under control. Cowen sees them getting maybe a 450 basis point margin improvement, at least on an EBIT basis, into the year 2025. We'll have to wait and see.
All right, Jared, thank you. Well, we have one earnings after the bell today that's getting our attention, and that is FedEx. The company is set to report this afternoon. Now, the street is looking for adjusted earnings per share of $2.78 on revenue of $17.66 billion. Emily McCormick is back with me. And Emily, a key thing that we will be looking for is any comments on the relationship with Amazon. What will you be watching in this report?
Well, that's definitely going to be one of the big concerns heading into this earnings report. Now that FedEx has confirmed that it is going to be severing that relationship with Amazon, in that Amazon won't actually be having its third-party sellers use FedEx ground shipment services heading into this holiday season. Now, that's according first to a Wall Street Journal report from earlier in the session. FedEx will still actually be able to have its shipments for prime orders that are a little bit more on the expensive side and use FedEx ground for non-prime shipments. But we are seeing this relationship with Amazon getting pulled back a little bit. This is what a FedEx spokesperson had to say to me. She said, quote, "While this decision affects a very small number of shippers, it limits the options for those small businesses on some of the highest demand shipping days in history and may compromise their ability to meet customer demands and manage their businesses." Now, this is a relationship we've seen really get rolled back over the past couple of months. Earlier this year, Amazon and FedEx had ended two major shipping contracts totaling $900 million in revenue for FedEx, or about 1.3% of total annual revenues. That's something that will definitely be on the minds of analysts today.
Emily, how big of a disruptor do you think Amazon is when it comes to this space, just in terms of FedEx's future growth, maybe possibly having to rethink at least some of their business model going forward?
Well, it's something that has been a huge concern, especially as Amazon has been trying to bolster its own shipping infrastructure. Amazon has been increasingly trying to improve its delivery metrics, really trying to speed that up with one-day prime shipping and other initiatives. That's something that has really been biting at the heels of FedEx and its own initiatives going forward. At the same time, that's not the only concern that's been hitting FedEx. The company did lower its full-year guidance in September, warning at the time that trade tensions and a weakening global macroeconomic backdrop would weigh on its profitability. FedEx does tend to be a global economic bellwether, so any color that CEO Fred Smith has to say on the economic front will also be closely watched.
All right, and those results will be out after the bell this afternoon. I know we will be covering it on the final round. Emily, thank you. Well, coming up, the old 60-40 rule for balancing your portfolio is going extinct. That's not necessarily a bad thing for investors. We'll explain all of this next. Well, financial planners have traditionally favored the 60-40 rule when it comes to getting the right mix of assets in your investment portfolio. But recently, this classic approach has been called into question. While target date funds are often rely on similar assumptions, but they could be better equipped for the change. Yahoo Finance's Ethan Wolfman joins us now with more. And Ethan, when you take a look at this, target date funds, you say could be a good investment. Why is this?
Well, kind of the thing about target date funds is that, while they have some kind of assumptions underpinning the relationship between stocks and bond mixes, the kind of way that the people who manage these are looking at this, it kind of protects this long-term difficulties that people are seeing with the 60-40 portfolio, mostly because the role of bonds is changing. I talked with both Fidelity and Vanguard about what they're doing and kind of what it takes to change the glide path of a target date portfolio. As you get closer to retirement, the amount of equities, stocks goes down, and the amount of bonds goes up, providing this diversification and a bit less risk. But essentially, to make a big change to this planned out long glide path, it really takes a lot. There's a lot of small little changes that can happen year over year, but generally it takes something like a large governmental change in Social Security, for example, or the way people are saving for these changes to happen.
Yeah, that's interesting here because I was going through your piece, and that was the thing that stuck out to me just in terms of the major changes that they're very rare and they don't happen often. So when they do, it's something that you obviously need to take notice and really change your portfolio or change your allocation in regards to this.
Yeah, I mean, I think one thing that was most interesting to me is the way that these portfolio managers look at things. It's not just about expected returns, or even risk and returns are important, but it's also about behavior. These companies, Fidelity and Vanguard and others, spend a lot of time and energy looking at exactly how these people who hold these funds are expecting to use them, how much they're invested, their life expectancy. That is something actually that is especially kind of important here because these, a small change in how long somebody lives is going to have a large effect on whether their portfolio will allow them to not run out of money before they die.
Yes, and that's something that we're all trying to do. Well, Ethan Wolfman, thank you so much.
Thank you.
Well, joining us now with more on this and just in terms of where you should best put your money right now, we have Steve Lipper, a senior investment strategist at Royce & Associates. We also have Victoria Fernandez, a chief market strategist at Crossmark Global Investments. And Victoria, let me start with you. And when you take a look at where we are right now, where are the best places to invest, what are you telling your clients?
Well, when we're speaking with our clients, and we have separately managed accounts with them, and so we really don't follow that 60-40 rule or even the 110 minus the age on what their allocations should be. It really is an individual decision for each client based on their ability to take risks, their willingness to take risk, what their financial goals are. So it's varied with each individual client. But what we try to do is really see some opportunities within the markets, not necessarily in a particular sector, but what are some names that we have seen maybe pull back a little bit? Where are some names that we've had some volatility? We do think the markets are going to continue to trend higher. And so looking across the board, some of the names we've added lately, we added MasterCard last week. We actually added Intuitive Surgical. We added Amazon. So different sectors, but places where we think there's some good upside potential is the market continues to trend higher based on some of the uncertainties that have come back over the last few weeks.
And Steve, just to get your thoughts on this, I know that you closely watch small caps, just in terms of the strong economic momentum that we have been seeing. We've got some strong data out this morning. Do you expect now that it could lift small caps, that it will be a strong year for it going into 2020?
Yes, we do. And I think you spotted exactly the important indicator, particularly small relative to large, because small caps are more cyclically sensitive. As the U.S. economy has decelerated this year, it's one of the reasons you've seen large outperform small. And exactly as you're citing, if we're seeing an acceleration into 2020, people should consider reallocating some of those gains they have in large cap into small cap.
And are there any specific sectors, just in terms of the small caps, that you are favoring at this point?
Yeah, I mean, if you break it down to cyclical versus defensive sectors, we really like the cyclical sectors. In that, you would consider industrials, you consider parts of technology. We like machinery, companies that are helping with semiconductors, companies that are helping with automation. This shortage of labor creates opportunities for any companies that can help with automation.
Victoria, when you take a look at where we stand right now in the markets, we're at record highs again. It seems like every day almost now we're pushing higher and higher. Are you at all concerned about the valuations that we're seeing in the U.S. equity market?
Well, I think we're around, 17.5, 18 times right now. We wouldn't expect that to go too much further, and we do expect there to be some volatility. I mean, even though I was saying some of the uncertainties in the market, like the phase one of trade and Brexit, what the Fed is going to do, even though some of those have come back and you have the potential for the stock market to continue to run and prices to move higher, that doesn't mean that there's not going to be volatility, that we don't still have questions that need to be answered. Manufacturing is still a concern, even though we feel like it's stabilized a little bit. So I think we have to continue to look not just at the consumer, even though we know that's really been the foothold for this economy going forward, and realize that there could be some volatility. So can prices go higher? Yes, obviously it can. Do we think markets will continue to trend higher? We do, but we think there'll be some volatility mixed in with that, especially going into an election year.
Steve, what do you think? Are you preparing for more volatility in 2020?
Actually, we're pretty optimistic right now on small caps, and I'll give you a couple reasons for that. First, on valuation, we think you have to look at valuation relative to where interest rates are, and versus history, versus interest rate, small caps are roughly in the middle of the range. We think they could go higher on valuation alone. Plus the point that you spoke about economic acceleration helping with earnings growth. Finally, the research we have done has said when the ISM index is below 50, specifically 49, and the central bank has been accommodative, you've generally in the next 12 months had twice the average gain that you normally get in small caps. So we would tell people actually lean into equities and lean into small caps.
All right, we'll leave it there. Steve and Victoria, thanks so much for joining me today. Well, coming up, Peter Thiel's controversial advice for Facebook and the fight to vet fake political ads. Stay with us. Well, it's time for our last tick of the day, and it's Facebook. We have billionaire investor Peter Thiel reportedly advising Facebook's CEO Zuckerberg not to fact-check political ads. Now, this is according to a report in the Wall Street Journal. This coming as Facebook faces government scrutiny over its news gathering. We have Anjali Khemlani, Jared Blickery, and Emily McCormick all back to weigh in on this. And Anjali, let me go to you first. Just in terms of what Peter Thiel may hold, how closely Mark Zuckerberg listens to him, what do you think?
I think that there is obviously something to be said about the fact that Peter is, one of the longest standing board members. He's the first outside investor for Facebook. Obviously has some weight to what he has to say, as well as, the support for Donald Trump. So there's definitely a line to be drawn there in sort of what his stance is and what he's saying allegedly to Zuckerberg.
Jared, I know you closely watch Facebook's stock or just charts in general, but when you take a look at just how this could impact Facebook's business down the line, how big of an impact do you see that having?
They could take a hit. If they lose political revenue, that's going to affect the share price, but they have other things in the pipeline. Instagram is more a money maker for them, and they have monetization opportunities with some of their other apps as well.
Emily, what do you think your thoughts are on this, just in terms of Facebook, if they do police these political ads, and they could be facing a lot of backlash as well?
Absolutely. I mean, at this point, we have seen backlash, mostly on party lines. We have seen Republicans mostly in favor of the decision that Facebook has now not to fact check ads. And of course, Peter Thiel coming out and being very outspoken about his conservative and libertarian values. So it seems like his views now are keeping in line with what we've seen previously.
All right, Emily, Anjali, and Jared, thanks so much for joining today. Let's take one more look at the markets before we let you go. The Dow is up still significantly, up just around 61 points, so higher than when we started the hour. S&P up just around 0.1%, as well as the Nasdaq. In terms of what is leading the Dow higher, we have Goldman Sachs, that stock up just around 1.7%. We're also seeing some strength in Johnson & Johnson and Home Depot. Well, stay tuned right here for the final hour of trading. The final round is next. Hello, everyone. I'm Jen Rogers in New York, and this is the final round. Stocks grinding higher here, trying to eke out more records.
Now, Miles, other than this, as economic data continues to improve stateside, factory production and home construction topping estimates. We'll have more on that coming up in just a bit.
Plus, Wall Street getting bullish on UPS to the chagrin of FedEx. It's our call of the day. And the rise of Skywalker debuts. We talked to Lucasfilm's executive creative director on the latest installment in the Star Wars saga. Plus, in this record-setting market, we look for pockets where the money can still be made. Let's check in on the markets right now. We're on record watch once again. All three major indices grinding higher, looking for record closes yet again. Right now, stocks are on track to have a fifth straight session higher. This will be the Dow's first winning streak of 5 days or more in 3 months. Miles, the S&P and the Nasdaq looking at their largest yearly gain since 2013. We continue to get this good economic data. You just mentioned factory housing. The bellwether of housing is doing well. So the sentiment swing is definitely in full swing, and now the economic story seems to be catching up Is there anything that can derail this?
Lower prices.
And where could those come from?
I mean, look, I think, for folks like us who've been following the market all year, what has happened in the last 2 months has been interesting in the sense that when the market began to grind higher in early November, there was definitely this sense like this isn't real, not going to last, can't believe this rally. But of course, and I wrote about it a little bit in the newsletter today, like that's kind of how the market works, right? And I don't mean to be too reductionist about it or too absurdist about efficient markets or whatever, but ultimately the market is trying to anticipate things that haven't happened yet, but the market is trying to essentially impute what it believes is going to happen, right? So it shouldn't surprise folks, I guess I'm trying to say, when the market goes up a lot and then the data starts to look better. The data looking better now isn't necessarily a reason for the market to keep going higher. That's the reason it had been going higher, but it also shouldn't be a huge surprise that the economy is in a fairly strong position. And I know it sounds kind of empty and meaningless, because it can be when we get consumers strong, we believe, all this stuff, right, that people come on and say. But look, that's what the market was assuming would happen. That is what's happened, and so here we are.
Here's another thing that people will say. It's just the time of the year. It's seasonality. Forget last year.
Seasonality's fine. Yeah,
this is
that's
also.
That's as good a reason as any.
That's as good a reason as. So we've got that. Yep. We've got the Fed.
Yep.
And it's now a global growth story that seems to be leading us to this risk on trade. Just looking at some of the big movers here, sector-wise, consumer discretionary, financials. We talked about that yesterday. Financials back at a record. Completing the U-turn. Not every name in there. We noted that yesterday, names like Citi that haven't come back, but still from the financial crisis there. Today, though, we are seeing real estate and technology lower as well. And of course, the story for Boeing continues, that we were able to hit these highs here on the Dow without Boeing getting into the game, really at all. Boeing up right now just about 0.1%.
Well, and I guess to that point, if the market's behavior this year has taught us anything at all, I think where Apple seemed to put us on January 2nd and where we ended up should be a reminder that really bad news can come for individual companies, and this specific market, basically because the Fed is easing, right? I mean, it's not really a lot more complicated than that, but when you've got easier, fiscal or central bank policy and easier monetary policy, all else equal, stocks are going to go up, risk assets are going to do better, and so we've seen a lot of bad news from companies. Boeing is just the latest that seems to have some sort of systemic issue we should be worried about, and I think that issue is probably going to come back in some form or fashion. But look, in this market, it's all fine. It's all fine.
Everything is awesome today.
You don't have to like it. You just have to know the rules. For more of today's market action, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott.
Hey, Miles. Well, a couple of tickers we're watching in this final hour of trading today. First up, Unilever. The stock is down over 9% after the company warned that it would not make its 2019 sales forecast amid an economic slowdown in South Asia. So you're seeing the stock at session lows as well today. And then Roku shares also under pressure. That stock down about 2.5% right now after the company announcing that its CFO will step down but will stay on until a successor is named. Although even with today's decline, the stock is still up some 340% so far this year. And then we also want to talk about Apple, because remember yesterday Apple shares crossed $280 but then moved below that threshold in the final moments of trading to close yesterday below 280. Well, today the stock has been above 280 for most of the trading session, and that's where it is right now. So if Apple can at least maintain its gain or build on its current gain, Apple is looking at another record close. By the way, the three major indices, all they have to do is stay in the green to log another record close as well, guys.
All right, Scott Gamm, live on the floor of the New York Stock Exchange.
So one of the other things we're looking at right now, we got FedEx earnings on tap. And of course, FedEx in the news a lot because Amazon has kind of changed up the shipping game. The last day that you could get your FedEx Ground and make sure you had Christmas has passed, and now they've changed the rules a little bit. If you're a third-party seller, you can't use FedEx Ground anymore. FedEx slipping on that. We've got a bunch of notes out as well. Seems like UPS could be a beneficiary here, but the FedEx call could also be exciting because
It usually is anyhow.
Well, and the FedEx release is often great because Fred Smith not one to really hold back his thoughts on pretty much anything. And so even though this news only crossed yesterday, FedEx still had like 12 hours to put their earnings together. Yeah. So one imagines that it's going to make its way in there. Bloomberg actually out with a great story today about Dave Clark, who runs Amazon's logistics operation, and kind of outlines the job he's done there. I think the beginning anecdote is a little bit disturbing. He used to hide in warehouses and see which employees weren't hacking it, and then would yell at them. So he got the nickname the Sniper on that basis. Not exactly great. I'm not sure I'd want to work for Dave Clark, but he runs Amazon's logistics business, and it's a very interesting move, like 9 days out from Christmas. Well, 8 days out from Christmas.
Oh my gosh.
To go ahead, for all you out there, to go ahead and sever that relationship. So always exciting, I guess, when you're working with Amazon. And the answer is like probably Amazon ends up benefiting because they're trying to like build out their own network, yada yada. So bad for FedEx. I don't see, UPS is going to be fine, but Amazon really wants it for themselves.
And through the story, I think it's been interesting to revisit the logistics Amazon business, because sometimes we don't talk about it that much, to see really how much they've been growing that as well. So ride more, pay less. That's the idea behind the new Lime Pass launched in the competitive e-scooter sector. Dan Howley joins us with the details. So Dan, a micro-mobility company, Lime, they've now launched Lime Pass. This is a
micro-mobility?
Yeah.
We're giving them that?
Dude, I just call them a full mobility?
It's a scooter company.
Scooter works, yeah.
I guess they got bikes, but whatever. It's a scooter company.
And they're small.
Yeah, I think
they are micro, and the things you get on are micro.
Exactly, yes. Small company, small scooter.
So the way I understand this, it's a subscription business, but it doesn't just give you free riding.
Yeah.
You get free unlock, so then you can just like unlock the scooter as many times as you want.
Yeah.
Who is this targeted towards?
So it's basically for people that regularly use this. If you commute, if you go to different places around small cities that have Lime, San Jose, San Francisco, New York, not one of them, and I don't think it's going to happen anytime soon, considering we don't get e-bikes for delivery drivers. But this is basically the idea where you would unlock it for free with a $4.99 weekly subscription. So not truly free.
Weekly.
Weekly.
Not monthly, weekly. So it's
Weekly.
like $20 a month.
Yeah,
Okay.
but if you make frequent rides, you usually have to pay $1 to unlock the actual scooter. This eliminates that dollar fee every time. So if you're going to do day-to-day rides or rides multiple times a day, you just get on and you can go. You still, however, pay the per minute fee that you normally have to pay for a Lime scooter. But I think something like this is very helpful for commuters, people who don't necessarily want to get into like a city bike plan, which is pretty expensive when you get down to it. And if they're just going a few, maybe a mile, maybe 2 miles, something like that, you can zip down and 1, 2, 3, and you're done. It's an interesting model, and obviously something that's taking off more and more, whether or not cities like that or not, because they just kind of get dumped on the sidewalk. That remains to be seen. But in New York, we have the Revel scooters, which you can unlock. You have to wear a helmet, though.
Those are big.
They're big.
Not micro-mobility.
No, not micro-mobility.
Also in Queens.
Yes, and Brooklyn. And they're frequently parked outside my apartment in Queens. And the helmets you share with people, it's kind of gross.
Called lice.
Yes, I've never used it because of that reason.
It's like those blankets they had at our holiday party that people
What is the play here for Lime eventually? Get bought by Uber or Lyft? I mean, honestly, can any little company make it in mobility?
I think that's really the idea here, is to get bought out by a bigger company. That's something that they're working towards. With Lyft, you can now, Lyft and City Bike are now the same. So you can, or not the same, but you can order your Lyft or a City Bike through Lyft and kind of get directions and get the bike at the same time. So it's really kind of the idea of merging all of these different types of hyper-local transportation. And I think that's really kind of the way that they're going to go. That's their ultimate goal. I don't necessarily think that a company like this, though, could exist for very long on its own, especially when you consider that cities are pushing back heavily on these things, and they continue to.
And in an up market today, we've got Uber and Lyft both lower. Dan Howley.
It makes sense.
We'll talk with you tomorrow.
All right, coming up here on the final round, we'll have some stocks to watch in this market, but first take a look at where the European markets closed on this Tuesday.
Now here are some stocks that we're watching. Bed Bath & Beyond, after the retailer announced the departure of 6 senior executives, the company's first major leadership shift under the direction of new CEO Mark Triton.
I kind of like this.
I would totally do this too if I got somewhere.
Look, so the head of digital, the head of marketing, the head of legal, the chief brand officer, they're all gone.
Yeah.
I think it's great.
If you're having a turnaround, I'd be like, okay.
Look, so in the sports world, anytime a new coach is named the coach of the team, they fire everybody as a course of doing business.
Yeah.
What if they did that in business?
I mean, we're sorry for these individual people. We are now never going to get jobs as CEOs.
If you're the chief marketing
but
exec at Bed Bath, I think you're going to be okay. You'll land on your feet somewhere. But look, obviously the stock is telling you hadn't been getting the job done, so.
Somewhere. It's tough out there in retail. The president of Macy's just went to the Tractor store.
Yeah.
So.
Tractor.
The Tractor Supply.
That's good retail.
Goldman Sachs, after Wells Fargo analyst Mike Mayo increased his price target on the bank to $280 per share from $240, expressing optimism about the bank's earnings guidance for next year. And finally, Netflix, after the streaming giant reported that its Asia Pacific area experienced gains of 148% between the third quarter of 2017 and third quarter 2019, its biggest gains in the past 3 years. Membership in Europe, the Middle East, and Africa also shot up by 132%. And the stock moving big on here, it's the second biggest mover right now in the S&P. It's up almost 4%.
Mm-hmm.
So,
well, I mean, Netflix has had the Disney Plus overhang all year. We know the story for them for a long time has been the international business. They said they were going to release these data, so now they have. Maybe it's a surprise the stock is moving this much on that news, but because you get less money per sub from these markets. But I think what we might be underestimating, the market might be underestimating in general, is just the international story Netflix can tell and the ease with which they can tell it that a lot of these competitors can't. Like, we don't need to go through the whole rights thing, but it suffices to say that like HBO Max can't just go get the license to its own content in international markets. Netflix has that.
And they're very cognizant of releasing everything at the exact same time with every language done. And they're doing so much local content as well, which is costing them a ton of money. Yeah. But if they're getting the subs overseas,
there you go. Effectively
going to be worth it.
The content. Coming up here on the final round, Wall Street is getting bullish on UPS, much to the chagrin of FedEx. It's our final round call of the day. But first, let's take a look at some of the trending tickers here on Yahoo Finance.
Let's go to our call of the day. It's BofA Global Research weighing in on the latest Amazon-FedEx feud, with Amazon blocking its third-party sellers from using FedEx's ground delivery network for Prime shipments. BofA sees rivals UPS and the U.S. Postal Service as beneficiaries to this, which kind of, it makes sense, right? But in the end, are they going to be enough of a beneficiary, or is Amazon just going to do this themselves eventually? I can't get that from this note.
So, they want to, obviously. I think everyone knows that Amazon's ambitions are kind of well telegraphed in this area, but almost just by process of elimination, right? Like a classic kind of three-card Monte here. The other two must gain because, there's no one else who can do it. And I think what's most glaring here is that FedEx, while they've long kind of bragged about not needing the Amazon business, Amazon is now more than willing to basically play offense and say, you can't work with anybody that's on our platform. Because by saying that our third-party partners can't work with FedEx for Prime deliveries, they're, I think, in so many words, saying, because we didn't, we already were not working with these guys. So now, if you want to be part of our platform, you can't work with them either.
Is there, so Target's got their Shipt deal, right? And now you just kind of think like if companies are going to go kind of like tribal and be like, you can't work with them, is another company going to come in and say, all right, well, we're going to be the FedEx, we're going to tie up with them. Maybe not an M&A deal so much as like, but they are our supplier in here. Like, is this, I just keep trying to think, is this definitely super bad for FedEx? Because you look at the numbers and it doesn't feel like it's not like the death of FedEx.
I mean, the problem with this announcement, I guess, or maybe the way that we didn't say clear enough, is like, I think Amazon's problem, their only problem really, is what equates to a last mile problem, right? Because it's 2 days. We need to get it from here to there with very few stops. FedEx has always argued that, well, it's a commercial business, right? We don't really need, and we're not going to be playing in that small last mile field. It's actually more ideally suited for the Postal Service and others like that. So I think that's why FedEx believes they're fine. I think what Amazon is perpetually frustrated by is the inability to control that last mile. Because that's, like, the last mile, businesses are really good at sending bulk items to places without them getting damaged. The reason that your soap explodes is because something happened in the last mile. And then when the soap explodes, Amazon has to comp you for the soap.
Yeah, and I'm annoyed.
Right, and then you get the package and the package is wet. And you're like, why is the package wet? You have to put the package in the sink. And you find out that the top of the Windex actually got split in half.
Did this happen to you?
May have happened. And then you're in there washing the bottle of Windex that didn't split open, and your 2-pack is a 1-pack.
They don't talk about damage here, but they do talk about FedEx's on-time performance.
Yeah, I mean, that anecdote had nothing to do with this decision, but you know what I'm saying.
I totally do. But FedEx's on-time performance dropped to 90.4%.
Yeah.
Interesting that Amazon is kind of leading the way here with 93.7%. I'm waiting for the president to get involved with a tweet. Remember how he was all over the Postal Service and Amazon?
He's not shopping for gifts.
I know, just throwing the gauntlet
I know,
down here
but like,
somewhere on Amazon. Amazon and shipping. It's like a trigger, an old trigger for him.
We'll see. You should be the president, and then Amazon and FedEx are going to have some problems.
We've already clarified that I should not be CEO.
Let me tell you. Yeah, president's fine.
Fire everybody.
The president CEO crossover, very limited. Coming up here on the final round. Our next guest makes the case that REITs could be primed to benefit in this market. We'll have that call right after this. But first, let's take a look at some of the day's leaders in the Dow.
As the markets continue to hit new highs, our next guest says the current market backdrop is great for the real estate market. Joining us now to discuss is Gina Szymanski, Director of AEW Capital Management and a co-portfolio manager at Nataxis Investment Managers. So, Gina, sitting here watching today, we're on record watch, but I do have to say XLRE real estate is down just about 1%. Let's look forward to 2020. What are you expecting out of REITs as we head into the next decade?
Absolutely. So first of all, thanks for having me. Happy to be on the show. What we think for REITs as we look forward for the next 12 months is about a 7 to 8% total return to investors. We think that is about a little half, and half of that will come from dividend yield, and the rest of it will come from growth.
And so what's really the story there when you look at the real estate sector on why you're calling for that kind of return? And is this a macro play? Is this a rates play? What are you kind of seeing here?
No, I mean, you can think of real estate the same way you think of bonds, and that's the companies pay a dividend, but they also have underlying asset growth, which represents the buildings that they own. And so when we look at the return to REITs, we really think about that coupon, which is the dividend, and that is about 3.5% right now for North America. And then we look at the growth, and the growth is pretty baked in. We have very strong visibility within real estate right now. The buildings are very full. Landlords have a lot of pricing power, so there's rental growth with lease escalators, and we think that's very high visibility into that 4 to 5% growth in addition to the coupon that you'll get.
Can we talk a little bit more about the leverage, I guess, that you see out there? It's kind of interesting because you're pretty bullish on the affordable segments of housing. And it's interesting because as we look at the labor market, obviously it's doing very well, but we're not seeing some of the wage gains that you might expect here. So if we don't have people's salary going up, what makes you bullish on the fact that affordable housing should be good, and that with the leverage there to raise rents, that people will be able to pay the increased rents?
So this is exactly the case. So within residential sector, we have traditional residential, which is apartments that you and I all live in. And then we also have the more affordable segments of residential, which are single family rentals and also manufactured housing. And so as you mentioned, that is absolutely the case. As we get later and later into the cycle and we don't see a whole lot of job growth, not a lot of job growth, but a lot of wage growth, there is headline risk with respect to how much the landlords can actually push rents and what these tenants can afford. And so if you look to the single family rental space as well as manufactured housing, it's just a better deal for tenants. It's a less % of their disposable income, and there's a very strong demand from the millennials who don't necessarily want to buy houses anymore, and they want to be mobile in their jobs. And so we see those two areas, again, apart from traditional multifamily, as having very strong fundamentals going forward.
Gina Szymanski with Nataxis Investment Management, thank you so much.
You're welcome. Thanks for having me.
All right, coming up here, we'll have more on the final round, plus the rise of Skywalker debuts. We'll talk to Lucasfilm's executive creative director on the latest installment in the Star Wars saga. We're back with that right after this. Welcome back to the Final Round here on Yahoo Finance. Miles London with you in New York. I'm joined as always by my co-host Jen Rogers. Let's take a look where we stand right now. 30 minutes to go in the trading session. All three majors are currently at record highs. Any green close for any three of these indices will result in a record close. The Russell 2000 actually a modest outperformer here, up about 0.3%. Jen, very quickly, name making a new high today. Good old-fashioned Target, Yahoo Finance Company of the Year. And I just kind of pulled up the consumer basket here. And of the top 15 names or so that's in this portfolio I have on Yahoo Finance, only McDonald's and Starbucks are off more than 10% from their 52-week high, which, you know, the simple way of saying this is all these consumer-focused names are still pretty much at their highs for the last year, and I think overall reflects a market that still kind of believes in that story.
And even those that aren't there are up today, like our friends at Macy's. Macy's right now.
Congrats to Macy's.
1, 2, 3, 4, fifth biggest performer in the S&P. So just getting on that Target bandwagon. Although Macy's was not Company of the Year.
No, it's also not in my consumer basket because I like that one for the stocks that do well. That's in my Amazon basket for the stocks that get killed. That stock is down 49% from its 52-week high. For more on today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott.
Hey, Miles. Well, take a look at Boeing shares. They're actually in the green. Surprising given all of the headline news and headline risk out there. But, you know, Boeing stock is still resilient, just at a lower level, right? It's been resilient really all year in the 360s, in the 350s, in the 340s, and yes, even now in the 320s. Even right now at 328, you could argue that Boeing stock is still rather resilient. Why? Because it's still above the August low for Boeing, which was on August 14th at $320 a share. And at that point, we were worried not about Boeing itself, but really about the inverted yield curve, and the entire market took a hit. That mid-August low for Boeing was the low for Boeing since the March tragic 737 crash, which was really kind of the start of all of Boeing's issues. Now with that, you have the US carriers that fly the still grounded MAX jet, Southwest and American Airlines, extending out the timetable for the return of the MAX now to April of 2020. And as we've said for months now, these airline deadlines are really arbitrary because the FAA has the ultimate say over when the plane returns to the skies. Although Southwest and American fly a few dozen of these grounded jets, so it's still a pretty small percentage of their overall fleet. Now, in terms of the market reaction within the airlines, there's not much to interpret here. Southwest shares at last look are down slightly. American Airlines shares are up more than 1% right now, guys.
All right, Scott Gamm, we'll talk to you after the closing bell.
Baby Yoda may have made Time's Business Person of the Year cover with Bob Iger last week, but Star Wars: The Rise of Skywalker will be in theaters this week, and early forecasts are estimating a $170 million to $205 million opening weekend in North America. And Yahoo Finance's Melody Hahn made her way to the premiere in Los Angeles and spoke with Lucasfilm's EVP and Executive Creative Director David Chang about the saga's latest film. So Melody, there's a lot of execution that goes into making these movies a success. Not all of them have succeeded. It's hard. There's the new audience, there's the old audience. How is this one shaking out?
Yeah, and Jen, his name is Doug Chang, and Doug actually has been with Lucasfilm over 20 years, plus or minus. It was interesting because George Lucas actually handpicked Doug to lead the art department back in 1995, and he was with the company for 7 years, then left trying to do his own thing, and then ultimately Disney kind of brought him back in, and now he's been with Disney since 2013 for his second go-around. I have to say, Jen, he was very nervous going into this film, and I was talking to him and his wife kind of during the reception area, and she was saying every single one of these Star Wars films, any film that he's been a part of, he anticipates that it will bomb. And it's almost like you expect the worst and hope for the best. I do have to say, I cannot give any spoilers, but the film I thought was extremely entertaining, lots of twists and turns. Some people are calling it convoluted, but I have to say, as someone who is not necessarily part of the cult following, I found it very enjoyable to watch. I specifically talked to Doug about this creative process, and I want to note that they collaborated with Porsche to come up with a brand new spaceship called the Tri-Wing. What's interesting, though, Jen and Miles, is that it did not actually appear in the film. My understanding is that maybe perhaps it made it into a final cut, and then J.J. Abrams kind of nixed it. I'm curious to see where it ends up living, but here's what Doug had to say about this process.
Why didn't you end up kind of editing it in the final film?
Oh, because we literally just finished it now. And so we're going to get into one of our future storytelling projects for sure.
And when you think about the iconic ships in the past, whether you think about the Millennium Falcon, what do you think is so iconic about this one? What is so special about the design?
Yeah, well, for us, it's we were trying to create something that's very memorable. And spaceships are really hard because they all have to have personality. Personality in both of what the ship is, and also personality of the characters that are piloting it. Like the Falcon is one of my favorite designs, and that's because of Han Solo. And it's one of those designs that's kind of has sent the benchmark for Star Wars designs for years. And so our goal was to try to create something that was, could possibly live up to that. And in designing for Star Wars, we always try to go for something that's very graphic, very, sort of easy to draw, more like a movie logo, really. And so when you can do that, it actually gives it a lot of power because you can read it very quickly cinematically.
I know it's not in the film, but theoretically, who would be the one actually driving this ship?
Oh, this is, we actually came up with the backstory just on our own, because normally when we design for something, we like to figure out, okay, well, who's piloting this? So we decided this was a good guy ship in the sense that, this person perhaps found this in an old barn, like an old race car, and he refurbished it, fixed it up to be his own hot rod.
So, of course, Doug mentioning the Falcon, but of course there's the Star Destroyer and the TIE Fighter that have become iconic sort of symbols of Star Wars. I do have to say, in the intro you guys noted Baby Yoda. He is an integral member of the Baby Yoda family, and he was part of the design process of that. He had no idea that it would blow up to this degree. They've actually been shooting The Mandalorian Season 2 in Long Beach and parts of Manhattan Beach in LA, and he was saying it's actually very refreshing to be filming in the United States, because for so many of these films they had to travel overseas.
Melody, I love how you say you're not really that big of a fan, but you're just like dropping Millennium Falcon.
Research, Jen.
Research. So overall, look, Disney Plus has gone well. You talked about Baby Yoda there. Fair to describe the mood among the Disney crowd as we're crushing it?
Oh, Jen. Honestly, we don't want to pander. We don't want to necessarily depict things that are not true. But in this case, the enthusiasm, the energy of the room, in addition to the diehard superfans, there were probably about 200 of them dressed in head-to-toe, lightsabers, everything in between. I saw kids who were 3 years old to grandparents who were in their 80s kind of decked out. You could tell they won some sort of lottery system. And then, I was sitting actually in front of the United CEO, Oscar Munoz. 2 rows ahead was Han Solo himself. All the cast members were taking the stage. It really was kind of this amazing occasion. I know that the Cats premiere happened last night as well in New York, so this was like a rivalry sort of coast-to-coast situation. I do have to say, though, the film was met with tons of applause. It was actually a super interesting experience to be in that theater because it was very interactive, to say the least. There were lots of fans shouting, "I love you, JJ," during very pivotal moments of the scenes. Which I ended up appreciating because it was pretty late and I was dozing off here and there.
You guys are going to start having a name-dropping competition between Jen and Melody. I'm not going to be able to keep up. What am I going to do to say I was in the room with the CEO from this and that and the Han Solo's right there?
It's
All I know is Gary Player.
visualization, Miles. It's a description of the context of the situation.
Very good. How's Adam Driver's energy in that setting? I admire him, but I feel like he's not really, that's not his scene.
Yeah, it's so funny you mentioned that, Miles, because I was kind of obsessing over that Daily Beast article where he walked out during the Terry Gross interview. Very incredible, very kind of in his character, right? I actually saw him when I was in college, and he talked about the transition from being a Marine to being an actor. And as you just saw there, he was with his wife, who actually co-founded that nonprofit that helps a lot of people who served in the military end up in acting careers and in the arts. I do have to say he only made a very brief appearance. They were all the cast members were called on stage. He did not speak. I didn't necessarily see him on the red carpet. They call it the blue carpet because it's a blue velvet. I think he arrived very late to the actual premiere, so you can tell that he avoids it. I don't know if that makes him a true actor, if that makes him kind of I don't know, unpleasant, but for me, I kind of put him in the category of he wants to do it as art and he's not trying to necessarily be talking about or watching his work. I wouldn't be surprised if he actually wasn't sitting in the audience for the film.
Definitely.
Because apparently he hates to watch himself.
Definitely a career ambition of mine to walk out of a media appearance because I didn't feel like the creative energy was right.
Where Steven Spielberg is sitting in the audience,
Right,
you know,
yeah.
where you're like,
You definitely are the Adam Driver of Yahoo Finance.
Miles, is that a compliment? I don't know. There's talent, but curmudgeon.
Oscar, right? He's actually has talent.
He's great.
I'm just sitting here.
Melanie Hom, a fantastic interview with Doug Chang. Can't wait to talk. I know you can't give us any spoilers, but once we all see it, then we can kind of tear it apart a little bit more.
Are you going to watch it this weekend?
I don't think so. No, I'm just being honest.
I know Miles is not.
Jen is traveling the world. Mel, you're not going to see the movie. I'll see you in New York not too long from now, though.
See ya.
Take care. All right, coming up here on the final round, we've got the winners and losers in the stock market today. But first, let's take a look at the most active stocks today in the market. All right, let's take a look at some of today's winners and losers in the market. Stocks in the red include Groupon. Shares lower after the e-commerce marketplace saw the name downgraded to sell from neutral over at Goldman Sachs. The firm expressed concerns about the company's customer declines in North America. Also lower, Unilever shares the consumer goods giant getting crushed in today's session after announcing that it expects sales growth in 2019 to fall below expectations amid a slowdown in South Asia and weakness in North America.
Now for some stocks in the green. Guess after the clothing retailer received an upgrade at Cowen to outperform from Market Perform, which is optimistic about company management's new focus on efficiency. And Netflix shares are jumping after the streaming giant reported that its Asia Pacific area experienced gains of 148% between the third quarter of 2017 and third quarter 2019, its biggest gains in the past 3 years. Membership in Europe, the Middle East, and Africa also shot up by 132%.
All right, coming up here on the final round, Permanent Portfolio's Michael Cugino joins us to give his take on the markets right now and where he wants to put money to work in the new year. But first, let's take a look at where financials are trading right now, 17 minutes to go in the session. So a great year for investors is wrapping up. So what does 2020 have in store for markets? Michael Gugino is the president and a portfolio manager of the Permanent Portfolio family of funds, and he joins us now to discuss. So last week, Mike, we sort of got trade fixed, I guess. Phase 2 we get to enjoy in 2020. Does it change your outlook as you think about the market next year? And were you surprised that we didn't see a huge move on Friday? I know there was some disagreement, at least in my inbox, over whether the market should have been up a whole lot or whether it should have been more of a sell the news event.
Well, I think the market was building to that result, and so it's already been priced in, so to speak. And really, the trade deal took away a risk more than anything else. I think the risk is that the two countries continue to fight and nothing gets done and relations get worse, and that hurts everybody's economies. By having a deal as limited as it was, allowed that risk to be taken off the table for the moment, and it allows the markets to really move forward beyond that and begin to think about other things that may impact it. So I think risk mitigation was the major winner last year. And with that in mind, with the Fed on the side, the other piece of news we got last week was the Fed appears to be on the sidelines for a while. So you've eliminated two risk factors now going into the new year. But the market has also been anticipating this and priced it in. So I think that's why you haven't seen a big bump, but more of just a gradual uptrend or a continuation of what we've seen for the last 2 or 3 weeks. So I think that's where we're at. Going into 2020, I think you nailed it. We had a great year this year, the last 2 weeks notwithstanding here. But the question is, what do you do going forward versus looking back? And I think where we're at right now, there's a lot of good things happening in the U.S. economy. Global interest rates are going up a little bit. Global growth may be improving. You've had some risk factors taken off the table with respect to trade. Inflation's low. People are working and spending. It looks to be a good fact set going into the new year at this point, but things can change quickly.
So let's break down some of those sectors and where, in terms of asset allocation, if things look, sentiment has really shifted. And as you say, we're getting confirmation from some of the data that's coming out. So if 2020 is looking good, what is your favorite sector right now to say, you know what, let's add to that?
Well, we run a diversified fund, our flagship Permanent Portfolio, which invests in a bunch of different asset classes: stocks and bonds, U.S., non-U.S., gold and silver, real estate, natural resources, commodities, et cetera. So we maintain a diversified stance all the time. And I know the last 10 years or so, diversification and hedging your bets has really been out of favor. But at some point, it will be back in favor. And we think a prudent investor should always have something put aside for this sort of investment planning anyway. But having said that, in the equity market, for example, we would tend to focus on sectors that have not kept up with the broader market, that have been beaten down, but that are also levered towards improving or doing well in a growth-oriented environment, which would fit the fact pattern that I laid out. So obviously financials, transports, manufacturing, materials, commodities, energy would all be areas that would meet those characteristics for a patient investor going forward. So if you're looking for value and areas to make money that aren't too expensive, those would be the stock sectors that I think you would want to focus in. And we have healthy investments in all of those.
And Michael, just thinking maybe a little bit bigger picture towards the next decade, we've seen a number of kind of big strategy notes come out and predict essentially low returns in the 2020s, and that we've had such a blockbuster 2010s across a number of assets, most notably just the U.S. stock market. The all-world index is basically back at record highs. Do you see that kind of lower return profile in 2020, given where rates are and given what we've seen over the last decade?
Well, it depends on the economic landscape. The big debate I think the market's dealing with right now is, are we late cycle and heading into a recession? Or did we pause at a certain point this year as a midpoint to a larger, longer growth cycle? And I think that's what the market's trying to figure out. And I would agree that that's a legitimate question right now. Things tend to revert to the mean for the better or worse. And you've had a tremendous decade for equities. And so at some point, I think you would revert back to the mean and have lower returns. But when that is, I can't tell you. I mean, I think many people have been predicting that for several years now, and they may have missed quite a move in the stock market. So it's a tough thing to do. I think the big picture is that the next 5 or 10 years, I suspect for a lot of reasons, are not going to look like the last 10. And so investors have done very well in the last 10. I mean, literally, an investor, all they had to do was buy S&P or equity index or fixed income index funds, and they've done very well. And that was a great trade. You didn't need hedging. You didn't need to really think too much. You didn't need active management per se. You did well. But going forward in a much more mixed environment, where the data may be mixed, where the economies may be mixed, where you may have a recession, where you may have more fluidity with fact patterns, you're going to want something to work that wasn't necessarily the right answer for the last 10. And I think, we're in the middle of that space, and we know that space well. But, I think it's going to look very different going forward. And so investors should be prepared for that and not just assume that things are going to go on like they have the last 10. It's been a long cycle, and it won't continue forever. That I can tell you. I just can't tell you the timing.
All right, Michael Cugino, portfolio manager at Permanent Portfolio Family of Funds. Thanks for joining us. Have a great holiday. Talk to you next year.
Thanks for having us. You guys as well.
Coming up, still thinking about getting those loved ones some killer AirPod Pros for the holidays? Well, guess what? You're out of luck. We'll tell you why. But first, take a look right now where big tech is trading. If you're looking to give the gift of AirPod Pros this holiday season, it might be time to start looking at other options. Apple's AirPods Pro headphones are completely sold out online ahead of the holidays. Now, Apple stores have been out of stock since November, and now other retailers like Best Buy and Target and Walmart are out of stock as well. But if you're really desperate, you could go to eBay. There are some available there, but you're going to be paying more than the market price, a lot more. And then you never know, you could also get a knockoff.
Right.
But
plenty of options at a lower cost.
But they're not AirPods.
Right.
And that's the whole thing.
Right. Now, here's a question for you. You bought the AirPods.
I did.
The first day.
Yes.
If one of your children wanted it for Christmas, would you just give them yours?
No. I'll just give them my old ones.
What do you think of the morality of regifting down the generational chain an expensive item like this that you have already enjoyed? Now, granted, you have put this in your ear, but you could take a wipe, and all of a sudden it's fine.
Yeah, we are.
Do that with the earpieces here.
We are related. My philosophy on regifting any sort of phone or electronic is that I don't actually give them to my kids. They're mine. They're not a gift, so I can take them at any moment.
Wow.
That is my phone.
I see.
That I am just letting you use that phone.
So this is how we deal with technology in the youth.
Never give a phone as a birthday present or a Christmas present or a graduation present. It is my phone until you can pay for it.
You can now use.
Unless you're paying for the service, it's
Yeah.
my phone.
Very interesting. I will say I am surprised at the robustness of AirPod Pro sales. They're $250. To me, like the regular AirPods fit fine. I don't want the more in-air situation. I guess, selfishly, I have different noise-canceling headphones, so I don't need these. But man, they really just went nuts.
I think that as more people didn't get the phone, and there was a note out today on just
30% reduction in
that was in
sales.
China,
Yep.
but even in the U.S., I don't feel like
a couple
the
of firms
11
have said that number too.
has been kicking on. But people like these, I think, because people can see them. They see that you have new ones.
Yep.
It's an easy way to seem like you've upgraded something without having bought a new phone.
Yep.
And Apple loves it because the margins on here are ridiculous.
This story always makes me happy too because it's another way I get to tell Dan Roberts he's wrong.
Oh, that's always fun.
He's always been like, AirPods are stupid, and he's literally the only person who thinks that. Everyone else in America and the world is like, they're fine, they're great.
They're sold out everywhere,
They're a
Dan.
status symbol, and Dan, you're on an island, and you're wrong. Coming up here on the final round, we've got the closing bell on Wall Street, plus the 737 MAX halt over at Boeing could have some spillover effects that could be felt across the economy. We're back with that conversation right after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udlin, and joining us now, Jared Balikri. We are just moments away from the closing bell, where we are on track yet again. Well, we've come off quite a bit. Quite a bit, I might add.
These are records, Jen. Don't talk about records like that.
I'm not going to say it till it happens. Live pictures of the New York Stock Exchange and the NASDAQ market site. Looking at record closes. Put them back up.
Yeah, all three.
It was fading, yeah?
All
okay,
three.
but it was a serious fade.
Yeah, well, let's check it out here.
Yeah, I mean, look, when we came in here.
In the last few minutes.
I forgot about
Even in the last hour, but just in the last 10 minutes, we came down a little bit.
Scaling
here.
on the chart is magnifying it. It's really not that much.
Yeah. Okay, well, real estate's ending down more than 1%, about 1.15.
The only guests we found on the show, one of them was pitching real estate, and it's the
Yeah.
only thing that's down today.
She thinks it's going to be good in 2020. It's a long-term play.
I've long
not
had
for today.
I've long had a great idea for Bud Light that I don't want to share publicly because it's such a good idea, and seeing them makes me think of it. I'll tell you during the next break.
I can't wait. Netflix.
I'm going to run with it.
Netflix is the best performer in the S&P. A little bit of a flip there. It had been second, up some 4% today. The extra data. Usually companies are pulling data away from us.
Yeah, and they're just doing the opposite, aren't they?
Finally, because they've hoarded it for so long.
Well, the financials, they closed at a record high. They just broke
crazy,
out.
I know.
They just broke out the other day. They hadn't had a record high since 2007.
Yeah, well, actually, to that point, the technical long-term breakout that I think we often overlook. People like to rag on TA, but when you break through a 12-year high, right, there's going to be a lot of buying support there. And kind of going back to just the overall international, right, ASCI, all world index, that hit a new record or above the 2018 highs. Does that, to you, Jared, kind of signal a more constructive overall setup that we're not thinking about enough because we're just looking at the S&P?
I would hope that would be the final nail in the coffin for all the wannabe bears out there, because if just about every major index on Earth is making record highs, and of course we need the transports and the Russell 2000, but what is it going to take? There's just not a lot of bearish signs or any bearish signs in the market. I look at internals; those are expanding, those are healthy. I look at seasonality, and this is with the most bullish part of the year. And not only that, this is the most bullish OpEx week, which we have Friday of all 12 months, and then we have bullish seasonality for small caps going into March. So everything's kind of lining up here. Now, could it all fall apart tomorrow? Not likely, but what would it take? It would take phase one literally does not get signed. It just falls apart.
It appears as if the president will be impeached tomorrow by the House, but I don't think that's going to.
No.
No, we've already done that impeachment
stuff. So to your
stuff.
point,
Sometimes
to Jared's point, it's like if that's a non-market event, then this market has designs on something a lot different than what.
Yeah, and look, this is a low liquidity time of year. Traders are going on vacation. Mm-hmm. Some of us are going on vacation, trying to get
not all of us
trying to staff the show. Yeah, so you'll have like one guy manning the desk for an entire firm on Wall Street, and it's just
what could happen? What could go
wrong?
Nothing could go wrong.
It's like having one anchor for 2 hours.
Yeah.
Anything could happen, but also it doesn't really matter because it's just a guy just saying some stuff.
Yeah.
You guys, this is the part of the where I get to go. Aren't we being too complacent? But no, it seems like
hey,
we're not.
You can go be complacent.
I'll be
somewhere else.
I'll be complacent.
Don't worry.
On this desk, there will be no complacency.
VIX is going to drop to single digits, and then you can start talking about that.
There
wow.
you go.
For more on today's market action, let's go to Scott Gamm on the floor of the New York Stock Exchange. Scott, yet again, 5 days.
Scott did it.
Here we go. Records.
A trifecta, not just a record. All three major indices closing at record highs again. And I was just talking with our producer Praz before we went on because there was some worry that the S&P would not close at a record because it ended the session up less than 1 point, but the final tabulation is a gain in the S&P of 1.03 points. So we are in record territory. And remember, the bar was so low because we closed at a record yesterday. So all we had to do is close in the green, even if it was a tiny fraction in the green. But let's get to some specific names, especially in the Dow. Your leaders today were names like Goldman Sachs, J&J, American Express, and Home Depot. Apple was not in the list of gainers, but it did close in the green, and it closed at a record high for the second day in a row. Remember, yesterday's record was a record, but it closed just below $280 a share. The nice thing about today's record in Apple was that it closed above $280 a share. The laggards in today's session were names like Walgreens, Intel, Chevron, and United Health. So we'll see if we'll see more records tomorrow, guys.
Close one there, down to the wire, but a trifecta at the end of the day. Scott Gamm on the floor of the New York Stock Exchange.
All right, well, after Boeing confirmed reports that it would be suspending production of its 737 MAX plane in January, a slew of analysts weighed in on what it could mean for the broader economy. Most were about how the move would impact the company and its suppliers, but Capital Economics came out saying that this really has an impact on the U.S. economy much more broadly than just the manufacturing sector or industrials. They think that it could take a half percentage point, up to a half percentage point off of GDP in the first quarter. And Jared, I think this is sort of when we look at the Boeing story, and we talked about this a little bit with Andy yesterday, it's like it's hard to overstate how important this company is for the overall economy. But then when you put it in those terms, it almost sounds like you're being hyperbolic, even though that's actually what the data said.
Right. Well, you've talked about this too. Because of the way GDP is calculated, even though they're not shipping their planes just because they're building their inventories, it's still been counting towards GDP. And they've only reduced their capacity or their production from 52 to 42. If they suspend it, yeah, and especially if they have to furlough, or their suppliers, because they said Boeing itself is not going to furlough their employees just yet. But what about their suppliers like Spirit Aerosystems that relies on Boeing for just about 100% of their revenue? This could have ripple effects. And Boeing is so important that I think that's why nobody has gone after them and really asked hard, deep questions, because this stock is just floating here. It's at support. 320 is basically critical support. And I just tweeted this earlier. If you look at a volume profile chart going back 5 years where you can see where all the volume is, there's a huge air pocket between about 310, 320, all the way down to 150, 160.
Well, and
what happens?
Because I looked at the chart yesterday, thinking kind of, where is the floor on this thing? That was, the
Jen, floor is 150 to 160.
Right, Jen, you remember this. 2017, we came on this show, and every single day we talked about Boeing shares going up.
Every day.
That stock doubled in 2017 ahead of the tax cut, ahead of the huge, defense budget that was passed. That's another big part of the story. Now that part's not going away, but this stock went like parabolic in just a few months, right around all those policy changes.
It was either talking about Boeing or talking about NVIDIA. That was
Right.
just like, that was all we did, was Boeing
and Bitcoin.
and
And
Bitcoin.
Bitcoin. That was it.
If we went back there, that would be it. I was interested in this note. I mean, the GDP, the knock-on effect there, the supplier part I found fascinating, but also the bullet point on the Fed. Like look, the Fed, they talk about weather sometimes, they talk about the GM strike. When does the Fed begin to think this is something more than a temporary disruption? The note says that
That's why
right now.
they've been in the repo market so actively.
Speaking of the weather, I wonder what FedEx is going to blame everything on.
Yeah, exactly.
Something. But just the fact that you have to say that the Fed is going to think that this is a temporary disruption resulting just from the woes of Boeing, but if it goes on a long time, it really, the magnitude of it is something that you can't ignore.
Yeah,
and it's crazy because it's one company.
Yeah, and it'll eventually hurt personal consumption not on the margins, but that's all it really takes. I don't see this causing the economy to roll over in and of itself, but you combine it with a couple of other things next year from left field, who knows what can happen?
Yep.
Well, Boeing today, I mean, what was the support, 120 or
150, 160.
150,
Yeah,
160.
If it breaks through 300, let's say that's the final stop, it's probably going to 150, 160 just based on this technical analysis.
And then we'll find out just what this market is made of when Boeing shares get cut in half. All right, FedEx quarterly results are out. The stock is falling. The shipping giant missing estimates for revenue and earnings in the most recent quarter. In fact, adjusted EPS even missed the lowest estimates that were out there on the street. FedEx saying operating results declined due to weak global economic conditions as well as increased ground costs. No mention of the weather there, Jared, although
any dollar?
You had guessed at it.
U.S. dollar headwinds?
Economic conditions, ground costs, loss of business from a large customer.
Does not name Amazon by name.
Mixed to lower yielding services, more competitive pricing environment were cited top line there. But, this kind of makes me think, guys, when's the last time FedEx had a good quarter?
Yeah.
I've read.
Because it has been just an unbelievably poor run of
Not
results.
including today, they've been down 5 of the last 6 or something like that, very close to that. So now we're talking about 6 of the last 7, and they're saying the same thing. Basically, international weakness. So FedEx eliminating multiple international flights to reflect reduced global air freight demand.
Yep.
I heard that before.
Yep.
And what else?
Further restricting hiring, pursuing opportunities to optimize our network, including investments in tech and improving productivity and lowering costs.
Yeah, and no 2020 guidance.
Yeah,
So good
and
luck
that's
there.
not giving the guidance.
They have earnings
They've
guidance,
done-
but no sales guidance.
No sales guidance, but the implementing reductions in the global FedEx Express air network to better match capacity with demand. This company's also been in the headlines for their taxes recently, and trying to give sort of clarity on what they're doing there. There's going to be lots of questions on the call
You know, FedEx Ground is almost a completely separate company, as I've read, from FedEx. It just has a different operating structure. I've used it a few times, half of those times with really bad results. Just get rid of it.
Yeah.
If this thing is such a drag.
Yeah, certainly just a challenged business overall, not to mention a challenged stock chart here, Jared. I mean, this was a name that was down 30% in 2018, and this was actually really kind of the ground zero of that market, that blow-off stress this time last year, right? We had the market down, what was it, 7% in 5 trading days, something like that. And FedEx came out announcing their poor earnings results from their fiscal second quarter of 2019. This is their fiscal Q2 2020 reporting today. At the same time, Jay Powell raised rates for the last time. And that was just a whole,
a whole
alphabet soup of mess.
And they were seen as a bellwether. I hope we've learned our lesson and we can just completely discount these results tomorrow. But we'll see.
Yep. Stock right now trading 154. The high back earlier this year was at 198. All-time high 262 back in January 2018.
And that shift of Cyber Week, I bet we're gonna hear that from a lot of retailers. The calendar, the shorter time for Christmas.
It's almost like couldn't you pull up a calendar?
Nobody could see the calendar. They didn't know.
I'm not a CFO. I'm not smart enough to see a calendar.
Coming up, this trade is far out, man. Space investing heating up. Expert and co-founder of Procure AM, Andrew Chanin, on where he's looking for sky-high returns. But first, let's take a look at where some notable space stocks traded today. Procure AM ringing the NASDAQ opening bell today in honor of its Procure Space ETF. There they are, the ticker UFO. And co-founder and CEO Andrew Chanin joins us now to discuss making money in space. So we have had a number of people come through here. They're kind of going a different route. They're doing the PE, the VC route. You're getting into publicly traded space names. Are there enough of them?
Absolutely, and our fund proves that there is. I think a lot of people want to get exposure to space, but like you mentioned, the previous routes, early stage companies, private equity, things like that, it really restricts most investors from getting exposure to these names. And UFO makes it available for not just retail investors, but institutions as well. Anyone that wants to get exposure to space companies can invest in UFO and get exposure to 30 plus publicly traded names from around the world doing all different things across the space industry.
So just looking at the top 10 holdings, it seems that it's mostly kind of like a satellite sort of play at this point, or is that the way that it appears you can get the most obvious exposure to space from these companies? Obviously, a name like Garmin, Sirius, that Dish that a lot of investors are going to know will know them for their land-based ventures, but obviously there's a space angle there.
Well, their land-based ventures are entirely reliant upon space-based systems, so satellite, broadcasting, communications, things like that. They're utilizing the satellite infrastructure and to send satellites up into space and actually build out that infrastructure that those companies rely on. Satellites are a crucial part of the equation there. So yes, to answer your question, satellites are a major provider of revenues from the space economy right now, and currently in the publicly traded world, that makes up a large amount of it. If you go kind of further down the list, you'll see some of the more diversified aerospace defense names, your Lockheed's, Airbus, companies like that are major players in space, but that entire tranche of diversified names are actually capped at no more than 20% of the fund. So you'll look at the remaining 80% or more of the fund is focused on these pure play names. Virgin Galactic, one of those companies in there, also doing something very different, the first pure play space transportation company.
Yeah, I joked with Miles the other day that the total addressable market of space is infinity, but all you have to do is find one of these asteroids out there that's filled with minerals, gold, whatever. And I'm not even joking right now, because which of these companies and how far are we out from being able to mine in space? And are any of these companies set to take advantage of that, or do we have to wait for other ones to become public?
Companies are working on various ways of doing that, but right now that's a lot further away, in my opinion. I think when asteroid mining and things like that start to really take off is when we actually need and have more kind of established permanent space infrastructure. So when you need to resupply a permanent lunar base or Martian base or something like that with natural resources, it's probably a little bit easier to then go and start mining asteroids and bringing it there. I think the Kuiper Belt and whatnot could be out there and utilized for human progress as we expand further beyond Earth. But bringing it back to Earth, it's certainly something that companies are working on, because you said there's trillions of dollars worth of natural resources. Currently we're not running out necessarily of all of them on Earth, so it might be, maybe next 100 years from now, we could start seeing that pick up. But right now, no company is really planting their flag saying, hey, we're going to be, a publicly traded asteroid mining company, and we're going to be doing it, in the near future.
There's so much investment that's required in this. It's definitely a capital-heavy, investment-heavy area. So we've got the government, or at least we used to have the government doing a lot. Now we also have a couple billionaires that seem to be playing in the space, and I don't know, I think it's like their charity work, and they're trying to lose money on it. So how do these companies fit into the space economy when you have the government and then you have billionaires? Like, does it squeeze these companies that you're pinning right now?
So the government's actually extremely helpful for this industry. So roughly 20% of global space spending actually comes from the government. So that's actually kind of a support that we see right there for these various companies. Additionally, when you look at government agencies and government space agencies in particular, very few of them are actually saying, hey, we need to come up with all the R&D and we need to build everything ourselves and we need to own and operate it. Most of them are actually saying, hey, this is what we want to do. Hey, companies, start telling us how you're going to go about doing it, and we'll actually finance that. And so they're saying less, we need to do everything, and more, hey, this is a globally collaborative industry. So I think the governments and what they want to do and the kind of the varying degree of the scope of what they want to do actually allows for more players to come to the space. And now, yes, we do have billionaires that are starting their own projects and whatnot and kind of going in the direction that they see to be opportunity that they're most excited about. But really, when companies start building useful, usable space technology, lots of that becomes actual inputs or things that future companies will use. So they kind of lay out the infrastructure today, and other companies will be able to utilize that. So you look at some company that wants to send things into space, doing it now costs like a mere fraction of what it did before because of things like reusable rockets, which are lowering the cost of launch, as well as smaller satellites that are more powerful than they were before. So you could send up a smaller piece of something that you want to put into orbit, and it's going to cost significantly less.
Well, it's definitely an area that people are interested in. The ETF is the Procure Space ETF, tickers UFO. Andrew Chanin, CEO, thanks so much.
Thanks for having me.
All right, and coming up here on the final round, we'll have the sector watch, but first, take a look at where the FANG names closed on this Tuesday, with all three majors hitting record highs. Let's take a look at sector winners and losers on the session. Sectors in the red include real estate, XLRE down over 1%, weighed down by shares of American Tower, Realty Income, and Welltower. Sectors in the green today include financials, XLF, another 12-year high for the sector, led by shares of Invesco, MetLife, as well as Goldman Sachs. XLY, consumer discretionary, also up about 0.4%. Target, Ulta, and our old friends at Macy's. Positive day today, though, as we noted, Jen, 50% off its 52-week high. Not great.
Special.
Not great. Target shares, I believe that is another record high for them. Why not?
Why not? Company of the year.
There you go.
Coming up, what we're watching tomorrow in the look ahead, plus Coke taking a page out of the Stitch Fix playbook. It's subscription cola after this. And now here's Miles with a look ahead at what will be making headlines on Wednesday.
The market has for weeks been canceling the 2020 recession, and now, of course, the data are catching up. On Tuesday, readings on housing starts and building permits show the housing market is in its best shape in at least 4 years and maybe in 12 and a half. And by some measures, the housing market hasn't been this good since before the crisis. Might make you nervous, but it is a notable development, particularly since the first signs that something was wrong in this market in 2018 came from the housing market. Remember, in October of last year, the ETF that tracks home builders fell for 13 straight sessions. At one point, XHB was down on 23 of 25 trading sessions. It was clearly the canary on the way down, and its strength now shouldn't be ignored on the way up. As some economists have argued, the housing cycle essentially is the economic cycle because the business cycle and the economic cycle is really just, you know it, a consumer cycle. So, of course, the health of the consumer starts at home, and that strength is something we shouldn't ignore right now. Now turning to the calendar for Wednesday, on the earnings side of things, Paychex and Micron are among the notable companies set to report their quarterly results. And then on the data front, we only have the weekly read on mortgage applications due out at 7:30 in the morning.
Coca-Cola lovers are getting a taste for 2020 thanks to the company's new subscription service. This is a $10.
Tastes like recurring revenue.
Tastes like I hope
donuts
Nirvana
as a service.
could sing that. A $10 per month subscription offers the first 1,000 insiders an exclusive taste of 20 or more new beverages that are yet to hit store shelves. The Coca-Cola Insiders Club is now full. I wanted to get it for Brian Sazi, but I couldn't.
He doesn't really like soda, though. He just
But it
likes
just feels like
consumer
something
goods.
he would like.
He's not a sugar
like
guy.
to take, and he also liked beverages.
Yep.
So now you can sign up for the wait list.
Loves beverages.
Is this what the future of all retail is going to be? That it's all going to be subscription and everything is just going to be direct to consumer?
I think that is what companies think, and I don't think it's right.
You can't take this trajectory and apply it forever to infinity. You can't turn everything into a service. And this is a very small segment of their revenue mix.
So, I mean, this makes me think of like Dirty Lemon, right? Isn't that what they're trying to do? Their whole thing with you text and the beverages show up.
Yeah, and then it just shows up.
I think Coca-Cola, didn't they invest in them or something? There's some angle there. I think a company like a Coca-Cola wants to have more information on its customer than it does. All it knows is where the beverages are sold, so it could say, on average, we sell X amount at Kroger, and that customer has this profile. So Coca-Cola, compared to, say, Facebook, has basically no clue who buys their stuff.
I don't know of a Coca-Cola app.
Right.
There might be one, but
so there's a long way to go. But I think that we can all agree consumer conditioning is a real thing here in the U.S. and our consumer world, where all we can do is spend our money various ways. And I would just be surprised if everything I had to be like a D2C consumer. Like if I had to have a feeling about everything that's in my house.
Just a
Sometimes it's like, I just
thing.
need this, you know?
Yeah, but you're like,
So much for
Chewy, you've subscribed to something, and I got my clothes,
Like
and I got this. I
sometimes
mean, you
it's-
still have to have something you're deciding on when you have like a recipe that you got to make, but I don't know.
Yeah, well, I mean, I don't know what it's like in your house. I always find that depending on who goes to the grocery store, sometimes that some person comes back with a bunch of random stuff that wasn't on the list.
Yes, that is
Definitely
true.
one of
Grocery
us.
shopping
You were right. Coca-Cola did lead a $15 million investment in Dirty Lemon.
There you go. And now you can do the insiders thing for soda. Coming up here in the final round, we'll have more, plus our top take. So we got a 2019 huge year for investors in the cards. We'll take our guess at where 2020 could be headed. We're back with that right after this. Welcome back to the final round here on Yahoo Finance. Miles Allen with you in New York. I'm joined as always by my co-host Jen Rogers. Also stopping by today is Yahoo Finance's Jared Blicker. Let's take a look at where we finished on the session. We had record highs across the board. The Dow, the Nasdaq, and the S&P, by virtue of closing in the green, made incremental record highs, and I would stress incremental at this point. The Dow, the leader, up 11 basis points, outperforming on a relative basis today, Jared.
Yeah.
Small caps. I was going to say.
Yeah.
It's, nice to note. Nice to note. They have been a laggard. They're still lagging, I think, by about 5 percentage points to the Dow and the S&P. But kind of getting their act together here. They're really the only thing that we haven't had hit a record.
Except for maybe the transports. We could talk about those too, but they're kind of in the same class. If we get another shot to the upside in interest rates, with the yield curve expanding again, I think we'll see that record high for both of them fairly soon. I mean, what's going to stop this market? We were talking about the seasonality before, how bullish it is for this time of year. And things could fall apart in January, but at least for the next few weeks, there's really not a lot to happen. I'm just looking at another headline here. Wall Street banks pass living wills test, even as flaws flagged, but that means they're going to pay out their extra dividends to shareholders. Financials closing.
More shares,
exactly. Financials closing at a record high. So you get so much participation. And every day, depending upon what the yield curve is doing and what rates are doing, you might have a group of stocks making record highs, and the next day it's a different group. But that's suppressing volatility overall. That mix, that day-to-day mix, it suppresses volatility in the indices.
It's going to be an interesting end of the year. That's all I'm going to say.
Okay, you're going to make it interesting when you go on vacation?
I was going to say, Jen,
I'm just like, you guys.
You're here for 2 more days.
I know. That's why
I'm
just thinking, what's going to happen?
Yeah.
Something could happen. I just don't want to jinx you guys.
We'll man the fort here and make sure that we disseminate all the relevant.
I hope something happens. Otherwise, we're just going to be sitting here spinning our wheels like playing interviews from earlier in the year. Which is fine.
Earlier in the
I know, it was so fun last year, right? When falling off a cliff.
I don't remember.
You blocked it all out.
I blacked out.
Let's continue this conversation and go to our top takes and stick with the market here. Huge year for 2019 in stocks. You know that, unless you've been living under a rock. Dow 30,000. I said it. Dow 30,000. Seems like a done deal. We've got the Fed on hold. Trade war seems to be improving. Funds are back into the market big time, as a new B of A fund manager survey attests. So, just continuing where we are here, it's like the swing in sentiment has been so fast, and basically now, like the last B of A survey out, I think 66% of fund managers, maybe 64, are saying
huge swing.
No recession in 2020. Is it becoming too crowded of a trade at all that a crowded trade can reverse quickly?
Yeah, you're right that sentiment generally is a contrarian indicator. So when sentiment is really poor in the markets like it was a few months ago in August, and positioning was low as well, that was a great time to get long, as we were talking about at the time. I hope everybody took that trade because it was so obvious with hindsight. So I'm saying that with tongue in cheek.
Yeah, of course.
Because it's scary at the time, because the market can still go down further. But that's what we have to deal with. On the flip side, markets can stay overbought, especially the equity indices here. That's what I'm talking about. They can stay overbought much longer than they can stay oversold. Those situations tend to mean revert pretty quickly to the downside. So from the downside to the upside. But where we are right now, I don't think positioning and sentiment are at such extremes that we really need to worry that much. If we were to shoot up another 5% by the end of the year, I think that would make things pretty overbought. And January is a time when, at the beginning of the year, 1/3 of the positioning in stocks, repositioning is done in January. So usually that's a tailwind. But then, heading into February, there's a reason why we had Volmageddon 2 years ago in February. So
I think a lot of people agreed for a long time that from basically September 2019 going back in time to January 2018. There was a very 2014-15 feel to the market, right? We had a lot of, the trade war could be replaced by the oil crash, right? And the market had a lot of action, but on a straight line, point to point, it didn't really go anywhere. And I know a lot of people took issue with that idea because it did go somewhere. It went down 20% and then came all the way back. So either, I guess in my estimation, either the beginning of next year is going to be a 2018 redo. We're going to see a blow off top. We're going to see Dow 33,000, and then something bad might happen. Or, you know, I kind of echo what our friend Joe Fahmy has talked about a lot, which is these mini cycles within the bull run, right? I mean, the Tom Lee kind of secular bull market thesis is really popular now. You know, the whole idea that this is a 20-year run and this is a mini cycle. Yep. And if that's true, maybe we're just at the beginning of another 20% run higher because, yeah, we're at record highs, right? But we're only, 4%, 5% above the records we hit in January 2018. It hasn't been a huge, forceful breakout yet. So I think I kind of have my eye on, you know, with all the skepticism around the market, even when we have these short-term sentiment swings, is this the beginning of a new leg to this bull run? Or is, you know, that would seem to me, my suspicion is it's kind of more of that, right? Looking at where the economy is at, recessions don't just come out of nowhere. And a lot of those flags have really gone away. You could have a vol type event, you know, where the market has been very susceptible to that stuff. But I don't know, it feels, God, we're going to play this back when the market crashes, aren't we? It's like, it feels like it's fine. I mean, it just seems like we've done
December
a lot of
17th.
We've done a lot of flushing in the last 2 years.
It feels like we had a little
right?
pause. It does feel a little bit like 2018, though, going into 2018. And when Trump, they announced that he's going to Davos.
I was
like
he did last time.
It's just last time. But that was
All right,
global
so I'm
highs.
bullish.
Everything was great.
Where are we going?
Trump is going. It felt we had that melt up. Kind of feels like, I think January is going to be big. I timestamp it, play it back in February. It'll be wrong.
33 by 3.3.
Just brutal. Yep. There's just nothing you want less than your prediction on
I know.
it.
It's the worst. Why do we do this?
All right, coming up here on the final round, we've got all eyes on 1-800-CONTACTS. The company is now expanding into at-home vision tests using mobile, what it means for the business and competitors like Warby Parker and Hubble. We're back with that right after this.
One-800-CONTACTS boasts nearly 20 million customers and delivers more than 200,000 lenses daily. The 25-year-old company now wants to make that process even easier with a new acquisition that could transform at-home vision care. Joining us now to discuss is John Graham. He's the CEO of 1-800-CONTACTS. So, I mean, everybody wants to have medicine in their house, basically. Tell us about this acquisition. Does it mean you don't have to go to the doctor now?
Well, it just changes the nature of your visit to the doctor, right? Traditionally, you've gone to a doctor's office and maybe even bought your contacts and glasses while you were there. Now it gives you the chance to interact with the doctor from home. So it reduces the cost and both in money and time of being able to do so.
All right, so how is my vision getting checked from my house? And I guess my thing is like, I guess I'm standing 3 feet away if they ask me to stand 3 feet away, but like, what if it's 4 feet? Is that going to change my prescription? And then, the troubleshooting process, right? You go to pick up your glasses and they kind of look at you and maybe it doesn't fit. You can change something after that. I think for me, it is still okay to have that touch point, even though it's sort of annoying to always go to the doctor.
Yeah, and I don't think, in the same way that everything online works, it's not like brick and mortar doesn't go away, right? Some things you'll do online, some things you'll do face-to-face, just like with everything else in life. The exam itself is actually, the way that this exam works is using a smartphone. So if you think about the technology that you traditionally use to get your eye checked, it's really old technology, right? It's Apollo 13 sort of technology, and so we carry around more technology in our pockets than they had back then. It's just very old technology, and so it just uses
what's that thing called the
four-opter. Yeah, very good. You know the lingo.
Is that where they say
one or two?
Yeah, 1 or 2. How are you going to do that from somebody's house?
So the way that this eye test works is you actually hold your phone, and as you bring the phone close to your face, it detects when you stop it when you can see clearly. So it's detecting the distance rather than you. So it's really interesting technology, and there are obviously benefits to being able to do that, and there's benefits to working offline as well.
I wonder if are you getting regulatory pushback? So I use the example of Smile Direct, which is disrupting, orthodontists, and they have this system whereby a doctor in a different state usually is conducting the examination remotely, and so a lot of states are pushing back against that. I imagine that orthodontists are lobbying against that. Are you finding the same thing in your industry?
Yeah, I think there's similar things throughout any of these sorts of businesses where there's telemedicine, right, of making sure that you do it in a way that's licensed in the right state where people are located matters a lot. And so we already have a telemedicine platform that we've been using for several years, and so we use doctors who are licensed in all the states that we work within, and we'll continue to do that as we roll this out. Actually, the 6/6, the main 6/6 technology won't come to market for another year or two, but when it does, we'll be using licensed ophthalmologists the same way.
But there are states, right, that don't allow this.
There are a handful of states that have disallowed telemedicine.
Are you guys going to those states and trying to lobby to change that? Do you expect to, in 10 years, be able to do this across the nation?
I think it's hard for us specifically as a company to move an entire state in their telemedicine laws. But I do think that those few states where that is a law, more and more of their consumers will likely push to have the access to these sorts of solutions. If you have it available in 45 states and it's perfectly healthy, at some point, I think that those 5 will start to think, well, maybe our citizens would also like that.
And I'm just curious what you kind of see as the state of the eye profession, if only because there's been a lot of entrance into that space. And I think it's clearly an area where consumers, where patients are comfortable working in a startup setting or working remotely. Is this changing the way that optometry schools are teaching their students? Are we seeing fewer optometrists because of how that market has changed? And where do you see that going? Because I think, optometry is probably ahead of the curve relative to almost any other medical discipline in terms of how technology and the consumer side of it has changed patients' preference, really.
Yeah, I think that this is certainly a market where there's more consumerism, right? Because most of our customers pay out of pocket for their contacts, and so there's more of an approach to consumerism. It's also a fairly straightforward exam. It's not, and so I think that there is change within the industry. Frankly, it's been an industry that hasn't changed that much in a long time. It's sort of the same thing for 50 years, and then there were a few changes to it as lens crafters came into the market 25 years ago. We came in and started to change some things. Then, as you said, a few companies have come in the last few years to start to try to innovate, and honestly, that's a bit of a breath of fresh air. Innovation is good, right? I've rarely thought, boy, we just don't have enough innovation in this space.
1-800-CONTACT CEO John Graham, thank you so much for coming by, and Jared Blickery, have a great evening.
Thank you.
All right, and coming up here, Permanent Portfolios. Michael Cugino gives us his take on the markets right now and where he's putting money to work as we head into a new decade. We're back with that conversation right after this. for investors is wrapping up, so what does 2020 have in store for markets? Michael Cugino is the president and a portfolio manager of the Permanent Portfolio family of funds, and he joins us earlier to discuss.
Well, I think the market was building to that result, and so it's already been priced in, so to speak. And really, the trade deal took away a risk more than anything else. I think the risk is that the two countries continue to fight and nothing gets done and relations get worse, and that hurts everybody's economies. By having a deal as limited as it was, allowed that risk to be taken off the table for the moment, and it allows the markets to really move forward beyond that and begin to think about other things that may impact it. So I think risk mitigation was the major winner last year. And with that in mind, with the Fed on the side, the other piece of news we got last week was the Fed appears to be on the sidelines for a while. So you've eliminated two risk factors now going into the new year. But the market has also been anticipating this and priced it in. So I think that's why you haven't seen a big bump, but more of just a gradual uptrend or a continuation of what we've seen for the last 2 or 3 weeks. So I think that's where we're at. Going into 2020, I think you nailed it. We had a great year this year, the last 2 weeks notwithstanding here. But the question is, what do you do going forward versus looking back? And I think where we're at right now, there's a lot of good things happening in the U.S. economy. Global interest rates are going up a little bit. Global growth may be improving. You've had some risk factors taken off the table with respect to trade. Inflation's low. People are working and spending. It looks to be a good fact set going into the new year at this point, but things can change quickly.
So let's break down some of those sectors and where, in terms of asset allocation, if things look, sentiment has really shifted. And as you say, we're getting confirmation from some of the data that's coming out. So if 2020 is looking good, what is your favorite sector right now to say, you know what, let's add to that?
Well, we run a diversified fund, our flagship permanent portfolio, which invests in a bunch of different asset classes: stocks and bonds, U.S., non-U.S., gold and silver, real estate, natural resources, commodities, et cetera. So we maintain a diversified stance all the time. And I know the last 10 years or so, diversification and hedging your bets has really been out of favor. But at some point, it will be back in favor. And we think a prudent investor should always have something put aside for this sort of investment planning anyway. But having said that, in the equity market, for example, we would tend to focus on sectors that have not kept up with the broader market, that have been beaten down, but that are also levered towards improving or doing well in a growth-oriented environment, which would fit the fact pattern that I laid out. So obviously financials, transports, manufacturing, materials, commodities, energy would all be areas that would meet those characteristics for a patient investor going forward. So if you're looking for value and areas to make money that aren't too expensive, those would be the stock sectors that I think you would want to focus in. And we have healthy investments in all of those.
And Michael, just thinking maybe a little bit bigger picture towards the next decade, we've seen a number of kind of big strategy notes come out and predict essentially low returns in the 2020s, and that we've had such a blockbuster 2010s across a number of assets, most notably just the U.S. stock market. The all-world index is basically back at record highs. Do you see that kind of lower return profile in 2020, given where rates are and given what we've seen over the last decade?
Well, it depends on the economic landscape. The big debate I think the market's dealing with right now is, are we late cycle and heading into a recession? Or did we pause at a certain point this year as a midpoint to a larger, longer growth cycle? And I think that's what the market's trying to figure out. And I would agree that that's a legitimate question right now. Things tend to revert to the mean for the better or worse. And you've had a tremendous decade for equities. And so at some point, I think you would revert back to the mean and have lower returns. But when that is, I can't tell you. I mean, I think many people have been predicting that for several years now, and they may have missed quite a move in the stock market. So it's a tough thing to do. I think the big picture is that the next 5 or 10 years, I suspect for a lot of reasons, are not going to look like the last 10. And so investors have done very well in the last 10. I mean, literally, an investor, all they had to do was buy S&P or equity index or fixed income index funds, and they've done very well. And that was a great trade. You didn't need hedging. You didn't need to really think too much. You didn't need active management per se. You did well. But going forward in a much more mixed environment, where the data may be mixed, where the economies may be mixed, where you may have a recession, where you may have more fluidity with fact patterns, you're going to want something to work that wasn't necessarily the right answer for the last 10. And I think, we're in the middle of that space, and we know that space well. But, I think it's going to look very different going forward. And so investors should be prepared for that and not just assume that things are going to go on like they have the last 10. It's been a long cycle, and it won't continue forever. That I can tell you. I just can't tell you the timing.
All right, and coming up, we'll have what you missed here on Yahoo Finance today. We're back right after this. All right, it's time now for all the best moments that you missed today right here on Yahoo Finance.
We think the next 2 weeks are going to be a melt up into the end of the year. You're not going to see a reversal here at all. You've got less risk in the international system, in the international economy, so you're getting this melt up.
There's a social narrative that exists in our communities for families and for students, and it makes them feel this level of stress that's quite frankly unnecessary. Most employers are still looking for the skills such as strong communication.
BridgeBio Pharma, a pharmaceutical company working on drugs for various rare diseases, and because of that, it hopes to avoid the kind of competition it might see for treatments from more widespread conditions. The company hit the market in June for $17 a share and jumped 117.24% to $36.93 by December 10th.
With its sneakers app and the Nike Plus app, the growth potential of Nike in the digital space is quite enormous.
The idea is the gift giving process can be very challenging. So we wanted to reduce gifting to just that intention of I want to do a nice thing for someone and let the recipient pick out the gift that they want. And the whole process is kind of like taking the recipient shopping.
International subscriber growth is not something easy to do, right? It's not like other people are going to jump out and get into these markets. And Netflix is truly a global company. So being able to show that growth is important given the amount of investment they've made on content outside of the US and Canada, right? But they also did this other trick, which is like, hey, US, Canada, we're going to keep your numbers together. And that's the other thing that kind of came together. So you're looking at very uneven numbers. But the main thing is growth has slowed down in the US market and the Canadian market, and the streaming wars are coming.
The trade deal took away a risk more than anything else. I think the risk is that the two countries continue to fight and nothing gets done and relations get worse, and that hurts everybody's economies. By having a deal as limited as it was, allowed that risk to be taken off the table for the moment.
One final look at where the markets finished for the day. It was down to the wire for the S&P, but check it out. 1 point, and that means another record, our longest winning streak in a month as well. You know I love a good streak.
All we need is 2 more positive closes, Jen. You can go on a vacation on a winning streak of like 6 days.
Wow.
What a treat that would be. Talk about a Merry Christmas.
Let's see if we can do it. That's all for now from New York. I'm Jen Rogers with Miles Edlin, and this is the final round on Yahoo Finance.